Hiral, and it's showing in the way the global markets are behaving as well.
Absolutely, because if you see in terms of the way US markets have reacted, a clear surge, tech stocks have rallied, so that's an interesting one to look at. And I think the commentary that came in with regards to tariffs or what will be done with regards to chips, there could be some changes that could be happening on that front, right? So that aspect is going to be important. The delay in tariff implementation is what the street is watching out for, because everyone was probably looking at something very immediate. Now we are looking at the 1st of April. So that is what has cheered the US markets overall. S&P, if you see, Neeraj, a 1% gain, I think nearly a record high. We are very close to a record high in terms of S&P 500. Meta, 19th consecutive session of gains coming in on that counter. And overall, if you see in terms of crude as well, that has steadied at around $75 per barrel. So that is going to be some bit of good news coming in there. So across, the sentiment seems to be absolutely positive on the commentary that we are picking up on the US tariffs. Plus, if you talk about the trade war as well, again, from a sentimental perspective, it's moving towards the right direction.
Sure.
Now, in terms of execution is what we need to see as to what comes out of all of these agreements that are getting signed, because that is what will tell you as to what is the next course of action that whether India or US will have to take.
And we'll talk about this in just moments from now. But before that, Hiral, a good time to take stock of what the global market mood is with Steve Englander, simply because the inflation data, while on the looks of it looked okay, but otherwise under the hood, not that bad.
Absolutely, because if you see in terms of at least the minute details that have come in, as Alex was also pointing out, clearly some aspects have been positive from that point in time. In fact, let's also get in Steve Englander, Global Head of G10 Forex Research and North America Macro Strategy, Standard Chartered Bank. Steve, good morning and welcome to the show. Your first view in terms of the data that has come in terms of the PPI.
Yeah, look, the data are not as bad as they look. We expect that year-on-year inflation, core PCE inflation, will drop from 2.8 to 2.6, and it could drop even further in the next couple of months. It was high, but the parts of the CPI that get tossed were high, so they're not going to be counting that much. And the parts of the PPI that were included were kind of soft. So it all adds up to, we think that PCE will be friendly when it comes out.
Steve, that PPE observation, the expectation that some aspects or some components of the PPI, which is the wholesale index, actually softened, and so that is good news for the Fed's preferred gauge of inflation. That is what we're looking at in terms of what led the street to have a positive view on that. Is that really the key takeaway from those numbers for you? And does that change the expectation on trajectory of rates going forward? What is your base case assumption of where rates head from this point on?
Well, look, we used to be pretty aggressive in thinking that the Fed would cut 4 times. Now we think they're going to cut twice. The economy hasn't visibly slowed fast enough to really make them want to cut, aggressively at this stage. And they probably want to see what happens with tariffs, with when they get implemented, what happens with fiscal policy. So we've shifted to a more cautious stance on what the Fed does. If inflation gets down to 2%, we think they will, and stays there, we think they'll cut, but they'll cut slowly. If the economy weakens, they'll cut much quicker.
Steve, the US exceptionalism was the key point for 2023 and 24. Early this year, everybody believed that there's no reason why that can't be the case. As you look at North America macro, and all the challenges that the US faces as well, right? Will it be an easy market to invest in, and will it turn out to be yet another year of US exceptionalism, or do you reckon emerging markets make a comeback?
I think it will be a year of US exceptionalism. I think that Trump is determined to stimulate the economy, so we're going to get tax cuts. I'm not a big fan of the tariff agenda, but that's, it's probably not going to have that big an impact if, the negotiations continue the way they look, where you get some concessions, you delay tariffs, they're not as harsh as anticipated. But I think that if we end up with lower interest rates, and if the U.S. is able to generate an environment where the long yield comes down, it could be a good year for EM. I think it's going to be hard for them to match the U.S. because I think in the first instance, the market will be focused on rate differentials, and it's likely that U.S. rates are going to go higher. Long end rates are going to go higher, towards the end of the year. But I think, I think it may not be a terrible year for emerging markets. Not nearly as bad as people expected, say in December or beginning of January.
So that's music to the ears of a lot of people listening in at this moment, Steve. But I have to ask you about the big talking point overnight, which is the announcement of reciprocal tariffs. Is this another instance of Donald Trump preempting certain negotiations that take place with key trading partners? And is this another instance of something that will dissipate eventually, or do you think that this will actually come to pass? What are the implications?
Well, look, I think broadly speaking, the U.S. probably isn't going to get what it wants from reciprocal tariffs. It's not going to. I mean, the rest of the world and its major trading partners don't have tariffs that are so much higher than U.S. tariffs that, making them converge will either raise a lot of revenues for the U.S. or shift production from import or shift demand from imports into domestic production. There could be countries where and commodities where it matters. So I think reciprocal tariffs are easier to implement, and I think that's a big reason they're going for it. But I'm a little skeptical that it's going to deliver quite as much as President Trump has been arguing that it will deliver.
Steve, thanks so much for joining us this morning, for the perspective that you gave us, and it's an important update, of course, to talk about. Thanks so much for joining in.
Always a pleasure.
Yeah. Well, guys, obviously the big talking point is the meeting between US President Donald Trump and Prime Minister Modi. And while we're going to talk about the implications of what was talked about, not anything in the way of very clear details, but just the overarching numbers you should be aware of. The total trade between the US and India is currently estimated at about $129 billion in 2024, and that's according to the Office of the US Trade Representative. You have 17% simple average tariff from India on countries with most favored nation status, compared with the US that levies 3.3%. But what are the key details of the trade and the announcement of reciprocal tariffs? What could the implications be for India? Somit is joining in to tell you about some of that. Somit?
Well, yes. If you look at India's book, India as a country's book, then US accounts for nearly 17.7% of India's goods export. However, if you look at how much where we rank as a part of trade surplus when it comes to US, we are 7th ranked. So we are not the highest among. Highest is China with around trade surplus of $295 billion, followed by Euro region, which accounts for nearly 267. Then there is Mexico, Vietnam, Taiwan, Japan, South Korea, Canada, and India are here at around $46 billion. So it's not among the highest, it's the 7th largest when it comes to trade surplus. Apart from that, if you look at the goods where we see, these are the products where we have much more exports than imports come from US. So for electrical machineries, if you look at the trade deficit stands at around $11.8 billion, followed by pharma products where the trade deficit is around $11.8 billion, pearls and precious stones, nuclear reactors, textiles anywhere between $3 to $6.3 billion, followed by other products like not knitted apparels, organic chemicals, articles of iron and steel, apparels, vehicles, which stand anywhere between $2.2 to 2.4 billion US dollars. So these are basically the commodities which we export more compared to what we import. On the flip side, if you look at, these are the commodities which we import more compared to exports, and first in the list is minerals and fuels, and gas LNG might be higher on this, around 9.6 billion US dollars, aerospace products around 2.7 billion US dollars, optical parts around 1.2, edible fruits and nuts, pulp food around 1.1 billion dollars, and similarly then there is chemical products, beverages and spirits, iron, steel, plastic, cotton, anywhere between 0.1 to 0.5 billion US dollars. So these products are not on which there could be reciprocal tariffs, but the earlier products that we had shown, that could be the one where we could see reciprocal tariffs. Now this is the most important part. Though we are 7th largest when it comes to trade surplus with US, but on trade tariff part, if you look at the weighted average tariff, it stands around 8.5%, the second highest in the Asian countries. South Korea is the top around 14.4, then there is China at 7.1, Thailand at 6.2, Mexico at 5.2, and US charges around 3% weighted average tariff. So there is a clear differential of around 5.5 percentage points. So which are those products where the differential is the highest at this moment? First is animals, where the difference is nearly 30.2 percentage points. Vegetables has a difference of around 20.5 percentage points. Food products 35.6, footwear 17.2, textile and clothing. This could be the sector that could get impacted the most, because a lot of Indian apparel makers export a lot of textiles to US, and that there the trade differential is nearly 15.6%. Then followed by transportation 14.4, chemical 9.4. This could also be one of the key sectors to watch out for. Stones and glass 9.4, and minerals is around 8.6. So these are the products basically where the trade differential or the trade tariff differential is the highest when compared to US tariffs.
Thanks, Amit, for getting us this entire breakdown, because this categorically tells us as to which are the sectors we should be focusing on in trade today and when markets open, because textiles, you have your chemicals. Apart from that, even if you're talking about pharma, to a certain extent might see an impact, but your electricals part of it, your even OEMs part of it, the auto part of it, these are sectors which we will have to absolutely watch out for pretty closely once trade opens. But also let's welcome in Mr. Ashok Sajanar, former diplomat. Mr. Sajanar, good morning and welcome to the show. Your initial comments, you know, when the entire conversation of Trump 2.0 had started, you had clearly indicated that, you know, that India and US will actually deepen their cooperation under Trump 2.0, and this would significantly boost trade and technology. Now that first Trump has called India the tariff king, now you're talking about reciprocal tariffs that will be probably coming into effect from the 1st of April. Your initial commentary on it?
Yeah, thank you very much. So, you know, this is not the first time that Mr. Trump has called India the tariff king or the worst tariff abuser. He has been making these comments, he's been making these remarks even during his election campaign and even after he was elected. So, number one, this is not the first time that he has said that. The second is that, you know, the reciprocal tariffs have been announced, but they are not in that sense country specific. This is the global approach that Trump administration has given, that reciprocal tariffs will be applied to those countries. And I think your colleague has very nicely you know, put out as to what are the tariffs in terms of the import tariffs that the US products have to face while coming in India, and vice versa when Indian products are exported to the US. My point there is that even if you were to go through this reciprocal tariffs, it's going to be a very tedious and a very difficult exercise, because how do you, you know, what India exports are not the same products that India imports. So, you know, getting a congruence, getting a similarity of products which have sort of, you know, different tariffs, that's going to be very difficult. And there's going to be, you know, different tariff lines, different, you know, HSN nomenclature, tariff nomenclature. So, you know, so that is the technical part of it. On the conceptual part of it, I think both the countries have decided that by fall of this year, we are going to have, you know, a trade deal. Earlier, as you know, your viewers would know, that there was a mini trade deal that was being negotiated in Trump 1.0. And in the last days, it could not be concluded, and then we had COVID-19 pandemic. So right now, both the sides have indicated their commitment to have this deal in, you know, by September, 7 or 8 months. So I think work is going to start on that. And, both the sides, it's also been decided that by 2030, we are going to take our trade from the current about $190 billion, which is in goods and services, to about $500 billion, which is more than twice the amount. So I think work is going to start on that. In my view, what Mr. Trump uses, tariffs, it is really as a negotiating instrument. Like he has said in his art of the deal, apply maximum pressure so that you are able to get maximum benefit out of your negotiating partner on the other side. So I think this has been used, this will be used as a negotiating leverage against India, number one. Number two, also to have a time-bound program for getting at least a mini trade deal. So I think we can see the movement in that direction.
Okay. Mr. Sajana, so you've elucidated a lot of the points that we were going to talk to you about. So I'm glad that you're so clear and concise. But I have one specific question on something that you mentioned, which is the difficulty in having these reciprocal tariffs. Is the interpretation, or could the interpretation of that be that if it does come to pass, you may not have a dramatic change in the weighted tariff that is currently in play simply because of the different goods and services, or goods in particular, that are exchanging hands?
No, absolutely. I agree with that. That there might not be any, products that are of interest to the United States. And, we can have, as we've already done in our budget, whether it is as far as the Harley Davidson is concerned, or luxury cars are concerned, or EV batteries are concerned, we have brought those down. So, in terms of the macro numbers, what you're showing, weighted average of 8.5, that might not come down in any significant way. But products, particularly, specifically of interest to the United States, we could have a look at that and, taking into account that though they do not really impinge adversely on the sensitive labor-intensive sectors in our own country, or sectors like agriculture, which are very domestically, politically sensitive, or the MSMEs. Those are things that we will safeguard. We will ensure that they do not face undue competition from outside.
Right.
Like in the past, I remember when I used to be in the Ministry of Commerce, we, as far as the Californian almonds are concerned, some of the other, engineering items, we did provide relief to the US products.
Yes.
But we safeguard our core interests and concerns.
Absolutely. Mr. Sajana, thanks so much for that insight, and absolutely amazing having you this morning. Thanks so much for joining in.
Thank you. Pleasure. Always a pleasure. Thank you.
All right, let's talk about very quickly what happened in trade yesterday. And you had foreign institutional investors that once again sold. This is for the 7th straight session. 2,789.9 crore rupees was the net sell number. Domestic institutions buying about 2,934 crore rupees. Indian equities were largely unchanged after a choppy session. The benchmark Nifty 50 shuttling in a 143-point range, and the benchmark actually ending about 0.9% off the high point of the day. You see that progressing in the second half, giving up most of those gains post 1 p.m. Broader markets also remained choppy and ended little changed. Not too much in the way of gains for the mid-cap index, and the small-cap index also going home very little change, down about 1/3% or thereabouts. The India VIX, by the way, inched upwards to that 15 mark. Pharma stood out as a pocket of strength, gaining about 1.3%. Metal and realty counters also gained ground. On the other end of the spectrum, IT, FMCG, oil and gas counters all lost in trade. The top gainers and losers once again were driven by earnings, and that likely will be the case today as well when we talk about the stocks in focus. Natco Pharma, just as an example, went home with losses of 20%, and Honasa and Suven, on the other hand, gained quite significantly. Neeraj.
Yeah, I mean, the market is duly punishing companies which are not coming out with good numbers when the expectations were high, which is probably only fair, if you will. So, be interesting to see how this shapes up. So, the Prime Minister Modi, Donald Trump meet. Well, if anything, the bonhomie might just aid sentiment. Keep in mind the global up move, if you will, or small up move that we have, also just aids that little bit of a sentiment booster in today's session. The only problem with this that now that the Nifty earnings are out of the way, with that 7% earnings growth mark, we're kind of landing somewhere in between disappointing to just about average. And therein lies the problem that the earnings growth is not quite shaping up very well. Does it recover in quarter 4? Remains to be seen. And therefore, it may well happen that for the next month and a half, the markets might just be in a limbo without having any major triggers. The policy is out of the way. This overhang is out of the way. Whatever the government could do in terms of the budget is out of the way, and earnings are out of the way. So very difficult to find very fresh triggers on the local front. Maybe it'll have to be global. And therefore, that's what you watch out for. And suffice to say, guys, today, I don't know, I haven't looked at the stocks that you have in your lists, but the larger set of stocks seem to be more on the disappointing side as opposed to on the gaining side, which is a bit of a worry.
100%.
We're ending the season on a bit of a whimper.
Absolutely. We're ending the season on a whimper, but few stocks that, on my list, we have 3 of them. The first one being United Breweries. The numbers are not that strong, but one of the aspects that we need to consider over here is the capex that they are planning by the 4th quarter of FY27, wherein they will be putting up a brewery in Uttar Pradesh. So that is one of the aspects we need to consider. But overall, a dismal set of numbers from United Breweries. And what the other aspect over there is that the margins have missed, and this is on the strong growth in the premium area, which has actually affected the return rates, right? So the gross margins have come in at 43.3%, a dip of around 89 basis points on that one. Low bottle return rates, as premium requires new bottles. They can't use the used bottles in that category. Apart from that, if you see in terms of the employee as well as other expenses, that has also increased, and they've said it's mainly on the back of the investments that they have made behind key brands as well as organization. More clarity will be awaited. The company does have a conference call today at 3 p.m. So the steps that the company is taking to close the portfolio gap between different price points is going to be the key monitorable from this front, and the revenue management and cost initiatives to improve margins is what we should be watching out for a United Breweries. The second on our radar is Godfrey Philip. This is an interesting one to watch out for. You might not see a negative reaction on this one because the revenue, a growth of around 27% coming in there. Profits have grown around 49%. Now, if you talk about cigarette revenues, they are up 36%. The cost of raw material has gone down for a Godfrey Philip. The finance cost has gone down and the other expenses have gone down. So all of this is what has aided the margins. Now, it's not only this quarter, their first half of FY25 was also absolutely strong. And they've clearly said that their strategy is going to be to target new cigarette markets, build on the export market, and leverage and monetize the distribution infrastructure. In fact, they've also done a supply agreement with Ferrero India. So Godfrey Philip, a thumbs up coming in on that one. And very lastly, Deepak Nitrite, again a thumbs down on this stock on the back of a dismal set of numbers because the revenues have seen a downtick, but the profit number, a downtick of almost 52%. The estimate was 183 odd crores. The number has come in at 98 odd crores. The margins as well have come in at 8.83% versus an estimate of 14.1%. So versus the previous quarter as well as versus estimates, the numbers have been below estimates. And clearly, they are saying that they are expecting margins to expand in the 4th quarter, but absolute thumbs down.
Yeah, thumbs down. I have a couple of thumbs downs as well, and one of them is Senco Gold, and a very dismal set of numbers coming from this company. Though the revenue growth has come in at 27%, the EBITDA has actually declined quite considerably, 56%. Margin has contracted very sharply to 3.8%, and the expectations had pegged it at 10.6%, and the versus number is actually 11%. So very considerable contraction in margins. The profit number is down as much as 69%. What has caused this? The margin erosion is on account of the lower stud ratio and higher export sales and OPEX increase. And there's also a custom duty impact in the quarter to the extent of 48 crore rupees. The cost of raw material has also gone up by 10%. Finance cost is also up as much as 20%. So that's certainly something on the radar in terms of a thumbs down. Manappuram is also a disappointment. And earlier in the week, you had positive cues from Muthoot. But this one is a bad number. Why? Because provisions have gone up quite considerably. The PAT number is down as much as 51%. 282 crore is the number. The expectations had pegged it at 489 crore rupees. There is an impairment at 555 crore rupees. That's much higher than the comparable quarter that stood at 260 crore rupees. The standalone loan growth is also at 18%, and that's slower than the comparable period where the growth was as much as 20%. The gross non-performing assets have widened, increased to 2.5%, and that's also a negative. The last stock on my list is actually a positive, KNR Constructions. Good set of numbers coming for this company. Though the revenue declined by as much as 15% to 848 crore rupees, the EBITDA has seen an uptick of as much as 13%, and the margins have expanded quite considerably, coming at 30.1%, and the PAT as a result of which has increased by as much as 78%, Neeraj.
Yeah, I'll start off with a positive, and that's Hindalco. The numbers, despite Novelis's performance, looked okay. Revenues up 10.57% ahead of estimates, 58,390 crores versus estimated 55,632 crores. So on the revenue front, ahead of estimates. Operating profit margins 12.98, in line, you could argue, because the estimate was 13.3, almost in line, you would argue. And the profit after tax up 60%, 3,735. The estimate was 3,372. What helped earnings? Strong earnings driven by the India business despite Novelis's underperformance. Aluminum upstream revenues and downstream were up 25%, and the upstream EBITDA was 73% higher. So very strong set of numbers by Hindalco. You wanted this to come in. They have come in, and therefore this should augur well. Concord Bio left a bit to be desired. Revenues were up 1.24%. EBITDA margin was down 409 basis points. Net profit was down 1.29%. And by the way, this is because you look at these numbers, YOY. If you look at it quarter on quarter, it looks even more shabby. So a bit of a pickle for Concord Bio. One would suspect that this one will have a corrective move. And lastly, the street is piled on Hindustan Construction because of plans of some development around the nuclear side. The numbers, not that great. Revenues down 31%, an EBITDA loss, a net loss of 39 crores versus a profit of 182 crores. HCC turned out a shabby quarter. Very likely, we'll see a bit of a reaction. So these are the top 9. We'll get in some more details. In fact, Mihika will join in to talk about Hindalco in a bit because it's really the standout large cap name. So we'll talk about that and more on the other side of this very, very quick break. Stay tuned.
आता है कि वो कैश
Welcome back. You're watching India Market Open. Let's just quickly look at the implied open currently, what that number is indicating. When we started off, it was around 100 points is what we were watching out for. Stays pretty similar, 81, 82 points upside is what we could be seeing. But clearly, you know, what's going to be interesting from here on is the sectors that we should be watching out for on the back of US trade tariffs. It could be a sentimental impact as well. Pankaj, let me come to you on this one. Clearly, you know, I mean, last week's consolidation is something that everyone was saying is not going to be sustainable. Now the key is going to be how the tariffs are going to affect markets, and that's what you were watching out for as well. Your initial comments, and how do you see sectors getting impacted?
So I think, this tariff tension is going to keep markets under check for some period of time. I don't think we have enough clarity to sort of say that things are going to turn which side. But having said that, structurally, we would want to believe that whenever this settles down, there would be a tariff arbitrage in India's favor, and which is going to sort of benefit some of the export-oriented sectors. But I think that is still some time away. Till that time, what we are going to largely focus more on, given the fact that budget has been quite consumption friendly. So I think a lot of consumption-oriented sectors, like, say, for example, hotels, hospitals, autos, look structurally positive to us, given the fact that overall, besides the 1 lakh kind of a benefit being given, a lot of these state direct benefit transfer schemes have been sort of going on. So that should help the overall consumption as a pack. On top of it, our sense is that even the next RBI policy meeting, our sense is that we will see some kind of a rate cut. So that will benefit the domestic sector, especially the banks. While initially it is negative for banks, but our sense is that the transmission of rates will effectively happen with the kind of measures RBI is taking, especially on the liquidity side. So bank is another sector which looks attractive from a risk-reward perspective. And we're keenly watching for some kind of a safeguard duty, as some of the companies have guided for steel sector in this current month. So in case if that happens, I think steel is one sector which should sort of do very well going forward. I think we have already seen worst of the prices in steel for the last, so prices are at a 4-year low. So from that perspective, there is another sector which we are looking at quite constructively. Cement is another pack. Like I said, we are seeing, or our sense is that the pricing will start getting better. So worst is already behind us. And since we are expecting more of a normal year, so we will see more of a normal volume growth with improvement in EBITDA per ton. So that is another segment which we are looking at.
So quite a comprehensive list there. And in the metal space, Pankaj spoke about steel, but Hindalco is something that we're focusing on at the start today because of the numbers, and the numbers significantly better than the expectations, particularly on the EBITDA per ton front. What worked? And what worked despite the Novelis situation? To tell you about that, I'm joined by Mihika, who's been looking at the numbers very closely. Mihika, please tell us.
Yeah, a very good set of numbers, and this was despite the weakness in Novelis. We've seen revenue see a 10.5% uptick. EBITDA is up 30% to over 7,500 odd crores and met estimates. Margins have seen an uptick, 12.98%, almost 13% versus 11.1% a year ago. And net profit is up 60% to 3,735 crores versus the estimate of 3,300 crores. Now, what helped earnings was the India businesses. We've seen aluminium upstream and downstream revenues rise 25% on a year-on-year basis. The copper segment also saw revenues see a 15% increase. In terms of the aluminium upstream, well, EBITDA was up to 73%, and the copper segment's EBITDA was up 18%. When you look at the segment-wise performance, well, aluminium upstream revenue growth was driven by the higher prices we saw in Q3. Shipments were muted, 1% uptick to 338 kiloton, but the EBITDA per ton saw 68% annual growth to $1,480. For the downstream segment of aluminium, revenue was driven by volumes which rose almost 10% on a year-on-year basis to 99 kiloton, and the EBITDA per ton was up 22% to $179. And lastly, when you look at the copper segment, revenue growth was driven by higher copper prices. However, the shipments remain muted, like aluminium upstream up about 1% to 120 kiloton.
Megha, a request, take a breath and tell us which is the most standout part of Hindalco's numbers. We have no hurry.
Yeah, I think it's the, you talk about the EBITDA per ton, this is coming despite we seeing a volume uptick, especially for the aluminium upstream. You've seen EBITDA per ton rise 68%. Yes, this is, a metric of higher prices, but they've also kind of have some stabilization on the cost front. And the aluminium downstream, which is what's the company's next leg of focus, we've seen volumes drive 10% year on year. You also have a FRP project for the aluminium downstream, which is going to be commissioned in FY26. The company has been focusing on that, and you can see, the benefits and the focus coming through in the numbers. We've seen the EBITDA per ton for this segment rise 22% on a year-on-year basis as well.
Okay, Megha, thank you for bringing that to perspective. Pankaj Pandey, you would have looked at the numbers. What is the house view? And then I'll of course go to Kush Bora on what to do if Hindalco were to start higher. But Pankaj, first, a results review from you. Good morning to you. Did you like what Hindalco has done despite Novelis doing what it has done? And does it make it an investment candidate?
Absolutely, Neeraj. Because see, when you look at the Novelis performance, because of the higher scrap prices, the overall EBITDA per ton had gone down from 490 odd to closer to 400 kind of levels. But you look at the domestic operations quarter on quarter, we see a 5% improvement in the EBITDA per ton or realizations in both upstream and downstream. And good part is that Hindalco is pursuing again growth objectives, and the balance sheet for the company is quite healthy. Debt equity ratio is 0.5. This is one company which in the non-ferrous space, which we like with a target price of 800. That was our earlier target. Obviously, we are going to review the target once we are done with the final numbers.
Okay. Now, we don't know what price it will start at, but it looks like it will start off higher. Now, Kush, tell us. If it starts off, let's say, a couple of percentage points higher in a market scenario like this, where you're not too constructive, would you go long on Hindalco?
I would actually take this opportunity to perhaps book out of any positions. Not everything's a shorting candidate at the moment, though it might seem like. But the stock has actually consolidated. If you see the last 3-4 sessions, it's not actually been as volatile as the market has been. It's respected the 20-day moving average for last 4 or 5 sessions. So that's actually a positive sign. The number I have in mind is 620. Above that you could see some further momentum. While the pre-open right now is indicating we might open above that. Let's see where that settles and how the stock behaves once it opens. But above 120, the near-term trajectory could perhaps turn upwards. But as I said, given the whole setup, not a bad idea to consider perhaps taking some positions off the table or holding it with a trailing stop loss near the 620 mark. Just quickly, one other stock that I like in this space is JSW Steel. That's the one also that you might want to keep on your radar.
Thanks on that one. So 629 is what we're looking at right now. In fact, CLSA has maintained their outperform rating. They have a target price of 800 on Hindalco. What they've indicated is that the Meenakshi coal block that has come in with the 12 million ton capacity, that is something which is the key positive over here, and this could cater to 75% of Hindalco's coal requirement. However, the commentary with regards to costs, the hedging impact and the benefits of alumina sales, that is something that we should be watching out for as well during the conference call. But that's Hindalco for all of us that we should be looking at from here on. But moving from a Hindalco, let's just quickly take a view on a United Breweries as well. Clearly, Kush, what is your view in terms of a United Breweries? Because if you see in terms of the stock, it has been slightly on a correction spree. From here on, do you think it's hit the bottom and a good level to enter?
Not really. I mean, this entire space just before the budget had seen quite a bit of rally, maybe just right after the budget also. But then a lot of these names have fallen off the cliff from there on. While United Breweries is respecting the 50-day moving average and squarely trades above the 200-day moving average, the trajectory is not all that great right now. So I would be a little cautious. maybe somewhere close to the 1980 mark, if it does take support and, holds up. I think the opening also is indicating we might open somewhere close to those levels, but the 200-day moving average support comes close to that level. If it does hold above that, then from a medium-term perspective, you could buy. I don't think there's a V-shaped kind of a recovery or a reversal that you could expect in United Breweries at the moment.
Okay, on to the big brokerage call of the day, and we've got Jefferies that has maintained its buy rating and cut the target price, however, to 1,650 on a stock that we were focusing on earlier in the week, Entero Healthcare. And Harsh is joining in to tell you why that is. The stock is currently trading still significantly below that target price. Harsh, what are they saying?
Well, results, while growth clip was very good, is what Jefferies is suggesting. Slight bit of disappointment on the back of acquisitions getting delayed. Now, on acquisitions, and I'll complete that point, delays in acquisitions is largely procedural. There's no valuation mismatch per se or aggressive bidding that they're seeing. So it's simply a procedural delay which has caused some of these acquisitions to get pushed. And therefore, due to this, they will likely fall short of their revenue growth guidance of 35 to 40%. But despite this, very, very constructive, Jefferies, they are expecting Entero to continue to grow at a growth clip of 31% from FY24 to 27. They are expecting FY27 top line to be around 9,000 odd crore. You're expecting sharp EPS cuts, but Entero still remains one of the fastest growing companies, and therefore scale and improved product mix should drive 30 basis points of gross margin expansion, and therefore a double or a triple rather in terms of profit after tax to around 290 crore by FY27 is expected. ROCE by then should near around the 16% number, and they're reiterating a buy 25 times is what they're valuing this company at, giving it a 30% upside from here, despite the kind of numbers it's clocked. So, despite all the negatives with regard to the numbers and possible guidance for FY25 versus what they might have to revise in terms of estimates, they're still very, very bullish.
Keep an eye on ITC. Thanks so much, Harsh, for getting us those details. Let's see how that starts up in trade today. But keep an eye on ITC Hotels, and the reason being you have BAT, which is talking about reducing stake in the company. And what they're saying is that they will reduce their stake at the right moment, as per the Chief Executive Officer, who is Mr. T. Morocco. They're saying that they have no interest in being long-term shareholders of the hotel chain, and they're saying that the right moment will be decided when they get the maximum shareholder value. They will be divesting and using the proceeds for their own requirements by 2026. So there is a time frame that they have in mind as well, and certainly something to watch out for. Neeraj.
Yep. Well, some very interesting things to keep an eye out for sure. And 2 or 3 days, we've gotten a slew of very positive commentary on hotel companies as well. Rather not commentary, but brokerage notes that have come out as well. Fairly constructive on this being multi-year theme. I wonder, Pankaj Pandey, if we haven't answered this already, but if you had to bet on one hotel name from amongst the many that are listed now, it's a full-blown sector now. Which one would you bet and why?
So, Neeraj, although we like the entire sector, including ITC Hotel, where our fair price is about 195, I think what we are going to, or what I would probably suggest is Indian hotels with a target price of 984. I think the service quality of Taj, or the kind of vibe what you get in Taj, is unparalleled compared to others. Then the kind of properties what they hold, I think the kind of premiumization drive what they can do is fairly high. So from that perspective, I think Taj has already been sort of delivering good double-digit kind of a growth numbers. Next 4-5 years, they're confident of delivering double-digit kind of a growth, with 1/3 of the growth expected to be driven by asset-light segments. So I think from balance sheet-wise, growth-wise, I think Indian hotels definitely will be the top pick.
Okay. Indian hotels at the top, that's a 1 lakh crore market cap, by the way. And you add up everything else, it doesn't come to 1 lakh crores either, or maybe just about reaches there. So that's interesting. Indian Hotels is equal to everything else. But keep in mind that the net profit of Indian Hotels is higher than the profitability of all the other hotels put together. So maybe there is reason why Indian Hotels is trading where it is. It's expensive, but a lot of others are also fairly expensive. So bear that in mind. The pre-open rates have settled. We need to see what Hindalco is up to. We need to see what Godfrey Phillips is up to. A couple of names which came out with, well, a decent set of numbers, if you will. And then a clutch of names which came out with a fairly disappointing set of numbers. Deepak Nitrite out there, UBL out there, not the best of numbers. I think Nazara too, kind of disappointed, if you will, because the revenues were okay, but the margins took a bit of a hit. And Concord Bio is the other one, wherein the numbers seemed a bit iffy, if you will. Let's just see if the stock is reacting. Yes, indeed. On about Deepak Nitrite, sorry, I missed it. Can you just pull that one up as well? But they came out a disappointing set of numbers. Should be down 8% lower. Not surprised. Now, Kush, on the charts, these 2 or 3 names: Deepak Nitrite, Concord Bio, right? And let's throw in United Breweries, which is kind of holding out well for now.
So something like a Concord Biotech, that had a good run. If you see, it had a rising trend line support also. But I think with the kind of numbers that are coming out and the kind of opening that we are seeing, that could very well come into test. If 1950 or thereabouts is held, after opening, we're going to see a gap down. But if 1950 or thereabouts is held, then the stock would attempt, a recovery or a revival. But other than that, I would wait and watch to see what kind of exaggerated reaction comes. Deepak Nitrite has been falling for a while now. Every rise close to the 20-day moving average has been taken as an opportunity to sell. I don't think you should venture any kind of a trade into this just yet. So out on Deepak Nitrite, slightly constructive on Concord Biotech. Just let's see where it holds up.
I will just want to slip in a Senco. 14.5%, 15% down. Take a quick one, Kush, on a Senco.
I think you could very well, give this a miss. Something that looks interesting in this space is, something like a PN Gadgil or a Kalyan Jewellers after the kind of fall it has seen. But for Senco, a medium-term support actually comes in close to the 400 mark directly. So even if you're opening, about 14, 15 points or lower, that support is actually now taken out of the window. So wait and watch on Senco. Don't be in a hurry to buy, just yet.
Okay. Pankaj, what is your opinion on some of these jewelry companies? Because Senco stands out as a bad number. And in the context of what has been reported so far, largely we're talking about value-led growth rather than volume growth, and the pressure on studded or that studded is bringing comes into play as well. What's your opinion?
I think, so we are very selective in this jewelry space. Titan is obviously the top pick, largely coming from the perspective that if families are going more nuclear, then jewelry is a business of trust, and you really do not have a pan-India brand which would be sort of competing with Titan. What you have is more of regional brands, and which is where we feel that Titan sort of stands out. On top of it, I think the other segments, be it watches and or the eyewear businesses, sort of doing very well for Titan. What also happens is that when the gold prices inch up higher, obviously it does take out some sheen out of the overall volume growth. But our sense is that 2025, you'll have a lot more wedding season or marriage dates. That is going to obviously help. So I think Titan for us stands out. We are not looking to sort of chase most of these regional brands.
So that's with regards to Titan. Bajaj Finserv, Bajaj Finance, both the twins up in pre-open 2.5%, 3%. Kush, quick one on these two.
A good setup, a good move after a very long time. I think both of these are looking fairly constructive, on the charts. As far as Bajaj Finance goes, I think the recent high of 8,600, 8,700 will come into play again. Bajaj Finserv, I think, has a better risk-reward ratio to offer. So that's something that can be considered on the long side for targets of 1,900 and 1,950. I'm just rounding it off to 1,950. And the stop loss is at 1,800. So Bajaj Finserv over Bajaj Finance right now.
2.5% gains yesterday for both of these. The question only is, does this quiet start today give you a chance to add on to them or no? Kush Bora, 10 seconds, your top call, only a word.
Same.
Long, right? Oh, Kush Bora's top call is a long on Grasim. Bear that in mind. as we get you the opening this Friday morning. Are we seeing that 100-point uptick on the Nifty or not? Is the question. Well, not really. 67 points. You'll settle with that, but a quiet start. And, well, frankly, most people would have anticipated this. IT is doing okay. I wonder what is actually correcting. Maybe we should try and get that going very quickly. Mid caps and small caps, 0.5%. Yep, or thereabouts. Let's get the heat map up on the screen. I want to see what's correcting. Nothing dramatic, really. Maybe an HDFC Bank or otherwise. Yes, the Nifty actually pulls up because there are not too many losers. It's actually a very pleasant screen because we haven't seen this in a really long time. But it's not a bad screen at all. Hindalco, 1.7% starting off well. It's giving a bit of a fillip to the other metal names as well today. Tata Steel, JSW Steel in the green. Maybe something to do with the tariffs. IndusInd Bank and ICICI Bank. Remember, IndusInd Bank is a stock that is below its Feb 2020 lows and finding some bit of stability today. BEL, Coal India, M&M. So all over the place, really. No big gainers, no big losers. Adani Enterprises, the top loser. Dr. Reddy's, Apollo, Ultratech, but everything less than 1%. So the game is not in losers today, if anything in the gainers. And out there, metal standing out with Hindalco being the top draw for now. I reckon, Alex, you would have better luck at the broader end of the spectrum.
Yeah, Kush was talking about the color of love in the markets being green, and well, here you go. It's mostly green, and I guess you can also say that a good relationship is built on na tera na mera. So I guess to a certain extent you can say that that is also range bound, not too much in the way of losses and not spectacular gains either. But the broader markets looking more or less range bound, very small ranges at the start. Let's see if that changes over the course of the day. Let's talk about sectors as well, and let's pull that heat map up just to see where things go. Here too, mostly green on the screen. Metals understandably at the top of the list right there, gaining about 1.4%, and quite a few of those names up and about, led by Hindalco on the back of numbers, as we've already pointed out. Auto gaining about 0.5% or so. You have IT that is up and about, but not too much in the way of gainers. And in terms of losers, also very small losing, right? You have media that is at the bottom of the list, down only about 0.4%. But let me quickly take you through some of the stocks that we're focusing on at the start. And understandably, as we've been talking about the last hour or so, quite a few disappointments in trade. But let me start with the positives. You have KNR Constructions that, despite a positive set of numbers in the third quarter, is trading lower by about 2% or thereabouts. Maybe a finer look at the numbers is warranted. Godfrey Phillips, very clear upside here, 7.9%, nearly 8% gains on the back of a very strong Q3. SJVN is tepid, you can say, but it's still in the green at the start. Margins expanded more than expected, and the EBITDA was up as much as 26%. Let's look at the disappointments now, and there are quite a few of these. So let me start with the gold financer. Manappuram is down as much as 4%. Very disappointing set of numbers. Provisioning up in the quarter gone by, and the asset quality is actually worsened, which is something that is a bit of a concern for this company. Carborundum, again, disappointing set of numbers. It has missed estimates and it's down in trade. UPL is a bit of a surprise because it was a halving of the profits that took place. The margin has also contracted, but the street is looking at something in the numbers to say that perhaps it was not as bad as what was expected, or maybe it's looking through some of those numbers. Senco Gold is something that is dropping very substantially. We marked it at the start and it continues to be getting beaten down at the start today, 13% or so, and a very weak set of numbers. The profit has fallen as much as 70%, and that's why the street is looking at it so negatively. The PFC REC twins, let's pull those up. They're not doing too much, but there is a positive note that has come through from CLSA. It has negative note coming from CLSA. It has cut price targets on these two counters. Deepak Nitride is a clear disappointment. Let's pull that up. It's down about nearly 8% on the back of a weak performance. The profit has halved and it has also missed estimates. A couple more. Entero is what we talked about. Yesterday we spoke about it. Today we're speaking about it. It's down about 1% or more than 1%. Jefferies has cut its target. We brought you that brokerage call earlier in the day. Concord Biotech is something that is at the last. It's actually worsened. If you pull up the intraday chart, you will see that it's actually dropped more substantially, down over 10% at this point on account of a very weak Q3. Neeraj?
Actually, so that's very interesting. But, just before we get to our guest, Hiral, anything else that you're spotting at the broader end of the spectrum?
More than the broader end of the spectrum, I think the metals counter, Neeraj, are absolutely in focus, because if you see the index, yesterday closed higher as well. Today, if you see all the metal counters from an Hindalco to a JSW Steel to a Tata Steel, all of them that are trading in the positive. One key aspect that we're looking over here is with regards to the rising Chinese steel imports, right? That is something that the government probably is paying heed to, and there is a murmur that there could be some levy on steel imports from China in the next 6 to 8 months, right? So I think that is what is providing that fillip to metal counters. But probably we can just head across to Pankaj to take his view. Pankaj, very quickly, in terms of the metal names which are up in trade today, talking of a temporary levy on steel from China imports, what would you say?
So I think in metal, couple of things. One, I think the prospect of putting a safeguard duty has lowered the incremental imports into our country. So that has improved the pricing a bit. And our sense is that any kind of a safeguard duty, which is what we would expect probably this month, say for example, a 5% kind of a safeguard duty on a company like JSW Steel has the potential to sort of prop up their EBITDA by about 25%. So it's quite sensitive to that, and which is why we feel that as and when the clarity emerges in terms of the kind of tariff being put on China, I think India could be sort of taking a call there, and I think metal is going to be a clear beneficiary of the same, and which is why from a near to medium term perspective, we are quite bullish on metal as a pack.
Okay. All right. What would you say actually if I talk about some of these chemicals names, right? We've not specifically asked you, Pankaj, about that because Deepak Nitrite clearly getting punished in trade today. How do you view this? Because we've been speaking about this all of this week. If you're talking about chemicals as a play, you were anticipating and hoping, if you were an investor in this space, that the turnaround would come in the third quarter, if not in the fourth quarter, right? But now you're perhaps looking even further. How much patience would you need to have, Pankaj?
Absolutely. I think one needs to be very selective in chemicals. I think you can't really sort of put a very rosy picture, although we've seen the last 2-3 years, the prices have sort of consolidated for most of the players. So we are sort of very selectively positive in some names. So for example, Vinati Organics or some of these battery chemicals companies like say Gujarat Fluorochemicals or Neogen Chemicals. In general, we are yet to sort of develop that confidence that the prices have sort of stabilized and things are going to sort of turn up for the sector. Earlier the expectation was Q3, now it has sort of shifted to Q4. But we are still not very confident, and which is why advice is to sort of remain very selective.
Okay. What would you do? I don't think that we've addressed this, Kush, on the charts. Some of these names that have absolutely been beaten down in the chemical space, and we saw some earlier in the week as well. How do you trade these? If you've been stuck in this on the wrong side, on the wrong leg, how do you extricate yourself?
Once bitten, twice shy. I think that's been the story for the chemical space, not now. I think for the last year and a half, perhaps a little longer, while you've got these bouts, of relief rallies, what they end up being as, there hasn't been a meaningful uptick on some of these names. So if you're, in profit, not a bad idea to perhaps exit. If the loss is mild, again, not a bad idea to perhaps exit. As Pankaj was saying, remain very selective in some of these names. So one stock that we like in particular in the chemical space is Vishnu Chemicals. If you see, it had a good run, then dipped. It's made a good base, and now it's coming up. What is also very evident is the relative strength in this one. I wouldn't mind the kind of mild negative tick that it is showing today, but on the whole, up on the back of very good volumes over the last month and a half. So this is one stock that I have on my radar. Others, if you are in profits, not a bad idea to exit or at least keep a very strict stop loss and closer to the support zones for each individual stock. You might want to consider an exit.
Yep. I wonder if if you can pull up the, let's say, a 1 month chart for AMI Organics, because you can, if you think of chemical companies which came out with a very good set of numbers, AMI was right up there, and you can see after the peak, even that one has trudged lower. So no big shakes there. By the way, on trill or transformers and rectifiers, it's a case of a corporate activity, a bonus issue, which has led to this price of 427. What else is correcting? So yes, of course, amongst the larger names, Deepak Nitrite and Natco Pharma are the two top losers. In fact, Natco now overtakes Deepak Nitrite as the top loser on the BSE All Cap amongst the larger well-known names. But big gashes for Natco Pharma yet again.
Wow.
Pankaj, I wanted to ask this to you. So clearly, the generic Revlimid revenues going away is impacting companies. It's shown up in Natco now, right? And correct me if I'm wrong here. Could it show up in some of the others, even the larger ones like Reddy's? They may not be as impacted as maybe Natco was, but will it show up, and therefore would some of the Revlimid beneficiaries over the last 24 months become Revlimid casualties over the next 24 months?
So, Neeraj, I think if Natco's case is sort of specific because what we sort of understand is that there is a quota on a quarterly basis, and Natco had already sort of consumed that quota till Q2, and which is why there was no Revlimid sales in Q3. Q4 onwards, things are sort of going to sort of normalize. So I think this is a one-off case as we understand. So from that perspective, I wouldn't really subscribe to the view that things are going to sort of turn negative for most of these companies which are supplying Revlimid.
Are you a buyer, therefore, in Natco, Pankaj? It's down 30% now.
We would be.
You would be a buyer in Natco at the current prices. Okay. Fair point. So, well, by the way, guys, the other thing that is also happening within this chemical space is that there are some which are actually moving up today. Anupam Rasayan is up 7.5. There is Valiant Organics, which is up 7.5. If you put in GOCL within that bucket, that is having a strong move as well. Punjab Alkalis is up about 3%. So chemicals, crop protection, what have you. There are a few which are actually not doing that badly either. So keep that in mind.
So is this a play on agri-chemicals in a
But agri-chemicals to PI Industries didn't actually have a great quarter. So while everybody was saying that agrochem is looking like turning bottom, which is the problem, Alex, I think this quarter with chemicals, that almost everybody believed that this will be the largely turnaround quarter, if you will, which is what we started asking the 840 guest with as well. Somehow it's been very, very chalk and cheese, and more chalk, less cheese, if that makes sense.
Well, I understood what you have to say, so I'm pretty sure that everybody else did. But let's talk about one real disappointment today, and apologies if this is giving you whiplash, because we're shifting from chemicals to jewelry and gold. But let's talk about Senco Gold, and this is a very disappointing quarter. It was on my list. The stock is down 18% right now. It's really getting beaten down, and so understandably, because the margin contraction was very, very sharp. What has led to that margin contraction? Why has it deteriorated so quickly? And there's also going to be a miss on the guidance for the full year. To tell you about some of those numbers, Mahima is joining in. Mahima, stock reaction is very, very dramatic. What is the earnings picture looking like?
Right, Alex, as you rightly mentioned, in terms of EBITDA margins as well as net profit, it's been a disappointing quarter. Revenue, however, is up by about 27 odd percent, but EBITDA is down 56%. Margins have, slid down to 3.8% versus that of 11%. Now, if we remove the custom duty impact, margins stand around 5%, which is still below the normative range of around 6 to 8%. In terms of net profit, it's down by about 69 odd percent. Couple of things that have not worked this quarter. Well, lower EBITDA margins is due to lower studded ratio, high export sales as well as OPEX increase. Custom duty impact this quarter is around 48 odd crores. Cost of raw material has gone up by 10%. Changes in inventory and finished goods has seen a drastic impact, because in the previous quarters it was a negative number, and this particular quarter it has turned positive by about 200 plus odd crores. In terms of finance costs, it's gone up by 20%. This is because they have used the QIP proceeds to repay their overall short-term debt, which is why finance costs have gone up, and 9 months margin also is at 6%, which is lower than the guidance of 7 to 8%. In terms of the operational metrics, however, retail growth was at 19%, same-store sales growth at 16.4%, studded ratio stood at around 10.5%, value growth for gold was at 21%, diamond at 9% and 35% for silver. In terms of the hedge ratio, it was maintained at 80%. The company did raise a QIP this quarter of around 459 crore, which was used to repay the short-term debt and CC. They have also announced 1:2 stock split as on January 31st, 2025. And in terms of stores, last 9 stores, they launched around 12 showrooms, and they are on track to open another 8 to 10 new showrooms in Q4 FY25. So this is the overall view as to how Q3 has panned out for Senco Gold. It's a disappointing quarter for sure.
A disappointing quarter, and I think the inventory, Neeraj, is the key concern on this one, and I think that's where we will need to get clarity from the management as well. With regards to the finished goods inventory, that's an item which is giving you some bit of a reaction as well. But thank you, Pankaj, so much for joining us on the show and sharing your views overall as well. Thank you, Kush, as well, for the Valentine picks that you've given us and the viewers today. But moving on, you have the metal pack that is absolutely in focus, and one of the best times that we can get Aditya Velekar, metal analyst from Axis Securities. Aditya, good morning and welcome to the show. My first question coming to you is, first, before we get to the sector as a whole, how have you looked at the Hindalco numbers? The numbers look strong. The stock has cooled off slightly. Now, your view. I think
Hindalco numbers are quite good. The Indian operations EBITDA has stood impressive, and they have also bagged a 12 million ton Meenakshi coal mine, which gives them a raw material security vis-a-vis coal. So the upstream aluminium business for Hindalco is doing quite well, and this time also, in this quarter also, their aluminium and copper, both these divisions in India, they have perform very well, offsetting the negative impact of on EBITDA of Novelis. So it's better than on EBITDA, overall EBITDA numbers. There is a 3% beat as on the consensus. So good set of numbers, resilient performance by Hindalco.
Aditya, just before we talk about the space at large and what Q3 has been like, this whole chatter around tariffs, the resultant reciprocal tariffs, what China might do in terms of its stimulus and the impact that it has on commodity prices and thereby resultant fortunes of metal names. There's just too much happening in your space. So I'm glad. I don't envy that I'm not a metal analyst. My question to you is really this. What is your initial reaction right now to all that has happened thus far? And what is the kind of investment case or the lack of it does that create for the Indian metal universe?
Yeah, absolutely. You are absolutely correct that the space is going through a lot of news flow. And in last 6 months, the space has also absorbed a lot of negative news flow coming from China. So if we divide the world in 2 parts, the number one is China, where the CPI and PPI data is still not very encouraging. It's in the negative zone, which indicates a lot of excess capacity. And that is also reflected in the higher steel exports coming out of China. In 24, their steel exports stood almost at 111 million tons, which is up 20%. And that is what is impacting the HRC prices. So that is number one. And number two, now the lot of news flow coming out of US, which is putting a lot of disruption, and market is still yet to find out how to react to all these trade tariffs and disruptions. It will surely disrupt the supply chains. As of now, what we can say is that all these tariff talks will put the premium within the US for all these metals higher. So for aluminium, it will increase the premium over the benchmark LME, that is Midwest Aluminium Premium. The HRC prices, that is steel prices in US, they will trade at a higher level than the ex-US market. And the major suppliers of aluminium to US, like Canada, they will push the metal to some other regions, especially to Europe. So that will also have some impact on the LME prices. So all these things need a careful monitoring. And as you said, there's a lot of news flows and a lot of complexity is happening. But what I can see is that the prices, the Indian metal stocks, prices are almost resilient, and they have, although the valuations are not as low as to the historical averages, but they are still palatable now. And overall, the sector is now, it seems that it is looking for some kind of trigger, like, for example, a safeguard duty of 25% or some stimulus package from China. And if any positive news comes, the stocks will just jump from here. So that is our view.
So Aditya, if once you see a trigger point, what would your top picks be? Because you're saying valuations are not really at the bottom yet. Where would you bottom fish now?
So we will look at stocks which have a good balance sheet strength and which have managed their leverage in a proper manner, and where we see that the price to book are not very demanding. So if you divide the metal space in two parts, steel and non-ferrous, our preference is towards non-ferrous to companies like Hindalco, Nalco, and Vedanta. So all these companies have one advantage, that the LME aluminum prices have stood quite resilient. Even after all this news flow, the aluminum prices are trading in the range of $2,600 per ton. And these companies all have expansion plans going ahead. Vedanta is undergoing a lot of deleveraging, and in last 2 to 3 years, they have deleveraged their parent company debt, and their expansion projects will fructify in coming years. Same for Hindalco. Their Indian operations are doing quite well, and they have quite a list of expansion projects which will fructify over a period of time, but still it's a good stock. For Nalco also, the alumina exposure gives it a good position, and the fifth stream of refinery at Nalco will also go for an expansion, so that will have additional volumes coming from alumina. So all these three stocks we prefer. In the steel name, we definitely avoid names like Steel Authority, and because the leverage and the capex execution capability of these companies in the past were not very good. So if the safeguard duty of 25%, if the government announces that, it will be beneficial for all the steel names, but we will stick to companies like JSPL, JSW, and then Tata Steel.
Okay, so the pecking order, sorry, I'm just getting this straight, Aditya, the pecking order is JSPL, then JSW, and then Tata Steel in the steel space.
Yes.
But sorry, I did hear you speak about some of the non-ferrous names as well. So if you combine the bucket, let's say if a client were to ask you that I'm indifferent between ferrous, non-ferrous, etc., and the whole universe, what would be the top 2 or 3 as per the pecking order? Then is there a list that you put out that way in your reports?
Yes, if you want to pick it, then definitely non-ferrous will be first. So
Okay.
we will go with maybe there is a kind of a competition between Hindalco and Vedanta. Then we will go with Nalco, and then JSPL and JSW still.
Got it. Now, Aditya, I have one final question because I did hear you say in your answer that there are multiple things happening and there could be one key trigger that the sector is waiting for. Now, if I were to ask you what would be the first amongst equals in terms of triggers, because there are maybe 3 or 4 things out there, what would be the most important thing that you would watch out for, which if it happens would probably outweigh a lot of other things that might be existing at that point of time? The key trigger.
Exactly. So the point is, as I said, the valuations are palatable, but the growth triggers are lacking.
Right.
So the growth trigger which we are looking for is any stimulus from China. That is because China is the largest consumer of metals. So that is the number one. Second, if we see some stability of all this news flow coming out of US, the brinkmanship of Donald Trump and how he puts the tariffs and all, the dollar, if it stabilizes, then that will also be an overall better trigger for commodity space in general, because strengthened dollar definitely is not, it is putting a lot of volatility in the sector. So we are looking that the things should settle down whenever and the sector has navigated well through all these complex news flows. And once they settle out, it definitely offers as a springboard for the sector to rise. So these two major events, I'll say.
Got it. Okay. Well, we'll leave it at that. Thank you so much, Aditya. Really appreciate your time this morning. That's Axis Securities' view on metals, a space that is firm and center in terms of conversation. Now, what we'll try to what we are trying to do next is try and tell you about this whole trade piece, nail it down to specific pockets of stocks as well, and the broader view around numbers or where India is relative to the rest of the world. Let's start off micro this time and then go on to the larger picture. So first, between Somit and Mihika, who join me right now, let me first go to Mihika to talk about the stocks that are exporters or large exporters to the US and might be getting impacted right now, sentimentally as it may be. Mihika.
Yeah, we are seeing some negative bias on the stocks that have exposure to the US in terms of their revenue. There are caveats on whether they are actually manufacturing, then lots of ifs, but they are trading in the red. In this pharma space, you have companies like Dr. Reddy, Lupin, Sun Pharma, Cipla and Torrent Pharma that have US exposure. As per FY24 revenues, you have Dr. Reddy with the highest exposure at 46%, followed by Lupin at 37% and a Sun Pharma at 32%. The next sector that is in focus is the auto ancillary space. You have Sona BLW with the highest exposure to the North America region at 40% as of FY24. Samvardhana Motherson's 18% revenues in FY24 came from the North America region, and for Sansera Engineering, direct 10% from the US in FY24. In the forging space, you have something like a Bharat Forge, which has 25% exposure to the US in terms of revenue, and a Ramkrishna Forging, which has a 58% exposure to the North America region. Then you have the tire space. You have something like a Balkrishna Industries that has a direct 16% exposure to the US as of FY24 in terms of revenue. In the capital goods sector, you have something like a Shilza Tech, which has a 21% exposure to the North America region. In engineering, you have Tega Industries, which is actually seeing cuts of 2% today. It has a 15% exposure to the North America region. And lastly, you have Worry Energies. 50% of their FY24 revenues came from the US, and that's a large growth market for them, but they are building capacities there. Lastly, in the textile space, companies that have significant exposure or do send textile to the US is an Arvind, you have a Wellspin Living, you have a Trident, Alok Industries, Raymond, and lastly Gogoldas Exports. And I also want to mention that the US also imports 5 major molecules from India. The little complicated names, but there are 3 industries that 3 companies that make these molecules, and that's a PI Industries, UPL, and a Jubilant Ingredient.
Thanks, Mika, for getting us these numbers. But clearly, one thing that we need to note over here is that though all of these companies have an exposure to the US, not everything for all of them will be exported from India. So that breakup is something that which we will not have right now as to how much is exported from India or how much is exported from other countries where these companies would have had presence. But interestingly, all of them are seeing some bit of pressure in today's session. But as Neeraj mentioned, moving from the micro side to the macro part of it in terms of the tariff differentials that we are seeing, the impact that we could have of the reciprocal tariffs on India. Let's head across to Somit. Somit, clearly, how badly could US reciprocal tariffs hurt India? Because you are looking at the kind of trade deficits that we are sitting with on various sectors.
Well, yes, if you look at the India-US trade, US accounts for nearly 17.7% of India's goods total export. But when you compare it with other Asian economies, we are not that high. When you look at China's total trade surplus to US, it stands at around $295 billion, followed by Euro region, which stands at close to $267 billion. Then there is Mexico, Vietnam, Taiwan, which is anywhere in the range of around $74 to $172 million. But when it comes to India, it is just $46 million as compared to that of Korea, Japan, and Canada, which stands at anywhere between $64 to $69 million. Now, if you look at the key commodities that are being exported more from India to US as compared to US to India, these are the key commodities where these are the key commodities that India exports more to US. Electrical machineries, the trade deficit stands at around $11.8 billion, followed by pharma products, similar amount of trade deficit. Then there is pearls and precious stones, nuclear reactors, textile, where the trade deficit is anywhere between 3 to $6.3 billion, followed by products like multiple apparel and textile products, iron and steel products, organic chemical and vehicle, which are anywhere between 2.2 to 2.4 billion US dollars. So these are the key commodities where there could be a chance of trade, a higher tariff coming in, given the fact that India is exporting more of these products to US. Now also let's look on the flip side, which are the products that we import more from the US market. Firstly, it's minerals and fuel. The total trade surplus stands at around 9.6 billion US dollars. Most of this would be towards gas, LNG as well. Then there is aerospace, which is around 2.7 billion, optical parts, edible food, fruits, pulp food. Not much of these products are coming in from the US to India. On the other side, if you look at, then there is chemical products, beverages and spirits, iron and steel, plastic, cotton, but the contribution of these products are not that higher. Now, if you look at the total excess tariff that India charges, in fact, that is the highest, around 8.5%, the second highest that we are seeing in the Asian countries. South Korea's total weighted average tariff stands at around 14.4% on goods that are imported from US, while that of India stands at around 8.5%. China has a lower rate of around 7.1%, Thailand 6.2%, Mexico 5.2%. As against this, US is charging a weighted average tariff of just 3%. So a clear differential of 5.5 percentage points is what we are seeing between the tariffs charged by India and tariffs charged by US. Now let's look at the products in which the differential of tariffs is the highest. Firstly is the animal products, where the tariff differential is nearly 30.2%, which means that India is charging this much percentage points higher than what US is charging on animal products. Vegetable products 20.5%, food products 35.6%, footwear 17.2%, textile 15.6%, and this would be the important sector because a lot of companies from India export various types of textiles and garments to the US market. Followed by there are many other products like transportation, chemicals, also one of the important products are stones and glass and minerals, and the tariff differential for these products stands anywhere between 8.6 to 14.4 percentage points.
Right. Thanks, Amit, for getting us these details. So interesting moves that we're seeing in terms of markets as well overall. Let's just first quickly pull up Nifty 50 and do a quick check. There you go. From the day's highs, you're seeing some bit of mild moves coming in. We are pretty much going towards that 23,000 mark, and to be noted, that's going to be an interesting support we should be watching out for. 49,350 is where Bank Nifty is trading at as well. And if you see in terms of the advanced decline ratio on Nifty 50, it is absolutely 50-50 right now. What's leading is the HUL and ITC, Tata Consumer, Nestle and Britannia. So it's the consumption pack which is hogging the limelight right now. Top 5 gainers on Nifty 50 coming in from the FMCG space. On the losing end, you have Adani Enterprises, Sports, Hospital, Apollo Hospitals, Dr. Reddy's and Sun Pharma, which are losing out in trade. And let's just quickly pull up the broader markets as well, the mid cap and the small cap index, and see if the performance is pretty much in line with what the benchmarks are doing. You can have the mid cap and the small cap index. There you go. I think, Neeraj, clearly if you see, there is that cooling off that's happening in terms of markets right now. 23,000 is what we're tracking on Nifty. I think if we break 23,000, I think there could be some pressure that could build in the second half then.
Yeah, I mean, just the point that every rise is being met with a sell, and therefore that is the bit of an issue. And this is despite fairly reasonable numbers that have come in from one of the heavyweight sectors, or in fact the biggest heavyweight sector, and that is BFSI. In fact, let's talk about that for a moment and try and understand if there is support out there. What are client conversations like as well? It will be important because Mona Khetan, who is Director of Research of BFSI Daulat Capital, would be talking to all their clients and trying to understand from them as well about what is their feedback. Mona, good having you. Thanks for taking the time out. Let's just sum up the quarter though, just for argument's sake, because one couldn't find too many faults per se, right, in the kind of numbers and the commentary that some of the large names have given.
I think the numbers were, better than expected, primarily on the credit cost front. Growth has slowed down that a little, but that was in line with expectations. So, from a quarter perspective, there was nothing majorly negative as to speak. In fact, we were worried about some spillover happening from unsecured to secured portfolios, which is not pretty evident as of now, which will be taken as a positive. But nonetheless, I think a lot of the sell-off, more so in BFSI, probably is also because the sector is very FII heavy, and that's where a lot of selling is happening. So yeah, to that extent, given a good quarter and given the correction, the overall space does look fairly attractive today.
Mona, what is the conversation that, or what's the, I'm guessing your comments to your clients is to go out and invest into these names because of all the factors that you mentioned. You might be getting a pushback from clients, right? What is the pushback? Why is it that, is it just that the nature of the sector is so heavy that domestic flows alone can't do it? And if you talk to global clients, what is it that their pushback is with regards to BFSI in India?
So, see, if you look at banks, most banks have somewhere in the range of 30 to 50% kind of exposure to repo-linked loans. And to that extent, these loans will get repriced very quickly. There is likely to be pressure on margin to that extent. Secondly, there are challenges on deposits. So, the sector is undergoing some headwinds. However, these were largely built in the expectations as well.
Mona, talking about the Karnataka MFI ordinance as well, what is the kind of impact that you're looking at? Do you think elections will get impacted in the state? And if so, do you think Karnataka becomes a no-go zone for microfinance lenders, or are you seeing that to be pretty much settled?
No, I think it will not be a no-go zone. Lenders will be a little cautious, and they'll have to sort of stop the reliance on external parties for collections. They have to completely do the collections in-house, given that banks and NBFCs are allowed to operate, but probably not others, right? So I guess to that extent, the OPEX may increase a little bit on the state in the state, but otherwise, and to that extent, there may be some caution, but otherwise, things should settle down, over time.
So, and Mona, so then let's talk about stock-specific action. Clearly, the embargo easing coming in for a Kotak Mahindra Bank. What would it mean, and where do you see it from here on?
Yeah, so embargo easing will result in them being able to issue credit cards and also onboard customers via online and mobile banking facilities. These will be positive for the bank, both from a yield perspective as well as small ticket deposit perspective. And from a medium term perspective, the overall development is positive both for growth as well as yields. So they should be able to better manage their margin amidst ongoing pressures from the repo cut.
Okay, Mona, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us that feedback. And it's interesting. I mean, I think the point out there that it's such a heavyweight sector that the selling from FIs outweighs all the positives that might be there. Okay, well, as we hit that break though, it's important to consistently take cognizance of what some of the biggest market voices are and have been saying. And this week has been nothing short of exceptional in terms of the voices that we've gotten for you on NDTV Profit. So with this ongoing correction, let's hear out from Sandeep Tandon of Quant MF, Sunil Singhania of Abacus Asset Managers, whether this is a good time to invest, whether through SIPs or lump sum. Let's hear out what they had to say.
Anytime is a good time, but what we have to understand is every investor has to assess their risk appetite and their investment horizon. And that is very important. I always say at the peak of the cycle, risk appetite is highest. At the peak of the cycle, everybody has 10 years and long-term investment horizon. What you have to assess, go back on the drawing board and see how you reacted in 2000, what you did in 2007-8, what you did in 2018, what you did in COVID period 2020, And that's the way you assess. Forget any risk management tool or forget any wealth management advisory or your own perspective. Just you as an individual sit down, how you reacted, you will get a fair, good answer. What is your risk appetite? What is your investment horizon? Once you assess or reassess that, and somebody comes and tell me that I have 5-10 year investment horizon, I will still say, go and deploy money in small cap. SIP is good for you. But somebody comes and tell me horizon is only 1 year, 6 months, 15 months, or 2 years, then I'll say you go for flexi cap or multi-asset fund or hybrid schemes fund, which is relatively low risk, and you can handle that.
I think December numbers have been slightly better than September, and at least the indications for the current quarter, both on the economy side as well as corporate growth, seems to be, a little bit of reassuring. So in this kind of a scenario, as has been our experience in the past, it is best to just stay put, don't do anything, don't get swayed by short-term bounces and go overboard. Don't get scared by what is happening and sell at the wrong time. I think it is best to leave the markets on its own for the next maybe 6-7 days. Take a very, very measured and patient view and move forward. However, having said that, I think the indications which are coming from yesterday and today, and at least as far as my experience is concerned, of seeing these kind of markets, I'm starting to get a feeling that capitulation is very close, and this will, at least slow down or end pretty fast. The Nifty has not fallen because there are quite a few stocks in the Nifty, like Asian Paints, Hindustan Lever, Nestle, Reliance, maybe an HDFC Bank and ICICI Bank. Except maybe one like ICICI Bank, almost all these companies have done nothing for the last 3-4 years in terms of price performance. And therefore, in this year, they did not fall also because they had not moved up. And therefore, the Nifty to that extent has been very resilient because, 50-60% of the constituents who had not risen at all last 3-4 years have not fallen this 1 month. You can't say that Nifty has done very, very well. You have not invested for 1 month or 1.5 months. Having said that, I think you are right that there are quite a few stocks in the mid and small caps, which are new age companies which don't have profitability or low profit, and which had a lot of hope built in, and the price went up 3-4x, and maybe all the IPOs which came in are a part of the mid or small cap indices, and they came at significantly higher valuations because of all the huge promises which were made during the IPO process, and they have also fallen. So in the mid and small cap, you will have to be more stock specific. For example, we invest only in profit making companies. So for us, these companies don't exist. But from an investor perspective, I don't think the indices are going to give you the best sort of conclusion. Because a small cap index might comprise of 300-400 companies. Some of them might not have profits at all, and therefore the P multiple also gets a little bit of it's not the fair estimation, because the P looks like 30, but there are maybe 20-25% companies which are in losses, which sort of complicate the whole process. So mid and small cap is more about stock specific. Having said that, I would still advise, being a proponent of mid and small cap all my life, I would still advise at this point of time to have a balanced approach, because this choppiness might continue for some time. We are looking at market stabilizing, but we don't see a V-shaped recovery. At best, it would be an upward moving W-shaped recovery.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Welcome back to India Market Open. One sector that we're talking about that could probably see an impact in terms of the tariff war. We have auto as a space that we've been watching out for. Tushar is standing by to get us more. Tushar, what is insulated and what is not?
So essentially here, OEMs or the original equipment manufacturers are seen largely insulated by the reciprocal tariffs announced by Donald Trump. But some auto component makers may get impacted, especially those who supply to American car makers. So the companies that may be impacted on the OEM side, some impact may be seen by Royal Enfield, which actually exports the 650cc line of motorcycles to the US. Remember, its entire 650cc line is directed towards the large motorcycle markets of the US as well as Europe. Among the auto auxiliaries, Sansera, Suprajit, Balkrishna Industries, Sona Comstar, as well as Motherson Sumi can see some impact. But analysts tell us that these companies have already started sidestepping the tariffs by working on some workarounds by routing these particular exports from other countries where they may have manufacturing facilities. Say for example, a manufacturing facility in Morocco in Africa. Some Indian auto component makers already have plants in the US, like Sona Comstar as well as Motherson Sumi. So essentially they are insulated from such impacts. So there's a positive news also for the auto auxiliaries. Remember, India is the only alternative to the US against China as far as manufacturing is concerned. India's automaker supplies to all car makers, American car makers, including Tesla and Ford. And any hike in tariffs on these auto components that go into the US will make American cars even more expensive. That's again when the sales slow down in America at this point of time as far as passenger vehicles are concerned. Remember, India is still a preferred partner of the US as compared to China. So things may just work in the favor of our country, so to speak.
Okay, thanks a lot for that, Tushar. We've analyzed a lot of these things in-house. Now let's try and understand what does an expert voice think of the same. And of course, the current market situation. In line with getting some of the biggest market voices all through this week, we have one more. Prateek Agrawal, MD and CEO of Motilal Oswal Asset Management, joins us right now on the show. Prateek, thank you so much for taking the time out and being with us. Really appreciate your time. At the outset, Prateek, we want to spend some time on this big development or a big meet that happened between Prime Minister Modi and US President Donald Trump, right? The initial takeaways seem to be placid, maybe even mildly positive. What have you made of the impact of all that's happened around tariff wars and the meet between the two head honchos?
Frankly, talking of it, personal point of view, I've been very positive. See, one has to realize that America can't make everything on its own, because while they may have a lot of land and they may have all the best technology of the world and all the best raw materials of the world, they don't have people. Okay, and we are seeing them send out people rather than get in people, which means this lot of this is posturing, to my mind. Now, posturing is against China because that is a country which is probably competing neck to neck with them on another scale actually. So one, there can be a revenue thought that let's levy duties. We have to import anyways. We get some money in. That money will be good to save taxes. The other bit of promises, I'll bring down personal taxes, I'll bring down corporate taxes. So, it helps support that. But here, if the main competitor is another country, more would be levied against that country, and others would get a better access to the US, which frankly others should be celebrating and not be worried about. I think what is happening just now is that because of the uncertainty, we are seeing people park monies back in the safe asset. So your DXY from 100, 500, 6 has moved to 110. Maybe it's coming down a bit because the risk aversion is so high. If it drops, I think a lot of it is actually pretty good, positive for us. My sense is budget was on the margin good for consumption. I think the outcome of India, US would be very positive for Make in India kind of initiative. So we have a lot to look forward to. Now the other thing is we as an economy is very diversified. So if somebody levies a tax on all, let's say, base metal imports, okay, it means manufacturing in the US of the use case of that metal will become more expensive. So you increase duties on aluminum, cables get more expensive, and so on. So which then gives a leeway to Indian producers of those commodities to export more. It's just that let it settle. My thought still is it's going to be positive, not negative, because the base case is the focus is somewhere else, okay, which would mean that everybody else should get a better access to the largest market in the world, which should benefit us.
Right. Pratik, an interesting point that you made with regards to it benefiting us, because clearly I was just looking at India's trade surplus with the US. It's the lowest compared with other Asian peers, right? We're sitting at around $46 billion.
Yeah, absolutely.
Right. And if you talk about the weighted average tariff rate as well, imposed on US imports by India is 8.5% versus, tariff rate imposed by US is around 3%. Now, if you have to take both of these into consideration and do the math, which sectors then do you think will be key beneficiaries? Because it's clearly China, which is sitting at the top at $295 billion, followed by Mexico, Vietnam, Taiwan. So where would you put your bets if you have to play this now?
No, so when there is uncertainty, see, just look at it. You are an industrialist, okay? You're trying to put up a plant. Now, earlier, people would put up a plant in this part of the world targeting another country, say the US, because here, let's say, labor is cheap. Okay, now this activity would be fraught with risk. There is uncertainty in the air. Now the new thing would be to put a plant in a country which can satisfy, let's say, 60-70% of the overall capacity, and you are searching for a market for the rest of 15-20%. Right? Indians do that. And hence, for an Indian entrepreneur mindset, this is very good. Rest in the, let's say, the ASEAN, where domestic markets may not be so large and export is a large activity, have more to worry versus an Indian entrepreneur who is putting capacities in India, basically targeting Indian markets and looking at others for some small surpluses. This is exactly what we want. You should actually, instead of speaking to us, you should speak to a variety of industrialists. Do they sense the opportunity or not? I would believe they are all excited. That excitement should come to the channels, to the public. It's not negative.
Noted. Okay. So in light of that, Prateek, then, how are you guys thinking of the market texture currently? I mean, earnings, the way they have turned up, you can argue that the Nifty earnings with that 7% growth isn't top quartile in terms of expectations. Forget the delivery, right? So 9 months now, we haven't had a great year. Does this year pass off with 3% and do expectations move to FY26? And are those reliable at 15%, or do you think they'll be scaled down?
No, so when you start a year with a lot of assumptions. Now we have the benefit of the budget, so we know, revenue side is assumptions as it would happen over the years. The expenditure side is probably more cast in stone and would happen. There, very clearly, the government expects the private sector to take up the baton for capex. Now that remains to be seen. So, point is, overall, when there is fiscal consolidation, private sector has to come up and take the slack, else there would be some slowdown versus expectation. So that is the thought. In that context, maybe the 14-15% earning uptick that people are talking of has less chances of being realized. But one has to caveat it. A lot of that increase is on account of reversal in commodities. Commodities had a tough year. On that base, maybe they have a better year next year. But that number can keep being very, very volatile. Now, this is as far as the legacy businesses are concerned, which is what the index is today. Today, as we speak, is one time in history when there is a sizable part of the economy which is not there in the index and doing very well. I keep saying this, just like software emerged as a strong industry in the 90s and continued to grow for a very long time. Just look at the number of industries which have happened over the last 5 years. It could be renewables, it could be hospitals, it could be, capital market plays, etc., 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 where, the earnings growth in this quarter, the last quarter, expectation for next quarter, expectation for next year is an order higher than that of the indices itself, which people keep focusing on. And if one follows the thought that market follows earning growth over a period of time, these are the spaces to focus on. This is where the growth lies, and not for 1 quarter, 2 quarter, but for a few years.
Okay. So selectively constructive, Prateek, would that be the way to assess how you are thinking about the market currently? Very, very bottom up. Very, very specific, maybe not even sectorally.
If I have to broad brush it a bit, I would say focusing more on newer spaces, which have been brought to the market over last 4-5 years versus the old legacy spaces.
Okay, and does that therefore, Prateek, just wondering, the overarching consensus on markets currently is that BFSI and large banks arguably look the safest bet earnings, valuation combined, but that's as old can get. So I'm not saying you're excluding all of old, but I'm still trying to think that would you be relatively underweight large banks versus the weightage on the index?
No, we are. We have been that way for a long while. We have said that whatever is happening is positive banks, is positive large IT, but then both of these spaces will deliver earnings just about indices or lower. We are a growth-focused house in terms of our investing philosophies. We typically should not be expected to be in spaces where growth in earnings is going to be index or lower. We should be expected to be in spaces where growth in earnings is expected to be significantly higher than that of the index for, let's say 2 to 3 year time period. So yes, short answer is we are underweight all of these spaces by quite a bit.
Okay, so significantly underweight with regards to BFSI. The other space, Prateek, that you have been staying away from or probably have got down your exposure is with regards to government capex-driven sectors, right? From there, we've moved in the budget to consumption with that 1 lakh crore number that would be in the hands of the consumers. How would you look at consumption growth versus value if you have to look at that aspect?
Sure. So, government capex driven sector. So we had some small exposure to railway space. We don't have that anymore. As far as consumption goes, luxury consumption is something that has been a theme that the managers have been following. We continue to be positive there. So unorganized to organized shifts in consumption on the retail side, let's say. Luxury is something that we like. We don't like staples because we think that's a very saturated market. We like durables, luxury, let's say hotels, jewelry, travel kind of stuff, and unorganized to organized, so retailers.
Okay. Okay, this is interesting because the guest who's joining in, and Prateek, if you have time, I'd love for you to stay a bit longer because I want to get in Manish Dangi in this conversation and have the conversation with two of you together, simply because Manish in a post yesterday has mentioned that he believed that by and large, while US and China were to fight this out, and Prateek made this point that the problem would be for some of those countries, Manish believed that US and China would be the least impacted. A lot of others might get impacted. And therefore, it will be a nice kind of mix of conversation happening here. Now, Manish Dangi joins in as well. Manish, good having you. And I requested Prateek Agarwal to stay on for a bit longer as we do this conversation with both of you. You made this very interesting point yesterday on your LinkedIn, right, Manish, that when the two elephants will fight, they might be the least impacted. A lot of others will get impacted a lot more. Did I get that correct? And would India be amongst the ones which, to your mind, will get impacted a lot?
Hi, Neeraj. So it's sort of true, right? These two big elephants fighting with each other, both of them are relatively much more local economies, independent, mostly source of maybe tech and production and everything else to the rest of the world. So the impact on them would be much lesser, even though, very, very paradoxically, US's entire play is actually to hurt China the most. And China would be least hurt, and of course, US would be sort of much less hurt, given the hegemonic power that they have. It is true that most other countries will be majorly affected because this, as a side, what will happen, of course, is that if US were to sort of import less, or because of higher tariffs, a lot of Chinese products would then be sold in the market and dumped rather. So to that extent, there could be a lot more effect on our economies. The only saving grace is that India also is relatively local economy. Its import-export as a percentage of GDP is not as much as what you will see in East Asia and Europe, and to that extent, somewhat muted impact of India. That's the only saving grace. But I think the primary sort of point is you sort of summarized well that yes, US and China would be least affected. US's total growth impact of the oil tariffs, Neeraj, is likely to be not more than 0.5%. And it's a super strong economy right now. It can afford to do all of this.
Right. Right. So Manish, when you mentioned about, how US and China will be least affected, if you have to look at the impact in terms of India, right? How are you seeing a differential between Trump 2.0 versus Trump 1.0? Is this something which will see a higher impact, or it's just a neutral, no game changer?
No, India, every other country, see, it's a zero-sum game, and in fact, it's a lose-lose game. So, to state that any country would be better off because of this really can't make out. In long run, perhaps, I think both US and China would be sort of well off because of this. But right now, everyone loses. US and China lose less. India certainly loses. So it's not a good outcome for us that these two elephants are fighting. Trump 2.0 is certainly more ideological, certainly more powerful, and certainly much more motivated. Look at the way he's trying to burn the whole bureaucracy down. In last 15, 20 days, what he's been able to achieve. To a certain extent, a lot of us voted for Modi, thinking that something similar would play out, in India as well. So, but big picture, it is pretty bad for the world growth, I think. And I don't think he is in any mood right now. And it's not about individual. I think from a US's attempt to preserve its hegemony, it is one of the last two left to create these unnerving moves for rest of the world, and force the world to actually come to settle with their terms. Look at the point that he made with respect to BRICS yesterday also, that if you go towards making BRICS currency or any such things, we will impose 100% tariff, and we don't just care. You need us. We don't need you. So that at the surface, superficial level looks like a very, very arrogant country. But it's basically that's the way the realistic, war games, geopolitical games are played. And Trump is, after a very, very long time, is playing that same game again because it's in the need of it. Today China has the momentum that it's not a sort of fair chance that China would surpass US in 10, 20 years in every single matter. And US wants to preserve that, and tariff is one such way of actually doing what it wanted to achieve for itself.
So, Pratik, come in. On you just heard Manish mention this as well, right? The question that comes to the optimist's mind, if you will, is that if the US is fighting that battle against China predominantly, right? And I believe that's a bit of an open secret here. It would much rather have the second strongest emerging economy out of Asia as an ally as opposed to a foe. And could that therefore be that in rhetoric, it will be equal for everybody, but, and we know the kind of, if I can use a lack of a better term, a bonhomie between Trump and Modi, that equations might be slightly better for India. So Manish is right that everybody else will hurt. Could India hurt less? And would that be taken constructively by risk assets like equities in India?
No, so agree with him on many points. So if tariffs are imposed and stuff gets expensive in the US, overall demand in the US should be expected to fall, which is not good for global growth. But at the same time, one has to understand that US is living way beyond its means anyways. So I see tariffs also as a tool to get in some money. Now, if there is a war, well, in war, there are allies, there are foes. If you think that, people are going to slug it out, they would want friends who would do some bit of it on their side. So we could be, the people who is wooed by both sides. And that can be a very happy situation. So if you see the past few months and the developments all around, we really are in a position where people are trying to have us on their side, and that can be pretty positive. I think the negative, but that said, win for India would be, significant gain in market share in the US. Only after that, we will gain, in spite of a slowdown that will be there because of increased duties and inflation and so on. So
Point well
it's
noted.
not a straight line, this thing. But
Got
I'm
it.
very hopeful we win. Any country who allies with the US does very well or has done very well, at least in the initial 8-10 years. After that, things can change. But the first 8-10 years are usually nice.
Manish, how would you respond to that? I mean, and again, I mean, it's kind of weaves in with what I was trying to ask. That in some sense, India is not coming out here as a non-ally. If anything, it's India is coming out as an ally of the US. Will it still hurt bad?
See, the US is actually behaving like a mercantilist nation. To think of US, see what they did to the fairness scream came to what you call Canada and Mexico first. You couldn't really imagine something what he did to both the countries, and it's sort of likely that something similar would happen to Europe as well. It's a very very mercantilist sort of a viewpoint that that the trade is zero sum. So you could think of US being an ally in defense and such things. This is an independent policy that and he announced reciprocal tariffs yesterday. So and in the press meet also when Modi was there, he said we are being fair. Whatever you impose, we'll impose equally to you. And sort of at the face of it, US has been sort of quote unquote ideological buffoon in last, since 1990 to have been practicing this laissez-faire that anyone can come and dump anything. And therefore, that has hollowed out US manufacturing in last 30-40 years. And of course, China has won majorly because of those policies. And so Trump is being extremely realist and simply unwinding the so-called these ideological liberal policies. And I don't think there is a case of being ally or non-ally here. Everything is a trade, and we ought to give. And we actually export a large amount. We run a $45-50 billion of trade surplus. He wants you to sort of now. Can you buy more defense? The Modi ji said yes. Can you buy more food? That will hurt our farmers, but we have no other option. And something similar will happen to a lot of Harley Davidson to a certain case is coming to you most likely cheaper sooner than later. So it is, as I said, in geopolitics, there are no friends, Chief. And my sense is that, yes, friends to the extent that if there could be a bipolarity and, US and China were to fight and, someone were to insist that either you are with me or against me, I think we will stand with US. But that's it. Beyond that, nothing much. As far as markets and economics are concerned, these are turbulent times. And I think, as I said, to repeat, that everyone is worse off in this. Least worse off are China and US. I think India is one of the better ones not because we are allied, but just because we just don't trade much with the world.
Okay.
And that's why we are okay.
Okay. Well, so let's see if cheap Harley Davidsons come in, and if you or Prateek, Manish, were to buy one, please let us know. Would love to take a spin on your vehicles for sure. Journalist salaries don't afford a Harley Davidson.
Buy domestic brands. Everybody in the world is doing that.
Okay, maybe that too. But gentlemen, we got to wrap it up here. Thank you so much, both of you, for taking the time out and being with us and giving us your thoughts. It's a wrap on India Market Open. Thanks so much for tuning in.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset.
Welcome back. You're watching Ask Profit, and we're seeing cracks on the screen actually right now. We began with a positive texture, but you are trading at the lower point of the day for the Nifty 50, down about 0.5%. Similar signs for the mid-cap and the small-cap index. They're trading with cuts of over 2%. In fact, for the small-cap index, we're trading with cuts of close to 3% at this point. And it's not a pretty picture, 2.7%. But look at the weekly performance as well. It's been a torrid week for the equity markets. About 3% or thereabouts for the Nifty mid-cap index. But you have significant cuts for the broader end of the spectrum, cuts of 7% or thereabouts for the mid-cap index, cuts of 9% for the small-cap index. And in fact, a lot of names getting beaten down on the back of earnings. We spoke about one such earlier today, and that is Senco Gold. The numbers proved to be a little bit of a disappointment based on what was anticipating. It is currently trading with cuts of 20%. I believe we've got the management joining in right now, and we've got Suvakar Sen, who is joining in from Senco Gold. Mr. Sen, thank you so much for taking the time. It's a tough day for you in the equity market, and a lot of the investors that have been holding your stock are seeing that as well. Why? And I think a lot of people are focusing on the contraction, the significant contraction in the margin in the quarter gone by. Why did that take place?
So see, if you look at Q3 of last year to Q3 of this year, the 2-3 reasons why the margins have gone down. One is the duty cut that was done in the month of July, which has its impact on the overall numbers. So we have taken a 58 crore impact due to the duty cut. A part of it was taken in Q2 and a part of it is taken in Q3. So that has been one reason. The second reason have been that in the till Q3 for H1, Q1 and Q2, we have seen that the share of diamond jewelry sale in the overall jewelry sale has been on the lower side. So, in terms of overall gross margins, gold, we have seen a 22% growth in terms of, overall numbers. And in the whole consolidated part of the company, we have seen a 27% growth. But the growth has majorly come from sale of gold jewelry. And the share of diamond jewelry has been down, which means that the impact on gross margins has been on the lower side. And as a result, the EBITDA has been on the lower side. And the third thing is that because of the drastic price movement of gold, we have seen that the hedging impact that we had to take in Q3 led to a lower number overall. But again, what we are trying to explain to everyone is that if you look at the 9 months performance, Q1, Q2, Q3 all put together, then in the previous financial year, we had seen that the 9 months performance EBITDA of the whole company was 7%, which in today's day and time, after adjustment for customs duty, is 6%. So it is only an impact of 1%, that we see due to the lower stud ratio. But yes, what the street and the investors were expecting is that usually Q3 has a great quarter in terms of top line as well as bottom line. But this time, because Q1 and Q2 had a much higher percentage in terms of bottom line, the street is little disappointed. But what we are trying to assure and tell everyone is we have seen the trend, the sales continue to happen. We are expecting a growth of 20% year on year in terms of overall top line. The share and the sales of diamond jewelry in the last 2 months have started picking up, and it is growing at 50%. Year on year for December, January, February. So we are confident we will move back towards higher EBITDA and a higher profit.
Point made. I do want to ask, and Mahima is joining me as well. She will soon join this conversation. But the clarification that I was seeking is this customs duty impact one that you have taken in the last quarter. Is that over and done with? And heading into the fourth quarter, also from the perspective of the inventory that you had, the impact of finance costs, which were 20% higher, all of these headwinds that you seem to have faced in the third quarter, how much of that bleeds into the fourth quarter?
So the impact of custom duty has been taken in Q2 and Q3. So the fourth quarter will not have any more impact on customs duty. And the finance costs that we have seen and impacted, that finance cost for the purpose of jewelry and gold loan. So we had raised money from QIB, which will control the finance cost to a certain extent. So I think Q4 will be not impacted by either customs duty or finance cost. And we look to have a much better EBITDA and gross margin for Q4 and going forward for the next financial year as well.
Mr. Sen, Mahima also joining in. I just wanted to understand, in your P&L, the line item that is changes of inventories and finished goods, that has always been a negative figure. In Q4 3 of FY24, it was around negative 270 crore, but that has turned positive this 9 to around 29 odd crores. What has brought that change? Because that is the line item which is kind of hampering the profits overall.
Dhanteras was in the month of October. And we have been building up inventory in the month of August and September for the purpose of Dhanteras. The gold prices movement has also happened for the month of October, November, December. So I think that it's all a part of the normal course of business, that in certain quarters you have seen that the inventory has been on a has been reduced, the sales have been higher than the procurement, and in certain quarters the procurement has been higher in a build-up and expectation of the upcoming season, and that is what impacts on the line item. But if you look at a longer period of time, say 9 months or the whole of year, you will see that it will normalize to a level where the EBITDA will be close to 7%.
Okay, Mr. Sen, we've discussed this before also, but now I think is the time when lab-grown diamonds have actually picked up. And Senes is the brand which is for you selling lab-grown diamonds. What's the kind of trends that you've observed? And do you think that, because of pickup in the sales of lab-grown diamonds, your margins have been impacted?
No, lab-grown diamond sales, if you look at the overall sales, is much at, say, below 1%. So till now, if we've seen the sales of diamond jewelry, the natural diamonds have been much more, and that is available in all of our stores. Lab-grown diamonds are available only in the selected 4-5 stores that we have. That is number one. In terms of the sales trend of lab-grown diamonds, we have seen that it is usually the bigger size diamonds of, say, close to 1 carat in terms of rings, pendants, earrings, that is selling more in lab-grown diamonds. When it comes to the smaller size diamonds, it's usually the natural diamonds that is selling more, which is 90% of our overall sales, that the small size diamonds sell in the overall diamond sale. So yes, in the long run, I'm quite confident that lab-grown diamond will capture more and more market share. But the natural diamonds and lab-grown diamonds both will continue to remain, and we have to hedge ourselves and create 2 separate brands to cater to the 2 different needs and taste of the consumer. And I must tell you that, as I said, the January, February, we have seen that the demand for diamonds, because, now that the Russia-Ukraine war is about to be over, we are all expecting that the prices of diamond will stabilize and start moving upwards. But the demand for diamonds have started picking up in a big way. Last 2-3 months, we have seen that year on year, the diamond jewelry sales have gone up by almost close to 50%. So for the whole year, while we see a 19% growth in terms of diamond jewelry sale, the last 2-3 months have seen a big jump. It was only that the share of diamond jewelry sale in the first half of the year was much lower, which is impacting on the overall gross margin. But things will again normalize back to higher diamond jewelry sale.
Okay, on that point then, am I right in saying that the studded jewelry ratio or the share is about 10%? And what is the steady state? So you mentioned as one of the factors that led to that contraction in the EBITDA margin was a lower than expected share. What is the ideal share for you then?
So our endeavor is that over the coming 2-3 years, we take it towards 15%. And last year, our studded jewelry share was 11.5%. But this particular year, till about end of Q3, it was 10.5%.
Mr.
So
Sen,
you can imagine.
Mr. Sen, apologies for interrupting you, but I think your shareholders will be more focused on what will happen in the nearer term. I appreciate that you're saying 2 to 3 years, but what I'm trying to get is what you've seen.
11, yeah. It will move towards 11%, and in the coming year, it will move back to 11.5%. So, what exactly is happening, we all need to understand. Even in a diamond jewelry, there is a gold component and a diamond component, and making charges. Now, the gold prices in the diamond jewelry is moving at a higher rate than the price of diamond. So overall, in the overall scenario, we are seeing that yes, diamond jewelry sales are going up, but the share of diamond as an overall jewelry sale is not going up to the extent that the share of gold is going up. And that is impacting on the gross margins. But in the near term, we are looking at 11 to 11.5% of studded jewelry.
11 to 11.5. Okay. So your guidance for EBITDA margin is in the range of 7 to 8%. We've spoken about why it's coming at 6% for the 9 months. Will you, because of what you've seen or with what you've seen in the first couple of months, a month and a half of this quarter, be able to at least match the lower end of that guidance in the full year?
Yes. So we will be moving closer to 7% in terms of the full year. The top line growth continues to remain strong. The sale of diamond jewelry continues to pick up. And from a 6% adjusted EBITDA that we have, we will be moving closer to 7% by the end of this year.
Okay. Mr. Sen, one last question. A lot of your peers, generally hedge 100% of their gold, but for you, the hedging ratio is around 80%. Are you also planning to move towards that 100%, or will you stick with the 80%?
No, see, we have seen that our range of hedging has been in the range of 80 to 90%. And that is what we feel that, in terms of, because we are hedging the full inventory, and it is very much, sometimes I would say practically difficult to hedge up to 100%, because there's always a price movement, and sometimes you're at 85, sometimes you're at 90. So we will continue to remain hedged for 80 to 90%, going forward as well, which I think is practical.
All right, and one last question, Mr. Sen. What's the value versus volume growth been like for this quarter?
The value versus volume growth. So the value growth for this quarter has been, in a consolidated company level, 27%. For the standalone company level, it has been 22%. So that has been the value versus volume growth for the overall company. For 9 months, if we look at gold growth, it has been 19%. For diamond jewelry growth, it has been 18%. So that is one of it. In terms of volume of gold, gold has grown by about 1 to 2%, and diamond has, it was negative 2-3% till September. December quarter, it has picked up, and now diamond is at plus 2%. So this is the volume growth that we are seeing.
All right. Well, Mr. Sen, thank you so much for giving us those insights and answering all those questions candidly. And thank you so much for taking our time and speaking with us at NDTV Profit. All right. We have our next caller also lined up, coming back to Ask Profit. Mohan from Hyderabad is calling in. Mohan, a very good morning to you. And thank you so much for waiting. Go ahead with your query.
Yeah, thank you so much for the opportunity. Good morning, everyone. So I'm holding NCC Nagarjuna Construction shares from a long-term view.
Okay.
The question that I have is, I'm holding at 90 rupees. I mean, it was 5,000 quantity. Of course, I exited about 2,000 when it touched 186.
Okay.
And then it went up to 365. Now with the recent quarter, the share was so much down. It was thrown down completely. So I'm just trying to understand what's the long-term view. While the analyst, average analyst rating is to hold it with an average rating of 360 or 400. So I just wanted to understand, from a horizon point of view, I can hold it up to 1-2 years, but yeah, I would like to take your view as well.
All right. Mohan, understood your query. Samir, I'll come to you. Good morning to you, Samir. NCC is the counter. He's sitting on a good profit number of around 3.4 lakh. But, the stock has significantly come down from, the highest levels. What's your view with respect to the long-term prospects of the company?
So, Mahima, thank you, for asking this question, because we've had this question quite a few times, but you got to understand one thing, that it's not only one stock, NCC, that's fallen. I think across the board, every stock has fallen in this current correction of this market, right? Now, NCC has probably fallen a little bit harder for the simple reason that the last quarter results were a little muted or subdued. We saw operating margins coming off. But you also got to realize that, these are construction projects, which are long projects. And we've always discussed this with you, that when you have longer term projects, there are certain points of completion of project where you can start recognizing the profitability for the project. So normally how it works is in the first 20% of a project when you're executing, it's just the cost that you can recover and charge the revenue for. You start charging the profitability and the margin only once you get past the 20% closer to the 60%, and then from 60% on, the margins start accelerating a bit more because you're getting closer to the completion. So during the current quarter, it could very well be that there could have been some increase. Some of the projects which were not in the phase where they were to get their operations, the EBITDA, but that will start coming in the next quarter. So sometimes you will get this lumpiness in profitability for companies like this. But like I said, at the point that India is, and we believe that the infrastructure spend is going to remain high, NCC is a player who's obviously delivered a lot of projects, has good balance sheet, and has a good growth opportunity given its order backlog and the future orders that they're tendering for. So we believe the growth trajectory will continue. The operating margins will come back to normalization and start moving up as you get to that point of completion. And this is actually a good time if somebody doesn't have the stock to add on. But for your current investor who's asking the question, I say stay invested in the stock.
Let's, Samir, talk about IRCTC, because the question coming in from Sundara Rajan, he's bought at levels of 603 for the long term, and he's wondering whether to hold or to switch to something else from the railway space, something like an RVNL. What's the view?
Stay put in IRCTC. So, okay, now the growth has been affected because of one point that I was part of the conference call that happened this time around. They said that they've captured 87% of the ticketing market, which has moved online. So the growth from that 87% is obviously going to be a little muted going forward, because at the end of the day, there's only 100% of the tickets. So once the additional train routes and more routes come up, you will see that normalized growth, but maybe capturing of market share will not exist. But what they're focusing on is the tourism packages business, where we've seen a very strong growth. And the opportunity in that business continues to remain very strong, since it's still a very small part of the overall business. As that sees more traction and more of these tour packages booked on IRCTC website start seeing an uptick, we will see the profitability continue to increase. It's kind of a monopoly business when it comes to the railways, when it comes to ticketing, and for food and the other services that are offered. Now they've also done these tabs with Zomato and a couple of others where the revenue streams and the profitability is coming in. So this is a business which is debt free, growing. Growth may be a little muted. Yes, valuations are a little expensive, but then in a monopoly business, you tend to pay premium valuations. So I say stay invested, and my view is that in the next year and a half, you could see the stock back above 1,000 rupees.
I do want to address markets at this stage, and let's pull up the sectoral index, because the indices, if we can, and just that heat map will tell you that the texture is completely different from what it was at the start. And we've got, just to give you some perspective at this stage, Sudeep Bandopadhyay, who is Group Chairman, ND Trade Capital, is joining us. Sudeep, please help me understand how you're reading this, because the gashes may not be very significant at the benchmark Nifty level, but at the broader end of the spectrum, you're seeing quite a bit of carnage. You see the small cap index that seems to be capitulating at this point. A lot of individual names losing a lot of ground. What are you seeing that is causing this?
Well, I think there is general uncertainty regarding what's going to happen as far as the tariffs are concerned. While the joint declaration was kind of reassuring, but the fact remains that reciprocal tariffs doesn't kind of augur well for India at one level, and I think the concerns haven't really been assuaged. So the valuation concern continues to remain, the domestic challenges continues to remain. So under these circumstances, people are taking money off the table, and that's what is getting reflected in the market.
This is your own judgment, though. So that may be the perception, to say that we don't yet know what the implications of this reciprocal tariff is. It is that boogeyman or specter that currently is standing over your shoulder, but nothing has come to pass yet. We're talking about something that has in the past, even over the last couple of weeks, been used as a negotiating tactic, and the Prime Minister very clearly stating that both his team as well as President Donald Trump's team are working on a trade deal. So for something that has not yet come to pass, is this a question of people pulling money off the table? Would you attempt to deploy in some of these names that are getting beaten down too much?
Well, of course, people are pulling money out of the table, considering the uncertainty in the global environment, as well as the challenges which are still existing in the domestic market. And remember, the valuations, even after correction, is not cheap in some of these small cap and mid cap names. So obviously, when the things are not really favorable and the valuations are rich, people would love to pull some money out, and that's what is happening. Also, remember the foreign institutional investors. Look at their perspective. They are getting a risk-free return of 4.5%. You assume a 4-5% rupee depreciation vis-a-vis US dollar. So you are looking at a rate of around 4 plus 4 or 4 plus 5, about 9%. Now, if they're willing to invest in equity in an emerging market, that also small cap, mid cap, they will definitely, look for a incremental return of 5-6% on top of that. So you're looking at a 15% return, minimum return, to kind of balance things out if they have to invest in small cap, mid cap, or even large cap. Now, I don't think that assurance they are getting at this stage. So money is being pulled out by foreign institutional investors like there is no tomorrow. I think combination and aggregation of all these facts is leading to this kind of correction. Market is trying to resurrect itself periodically based on news flows, but I think the selling pressure is little too much.
So, as I understand it, for the mutual fund industry as well, looking at the numbers that came through in the last fact sheets that were displayed, Sudeep, you have cash that has been deployed, but because of the drawdowns in the underlying asset, which is in equity, the percentage of cash sitting on the sidelines has actually gone up. So the industry has money to deploy. The question is, will they, and can they consistently do this? For you in particular, are you keeping your powder dry as things stand right now, or will you be buying selectively, and where are you seeing opportunities?
Well, we are definitely advising clients and ourselves also keeping cash in hand to an extent. But honestly, there is excellent opportunities, but not in mid and small cap. We are looking at opportunities in the large cap universe, and we believe there are excellent opportunities in the large cap universe if you are planning to build your portfolio for a longer duration. We do like banks, SBI in particular. We do like Reliance Industries at current levels. We do like LIC in the insurance space. We do like Ultratech in the cement space. I think corrections are providing excellent opportunity for building a long-term portfolio in large cap stocks. And instead of putting all the money to work, straight, it's better to deploy over a period of time in a phased manner.
Sudeep, thanks so much for joining in. Pleasure speaking with you as always, and thanks for that perspective. All right, let me take this next one because it is in line with what Sudeep was talking about at the end there. He was talking about buying select large cap names, and Vani wants to know whether or not to buy Reliance Industries. I know a few fund houses that have taken outsized positions in Reliance Industries and that have been disappointed because it's not performed at all. But the question is, would you buy this for the long term at this current level, which is close to that 1,200 mark? Jatin, what's the view on the charts?
See, in terms of Reliance, we are seeing a breakdown below this 1200 mark. So, yes, it's trading around that 1200 zone where a couple of swing lows are placed, but we don't see the structure turning out to be bullish pretty soon or until the price sustains about 1230, 1240 odd levels. So, it's not a price at which I would suggest to go long immediately, but definitely it should be kept on our radar. We believe that 1180, 1170 is a strong support zone, and once that is tested and we get a bullish development on the price pattern, then I think we can stick our neck out and say that the short-term bottom is in place. However, that process is still not complete, and we are expecting further downside from current levels. So one should wait and watch and not venture out and buy at current levels.
All right, so that's the view coming in on Reliance. We've got our next caller, Mahesh from Andhra Pradesh is calling in. Mahesh, a very good morning. I believe you have a query on TVS Supply.
Good morning, madam. I am Mahesh from Andhra Pradesh.
Right.
I want to know about TVS Supply Chain Solution.
Okay.
It is issue price is 190.
Okay.
Under the brand name of TVS, I bought it at the rate of 170.
Okay.
Now it is downtrend.
Right.
Yesterday or day before yesterday, a black deal has been happened at the rate of 160.
Right.
What I have to do?
Okay.
What I have to do?
Okay, Jatin, I'll take this quickly with you. What are the levels that you're watching for TVS Supply on the charts?
In case of TVS supply chains, we believe that it's falling. It's in a free fall. So I believe that 120, 121 is the level that I'm getting on my chart. So it's a significant downside even from current levels. So the support levels are pretty low even from current market price.
All right, Mahesh, thanks. Mahesh, that's the view on TVS Supply. Jatin, thanks so much for that view. Samir as well, thank you so much for joining in and really appreciate both of your patience on this show. That brings us to the end of this edition of Ask Profit. It's been a pleasure bringing it to you. Do stay tuned, lots more coming up on NDTV Profit.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome, you're watching NDTV Profit. I am Mahima Vachrajani. United Breweries is in focus on the back of its Q3 earnings, where revenue was up by about 6.5%, EBITDA was down 3.3%, margins came down to around 7.1%, and net profit was down by about 55%. But overall, in terms of volumes, the company has done well. Volume growth of around 8%, premium volume grew by around 33%. To discuss as to how the quarter has gone by and how things are shaping up for the company, we're joined by Mr. Vivek Gupta, who's the MD and CEO of United Breweries Limited, who's joining us now. Welcome to the show, Mr. Gupta. My first question to you is that overall this quarter has been good in terms of volumes because they are much better as compared to Q3 last year. But overall, what's the sense of how earnings have panned out this quarter, and why has net profit and margins been hit?
Yeah, good morning, Mahima, and thanks for having me. As you said, we are absolutely pleased with the volume growth on this quarter. Our overall volume grew 8%, our premium volumes grew 34%, and we actually grew market share throughout the country on a very, very large and competitive beer market. So we are very pleased on the volume results, and this volume also translated to a 10% revenue growth. So we had a good price mix as well as we did the business. This is in line with our strategy of being a category maker versus a category taker. We are really focused on driving top line growth and expanding the category in a tough circumstance. When I say tough circumstance, because beer is becoming less affordable in many states because of the high taxation and increase in consumer pricing. So that's a challenge which we are working on. But despite that, we are very pleased with the top line momentum, the category expansion. Yes, if you look at year to date, our EBITDA is up around 13%. We have expanded our gross margins by 50 basis points. This quarter our profits were lower because we made some choices to be ready for the season for 2025. If you remember, in 24, during April, May, June, there were general elections that impacted the volume. So this time we are expecting a slightly stronger volume growth because there's no election disruption. So to prepare for that, we invested a lot of money in our breweries on repair maintenance so that we are ready for more production. We invested in premium launches. We launched Amstel Grande in Maharashtra and West Bengal, which is off to a great start. We are going to expand that in more markets. We continue to invest in our premium brands like Heineken, which is growing at 61%, and Ultra, which is again growing more than 40%. So we are absolutely pleased with the momentum. We did have some one-off costs in the system, but we are not, concerned about a quarterly profit outlook because structurally we are getting better. On a year-to-date basis, we are fine. And I think our outlook is looking positive given some of the recent changes in the market, which has also happened.
Right. Mr. Gupta, you also mentioned that, revenues have improved on account of, better price mix as well. I just wanted to understand that what's the value growth been like and what is the kind of, rough range of price hikes that you've taken, this quarter? I mean, I believe it must be in select pockets, but what's the kind of range?
Oh, see, our pricing mix is only very small because a lot of it was the full year impact of the pricing we got last year in some of the states during the same period. We did get some new pricing in the start of the year in a couple of states like Tamil Nadu, and we got some pricing in Rajasthan. But at the same time, I would say that our price mix and our premium proposition mix was a 2%. On a full year basis, our mix is around 4%. Year to date, our volume is up 6% and revenue is up 10%. So it was slightly behind on the mix because of the state. But going forward, we expect to have almost 3 percentage point gap between the volume and the pricing growth.
Right. Mr. Gupta, the elephant in the room right now is, what happened with the Telangana government. And now, after a lot of back and forth, Telangana government has now agreed to, make a price hike of around 15%. And this is after, FY20, if I'm not wrong. But, yes. I want to understand whether that 15% price hike is enough for you. And if yes, although even if it's not enough, I believe that 15% price hike will, bring a lot to the table. I believe volumes will go up for you in Telangana. Plus, it will add on to your revenue as well as, your EBITDA plus EBITDA margins as well. One of the broker did say that, the impact on revenues might be around 1.7 to 1.9 billion and around EBITDA, it will be around, margins will be around 200 to 20 basis points. Is that the correct reading? What do you reckon of this?
Yeah, look, I think first of all, I'm really glad that the government of Telangana and the corporation actually, listened to the industry and made a progressive move. Because as you mentioned, for 5 years there was no pricing, the cost structure was really becoming unviable, and I think, unfortunately, we could not sustain that business, and that's why we had to take a call what we did. But I think we had very constructive conversations, and I think I see this 15% increase as a positive step. We are still not out of the wood there. We still think that we need to get the structural profitability right, and we are still in the conversation with the government on how to look into that. I also think that the consumer price increase of 30 rupees, 40 rupees is too much. There has to be some tax rationalization because, the beer has to be promoted more because it is moderate, it's a social drink. The realization by manufacturers is much, much lesser than what government realize. So I think there's a lot more work to be done. So bit of, bittersweet experience on that. In terms of our market, we expect almost 100 basis point impact on our gross margins, gross profit margins because of the Telangana.
Okay.
As we said, we are in the investment mode. We need to be category maker. We really need to see what's the impact on consumer demand because of the high pricing. We have no experience in Telangana over the last 5 years because consumer price increase happened once, but not to this extent.
Right.
So we have to be extremely watchful. We have to measure that. But if everything goes well, I think there will be a material impact on the top line and bottom line for this. But we will, as we said, there's a huge scope to expand category, and we'll continue to work with the government and with the corporation to further look at what can be done.
Right. So, Mr. Gupta, then you think that the 15% price hike is enough, or do you expect a further price hikes if you're in negotiation with the government already?
Look, as I said, the 15% is not enough. And why is it not enough? Because it still doesn't help our cost structure. But we also needs to continuously in the conversation with government, like we are with every government, that how do you make the state as an investment grade for beer? Because if the structural profitability is not there, it will be difficult to make new investments. And it is a very constructive conversation, and we understand the limitations on they could not take the pricing in one go, but this will be a continuous process because we are still not out of woods.
Okay. And with respect to the new greenfield brewery that you're starting in UP, I just wanted to understand as to what will be the capacity of that unit because it will probably start in FY27 if I'm not wrong. And what is the kind of total capex that you'll be doing for that particular greenfield project? And what's the kind of funding route that you'll be picking up?
Yeah, we are extremely excited to actually announce the greenfield brewery in UP. This is, I think, almost after a decade where United Breweries is actually putting a greenfield brewery, and this is going to be a world-class brewery with best of the technology. We are going to produce Heineken, one of the biggest brand globally, and our crown jewel there as well. So we are really looking forward to having production there and also expanding the category growth. It's a huge investment. We are making close to 750 crore investment in this project, which can be expanded further. The brewery is going to be modular, anywhere between 1 million to 2 million cases, because we are going to look at the expansion and the category growth to do that. So yeah, we are extremely excited about this project. In terms of source of funding, I think we always keep looking at our capital structure. And we will see, how much debt or equity we want to put there. So those details are being worked out, but we are extremely excited on our greenfield project.
Well, that was the management of UBL speaking about their quarter gone by and the outlook for the coming quarters. But moving on, let's just take a quick market check. Well, the Nifty 50 is mirroring the color of the day this Valentine's. It's in the red, seeing pressure down about almost 1% in trade right now. When you look, at the advanced decline ratio of the entire market, you have 1,921 advances versus 179 of the Nifty. You have 47 declines versus just 3 to 4 counters in the green. If you look at what's dragging the Nifty down in terms of a BEL, which is down almost over 3.5%, followed by an Adani Enterprises as well as an Adani Ports, all seeing cuts of 3%. And the only stocks that are holding some kind of strength on the benchmark is a Nestle. It's up 0.5%, followed by a Tata Consumer, a JSW Steel, as well as a TCS. It's a broader markets that are still underperforming, heavily under pressure, and that remains the case this entire month. You had this Nifty small cap 250 down about 3% and the mid cap 2.5%. I want to pull up the Nifty small cap 250. You have 233 stocks under pressure versus 9 stocks that are doing fairly well. You have a Concord Biotech, which we'll talk about in just some time. It's down about 15%. Natco Pharma continues its decline, seeing cuts of almost 10% after hitting 20% loss yesterday. Kalpataru projects, something like a KFinTech as well as a KEC International, all under pressure. Something on the small cap 250 that is doing well on the flip side is a Godfrey Phillips. It's up about over 17%, followed by Anupam Rasayan, Chalet Hotels, but very minor gains on that front. Lastly, if you look at the sectoral picture, well, you have all of the sectors that are in the red. The Nifty FMCG doing fairly better than the others, but the Nifty Pharma is down 3%. And you have almost all of the constituents on the benchmark under pressure. Natco Pharma, like I previously said, down almost 9.5%. Laurus Labs, Lupin, Glenmark Pharma, all seeing cuts of 5 to 8%. But we shift our focus to, you have all of this tariff uncertainty, but over last night you had President Donald Trump stating reciprocal tariffs, and we're going to talk about some stocks that do have a significant exposure to the US in terms of their revenues, and all of the counters that almost all of the counters that I'll be mentioning are in the red. Now let's start with the list, and I want to first we're going to talk about the pharma companies. You also have the Nifty Pharma under pressure today. We have something like a Dr. Reddy's, a Lupin, a Sun Pharma that have the highest exposure in terms of revenues, FY24 revenues to the US at 46%, 37% and 32% like on your screen. You also have something like a Cipla and Torrent Pharma which have a 28% and a 10% exposure in terms of revenues. Up next you have a certain you have certain companies like a Sona BLW, a Samvardhana Motherson and a Sansera Engineering that have a 10 to 40% exposure. Sona BLW and Samvardhana Motherson, their exposure to North America. That's where America lies. Comes in that place. Then you also have something like a Bharat Forge and Ramkrishna Forgings in the forging space. Bharat Forge has a 25% exposure to the US in the FY24 revenues. Ramkrishna at a 58%. You also have tire industries like Balkrishna Industries that have a 16% exposure in terms of their FY24 revenues. In engineering, you have something like Shilza Tech, 21% exposure to the region. You also have a Tega Industries, which has an exposure of 15% to North America. And then you have a Worry Energies that had a 50% of their FY24 revenues came from the US. But it's key to note that this is a company that does have manufacturing abilities in the US. And there are a lot of caveats to how the tariffs will be imposed. And we need some more concrete evidence. But you also have certain textile companies that have exposure to the US, something like an Arvind, a Wellspin Living, Trident, Alok. I want to quickly pull up a Gokaldas Exports, which is seeing cuts of over 6%. And this is a textile player whose exports ready-made garments to the US. If you could just pull up a Gokaldas Exports, there you go, it's down about 6%. You also have stocks like a PI Industries, UPL and Jubilant Ingrevia. All of these stocks are under pressure as well, and these are the makers of the top 5 major molecules that US actually imports from India. And all of these counters, Jubilant Ingrevia especially, is under pressure. So those were the counters that are seeing some kind of impact and they have exposures to the US in terms of revenue. But we'll shift focus to Senco Gold. It was a weak quarter for the company. We have Mahima joining us to tell us what's hurting the stock.
So as you rightly mentioned, in terms of EBITDA margins as well as net profit, it's been a disappointing quarter. Revenue, however, is up by about 27%, but EBITDA is down 56%. Margins have, slid down to 3.8% versus that of 11%. Now, if we remove the custom duty impact, margins stand around 5%, which is still below the normative range of around 6 to 8%. In terms of net profit, it's down by about 69%. Couple of things that have not worked this quarter. Well, lower EBITDA margins is due to lower studded ratio, high export sales as well as OPEX increase. Custom duty impact this quarter is around 48 odd crores. Cost of raw material has gone up by 10%. Changes in inventory and finished goods has seen a drastic impact because in the previous quarters it was a negative number. In this particular quarter it is turned positive by about 200 plus odd crores. In terms of finance costs, it's gone up by 20%. This is because they have used the QIP proceeds to repay their overall short-term debt, which is why finance costs have gone up, and 9 months margin also is at 6%, which is lower than the guidance of 7 to 8%. In terms of the operational metrics, however, retail growth was at 19%, same-store sales growth at 16.4%, studded ratio stood at around 10.5%, value growth for gold was at 21%, diamond at 9% and 35% for silver. In terms of the hedge ratio, it was maintained at 80%. The company did raise a QIP this quarter of around 459 crore, which was used to repay the short-term debt and CC. They have also announced 1:2 stock split as on January 31st, 2025. And in terms of stores, last 9 stores, they launched around 12 showrooms and they're on track to open another 8 to 10 new showrooms in Q4 FY25. So this is the overall view as to how, Q3 has panned out for Senco Gold. It's a disappointing quarter for sure.
Thank you, Mahima, for giving us those details. The stock under pressure, down about 20%. But we also spoke to Suvarkar Sen, the MD and CEO at Senco Gold, and he talked about their margins outlook. Do listen in to a slice of that conversation.
11, it'll move towards 11%, and in the coming year, it'll move back to 11.5%. So, you know, what exactly is happening, we all need to understand. Even in a diamond jewelry, there is a gold component and a diamond component, and making charges. Now, the gold prices in the diamond jewelry is moving at a higher rate than the price of diamond. So overall, in the overall scenario, we are seeing that yes, diamond jewelry sales are going up, but the share of diamond as an overall jewelry sale is not going up to the extent that the share of gold is going up. And that is impacting on the gross margins. But in the near term, we are looking at 11 to 11.5% of studded jewelry. So we will be moving closer to 7% in terms of the full year. The top line growth continues to remain strong. The sale of diamond jewelry continues to pick up. And from a 6% adjusted EBITDA that we have, we will be moving closer to 7% by the end of this year.
Moving on, we have the Jan WPI inflation data that just come in. So let's just quickly address that. You have wholesale prices rising 2.3% on a year-on-year basis versus the estimate of 2.5 percentage. And this is also versus the 2.37% rise that we saw in December. So we have a decrease in the quantum for how prices have increased. Manufactured product inflation stood at 2.5% versus 2.14% in December of 2024. We are in primary articles, inflation is at 4.69% versus 6.02% in December. Fuel and power has seen a deflation of 2.78% versus 3.79% back in December. And the November WPI inflation rate has now been revised to 2.16% versus 1.89%. This is on a provisional basis. So there's a positive rate of inflation in January 2025. This is primarily due to the increases in prices of manufacture of food products, food articles, other manufacturing, as well as non-food articles, and lastly, the manufacture of textile. Well, that was what we had for the WPI data. But moving on, let's talk about a stock that is in focus, and that's Hindalco Industries. And it was, it started the day in the green. It saw gains of 2%. It's now slipped into the red as the markets, are under pressure, down about 0.8%. But nonetheless, it had a very good quarter this Q3, and this was despite the weakness that was reported in Novelis just a few days before the, earnings. You have revenue rising 10.5% to 58,390 crores. You had EBITDA see almost a 30% uptick. Margins have also improved 12.98% versus 11.1%, and net profit has seen a 60% growth to 3,735 crores, beating the street analyst estimates at 3,372 crores. Now, in terms of what drove the earnings, well, it was mainly the India business, and this comes despite the weakness that the company's US subsidiary Novelis has seen in the quarter. Now, the aluminium and upstream and downstream segments is what's the standard. You've seen revenues take a 25% year-on-year growth. Even the copper segment, on the other hand, has also seen revenues grow 15% on a year-on-year basis, and the aluminium upstream EBITDA is up 73%, copper segment up 18%. In terms of, your segment-wise performance, aluminium upstream revenue growth was driven by higher aluminium prices in Q3. Shipments did remain muted at 1%, but this is because the company is currently operating at its full capacity, and EBITDA per ton is something that stands out, up 68% on an annual basis to 1,480. In the downstream segment, revenue growth was driven by volumes, which rose 10% year-on-year to 99 kiloton, and the EBITDA per ton also saw 22% uptick to $179 in Q3. And lastly, you have the copper segment. Revenue growth was driven by the higher copper prices that we saw during the quarter, but shipments rose 1% to 120 kiloton. But this is also because the company right now is operating at peak capacity, and this is what the management has said. In terms of CLSA, you did have maintained its outperform rating target at 800. All the aluminium profitably was in line with estimates, and there are certain positive. They're waiting for the commentary on costs, hedging impact, and the benefits of alumina sales during the conference call, which will be at 4 p.m. today. But we did speak to Hindalco's MD Satish Pai, and he talked about how the aluminium downstream segment's EBITDA per ton can grow from current levels. It's indicating a 40% quarter-on-quarter uptick. Do listen in.
I think that the upstream EBITDA per ton is good, but as our downstream capacities expand, the new 170 KT Aditya rolling mill is being commissioned this week as we speak. So our downstream volumes are going to jump to 600,000 tons per year from next year. So I think that we are expecting the downstream EBITDA to go above $250 per ton. This 250 is on top of the upstream EBITDA per ton. So I think that starting from next year, you should see a substantial contribution coming from the downstream side of aluminum.
We now shift our focus to a Concord Biotech, which is hurting in trade today. If you just pull out the charts right now, it's down about almost 17%. And this is on the back of its Q3 earnings. We have Puneet joining us. Puneet, what's dragging the counter down? What went wrong?
Well, definitely, in this particular quarter, we've seen demand getting impacted, and that has eventually hurt the EBITDA as well as the profitability in this particular quarter. But there is some grey lining out of coming out of the commentary from the management. But let's look at the results first. Revenue came in just a 1% growth at 244 crores compared to the same time last year, while the margins were down by 390 basis points to come in at 40% versus roughly 44%, which was there in the same time last year. Now, estimates were of 44%, so margins have been impacted due to that. Net profit was also down 2% to come in at 76 crores versus estimates of 89 crores. So a miss across all fronts in terms of estimates, in terms of revenue, EBITDA margins, as well as profitability. Now, what led to this particular downfall was, of course, lower growth in its API business, just 3% growth at 176 crores, while the new high growth business of the formulations is actually down 1% to come in at 67 crores in terms of segmental performance. Now, when you look at what was the key reason of the fall, was one of the, apart from the demand side aspect, was the gross margin fall of roughly due to lumpiness in terms of procurement. Now, typically for Concord Biotech, they do supplies APIs as well as formulation to its customers. Now, in this particular quarter, we saw that kind of order inflow delayed to the next quarter. Now, that's one of the silver linings I was talking about, that while revenue hasn't been recognized in this particular quarter, the management is confident that it is just a delay and not loss of revenues or business going forward. Apart from that, they're expecting some spillover to go into Q4 as well as Q1, but it's business not lost. That's what they mentioned. Raw material to sales also was up by almost 200 basis points, and that impacted the overall EBITDA margins as well, while the employee cost has also shot up by 12% in this particular quarter compared to the same time last year. So those were some of the reasons why the margins and profit was impacted, and spillover in terms of revenue to the next quarter has impacted the overall top line as well. But the company has guided that they are expecting and optimistic of achieving 25% CAGR growth over the next 5 years, led by new formulation business as well as the continuity of growth in APIs. And finally, they mentioned that they are also exploring a new opportunity in the CDMO space, something that the pharma majors have been talking about, and that could be one of the key aspects in terms of growth going forward. So while today it has been hammered because of the loss of revenue, so as to say, as well as the margin impact, the Concord schedule at 4 p.m. today will be key for the management commentary.
Thank you so much, Puneet, and we'll get you the con call highlights when the con call is over later in the day. But it's Valentine's Day today, and if you're running out of gift ideas, well, we've got you covered. And no, it's not chocolates or flowers, but stocks. We've Rucha, who's compiled a list of stocks with the most potential in terms of an upside that you can gift your Valentine. Over to you, Rucha.
So this Valentine's Day, let's think of a stock that which you can give to your Valentine. So we've brought you 11 stocks with an upside potential from more than 50% to up to 110%, and which are tracked by at least 10 analysts according to Bloomberg estimates. Let me start with the one having the highest upside potential. It is Sign DLM with a 12-month target price of about 900 rupees and an upside potential of 110%. Next one is Prince Pipes. 477 is the target price, upside of 66%. This is followed by the realty stock, Suntech Realty and CESC with the target price of approximately 727 and 205 respectively, having upside of about 63% to 65%. But if we can move on, we have upside stocks with an upside of from 53% to 57%. You can see we again a realty name Godrej Properties, we have a defense name Data Patents, and REC, AB Capital as well, all having upside potential of up to 53 to 57%. But if we can also move on, we have Power Finance Corporation, Z Entertainment and Repco Home Finance, which have an upside of approximately 52% to 53%. So these are the 11 stocks, as I mentioned, which have an upside potential of from 52% to about 100%, with Sign DLM having the highest potential upside, and these is according to the Bloomberg analysis.
Thank you, Rucha, for giving us all those details. And with that, it's end for this show. Thank you from myself and everyone who put this show together. Stay tuned to NDTV Profit. Lots more lineup on the other side.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market.
जब अमेरिका और भारत साथ मिलकर काम करते हैं यानी मागा प्लस मीगा, तब बन जाता है मेगा पार्टनरशिप फॉर प्रॉस्पेरिटी।
So we are being reciprocal with India. Whatever India charges, we charge them. So frankly, it no longer matters to us that much what they charge, because whatever they charge, I had discussions with India in the first term about the fact that their tariffs were very high, and I was unable to get a concession. So we're just going to do it the easy way, and we're just going to say whatever you charge, we charge. And I think that's fair for the people of the United States, and I think it's actually fair for India.
Hello and welcome. You're watching NDTV Specials. Trump's reciprocal on tariffs as well as Prime Minister Narendra Modi's visit to India. Overall, if you see, Mahima, the clear action over here is as to what happens in terms of the tariff war, whether India gets impacted or it's the other countries which are getting impacted, because if you see in terms of the trade deficit, India is at the lowest, whereas if you see China, which is sitting at the top.
Right, absolutely. And I think it's because of this uncertainty right now that the markets are under pressure. You know, we don't know yet as to how these tariffs will play out, what will happen next, whether, you know, these tariffs being implemented will again be revoked like, you know, it's happened with Canada and Mexico. All of these uncertainty taken into picture is why the markets are, you know, kind of wary of it. They're thinking that, no, right now is not the time when you know, because it's uncertain, let's, you know, take money off the table and you know, keep cash on hands right now and, you know, make decision once things are more clear.
Absolutely. In fact, US President Donald Trump on Thursday actually ordered his administration to consider imposing reciprocal tariffs on numerous trading partners, including India. What does this move mean for Indian economy and the markets? My colleague Somit joins us to give us more, and after that we'll have Mika. Somit, over to you.
Well, yes, if you look at the India-US trade, US accounts for nearly 17.7% of India's goods total export. But when you compare it with other Asian economies, we are not that high. When you look at China's total trade surplus to US, it stands at around $295 billion US, followed by Euro region, which stands at close to $267 billion US. Then there is Mexico, Vietnam, Taiwan, which is anywhere in the range of around 74 to 172 million US. But when it comes to India, it is just 46 million US as compared to that of Korea, Japan, and Canada, which stands at anywhere between 64 to 69 million US. Now, if you look at the key commodities that are being exported more from India to US as compared to US to India, these are the key commodities where these are the key commodities that India exports more to US. Electrical machineries, the trade deficit stands at around 11.8 billion US, followed by pharma products, similar amount of trade deficit. Then there is pearls and precious stones, nuclear reactors, textile, where the trade deficit is anywhere between 3 to 6.3 billion US, followed by products like multiple apparel and textile products, iron and steel products, organic, chemical, and vehicle, which stand anywhere between 2.2 to 2.4 billion US. So these are the key commodities where there could be a chance of a higher tariff coming in, given the fact that India is exporting more of these products to US. Now, also let's look on the flip side, which are the products that we import more from the US market. Firstly, it's minerals and fuel. The total trade surplus stands at around 9.6 billion US. Most of this would be towards gas, LNG as well. Then there is aerospace, which is around 2.7 billion, optical parts, edible food, fruits, pulp food. Not much of these products are coming in from the US to India. On the other side, if you look at, then there is chemical products, beverages and spirits, iron and steel, plastic, cotton, but the contribution of these products are not that higher. Now, if you look at the total excess tariff that India charges, in fact, that is the highest, around 8.5%. The second highest that we are seeing in the Asian countries. South Korea's total weighted average tariff stands at around 14.4% on goods that are imported from US, while that of India stands at around 8.5%. China has a lower rate of around 7.1%, Thailand 6.2%, Mexico 5.2%. As against this, US is charging a weighted average tariff of just 3%. So a clear differential of 5.5 percentage points is what we are seeing between the tariffs charged by India and tariffs charged by US. Now, let's look at the products in which the differential of tariffs is the highest. Firstly is the animal products, where the tariff differential is nearly 30.2%, which means that India is charging this much percentage points higher than what US is charging on animal products. Vegetable products 20.5%, food products 35.6%, footwear 17.2%, textile 15.6%, and this would be the important sector because a lot of companies from India export various types of textiles and garments to the US market. Followed by there are many other products like transportation, chemicals, also one of the important products stones and glass and minerals, and the tariff differential for these products stands anywhere between 8.6 to 14.4 percentage points.
All right, thank you so much for breaking that down for us, Somit. That was with regard to what we import and export, as well as, you know, what do these tariff hikes mean exactly, and what is the range of those tariff hikes. But you know, the stocks that export to the US are trading in the red. But which are these stocks? Which are these sectors? Mika is here with us with a list of that and breaking that down for us. Mika?
Yeah.
So most of the stocks that I'll be mentioning are trading under pressure today, and these are stocks who had significant exposure in terms of revenues in FY24. First, in the pharma space, we have something like a Dr. Reddy's, a Lupin, a Sun Pharma, highest amount of sales from the US at 46, 37 and 32%. Then we also have something like a Cipla and a Torrent that have a 28% and a 10% exposure as of FY24. In the auto ancillary space, we have three counters, a Sona BLW and a Samvardhana Motherson have a 40% and 18% exposure to the North American region, and Sansera Engineering had 10% of their FY24 revenues from the US. In the forging space, you have a Bharat Forge, 25% exposure to the US. RK Forging has a 58% exposure, but this is for the North America region as a whole. Then in the tire space, you have something like a Balkrishna Industries, which derives 16% of its FY24 revenues from the US. In the capital goods space, you have something like a Shilza Tech. This is 21% exposure to the North American region as of FY24. In the engineering space, you have Tega Industries. It had a 15% exposure in FY24, and this came from the North America region. In the solar manufacturing space, you have a Worry Energies. 50% of their FY24 revenues were from their US exports. However, the company does have manufacturing capabilities that it's building in the country itself. Lastly, you have some textile companies in focus. We don't have the exact numbers, but these are companies that do export to the US. It's something like an Arvind, Wellspin Living, Trident, Alok Industries, Raymond, and a Gokaldas Exports. A Gokaldas Exports is under pressure, down about 6%. And lastly, you have three companies, PI Industries, UPL, and Jubilant Ingrevia, all under pressure, Jubilant Ingrevia especially. And these are the makers of 5 major molecules that are imported by the US on an annual basis.
Mika, for getting us a lowdown in terms of everything, in terms of sectors that could be impacted. But let's look at the auto sector closely, which could bear the brunt of Trump's reciprocal taxes. Now, clearly, my colleague Tushar joins in to tell us the potential impact. Tushar, over to you.
So, original equipment manufacturers, the companies which manufacture vehicles, are seen largely insulated, but there can be some impact on the auto component makers due to the Trump reciprocal tariffs. So what are the companies that may be impacted? First is Royal Enfield, because some of its 650cc exports are targeted towards the US market and then the European market. Auto ancillaries like Sansera, Suprajit, BKT, Sona Comsa as well as Mother and Sumi have significant exposures to the US market. But the impact is seen limited because what analysts are saying that these companies have already started looking at workarounds from these US tariffs that may include routing these exports via other countries such as Mexico or Morocco, where these companies may have operations. The impact on auto ancillaries also should be seen from the point of view that these auto components go into several American cars, including Tesla as well as Ford. So if these exports become more expensive, which means the American cars will also get more expensive, and that's not a good idea for a market which is already seeing a sales slump. Any hike in the tariffs will, but India is a preferred partner to the US, so it seems largely that all these companies will be insulated. Also, we have to remember that India's forms just 2%, it's about $6 to $7 billion. India exports just about 2% of the total auto components exposed to the US, which is about $300 billion in a year. So small fraction, limited impact, that's what the story is emerging at this point of time.
Thank you, Tushar, for getting us the details. So that's the overall analysis internally as to what sectors could see an impact. But also, let's welcome in Aurodeep Nandi, India economist and executive director at Nomura India, to understand what his number crunching tells us. Aurodeep, good afternoon and welcome to the show. My first question coming to you is, clearly, India stands out as having much higher relative tariff rates and thus is now exposed to reciprocal tariffs as well. If you have to look at India's trade surplus with the US, it's absolutely low as compared to other Asian peers. I think we're sitting at almost around $46 billion versus a China, which is almost 300. And with that, if you talk about the weighted average tariff rates that are imposed on US imports by India, that is 8.5% versus tariff rates imposed by US is 3%. Taking this entire math into consideration, where do you see India standing now?
I mean, look, firstly, we need to figure out where the US stands in all of this. So as you had flagged earlier, is this a negotiating ploy? Is this, or is this going to happen for sure? If India and the US agree on a trade deal later, which reduces India's trade surplus with the US, will some of this reciprocal tariffs kind of be taken out? So that's one. The other confusion which is there is this whole MFN, most favored nation clause, right? So the MFN clause essentially says that if I, as a country, give you a concession in trade, then I need to give that concession to all my trading partners. Now, this whole reciprocal tariff across countries essentially throws the whole rules-based framework of global trade out of sync, because and India could say, all right, US, I am reducing my tariffs with respect to you on, say, dairy, but may not be as open to doing the same for other countries that might flood in to India on that particular commodity. So one, I think it's important to understand sort of where the dust will settle. Also, let's not kid ourselves. This is a complicated process. There are the customs codes run into like 8 digits or more, and for each one, there is a separate tariff rate. So for the US to do this reciprocal tariff across countries means it's a massive exercise to do. It's one thing to sort of impose it on a sector, but if you're actually planning to map each, say an auto component, and then you map it to what India is charging and then charge similarly, it is a pretty huge exercise. So I think there are some questions in terms of how this will finally look like. I think as far as India is concerned, India and the US share a sort of strong strategic relationship. Yes, India has a much lower trade surplus with the US vis-a-vis other countries, but President Trump has flagged India in the past and currently as a tariff king, and has been quite critical of this. So I think there is a sense where India needs to act. And I think India was already starting to act even before all these reciprocal tariffs, right? In the budget and proposals in the run-up to Prime Minister Modi visiting the US, I think India was already looking to reduce tariffs on certain areas which matter to it. And I think at some level, India will also be trying to look at this from the perspective of its Make in India initiative. So can I get cheaper inputs into the manufacturing global value chain? So I think there are lots of different angles to this. But as of now, there is a lot of uncertainty on how it will roll out.
Right. Auradeep, Mahima also joining in. I just wanted to understand that, as you rightly mentioned, because each line item in the Customs Act will have to be seen with respect to this tariff hike. But, in the first read through, what do you expect, as to, with respect to these tariff hikes, how consumer prices will fare? And secondly, if this comes into play, how do you, assess the overall availability of goods in India as well as in US? Because both, right now have a good, import and export relation.
Sure. I mean, so as you mentioned, the big delta for India in terms, so reciprocal tariffs essentially means if I have 25%, you're going to charge me 25%, right? So the differential between what US tariffs are in India, what Indian tariffs are and US tariffs are, because India's tariffs are higher, that delta is what needs to be looked at. And for especially food items, for textiles and clothing, for transport equipment, it's pretty high for India. But remember, there are also areas where US would want to import into India, and India doesn't, export in that. So it could be that, I don't know, let's say almonds, right, where US exports a lot of that to India and might be a target place. But a reciprocal tariff may not cover that aspect because India may not be exporting that much back to the US. One is in terms of the cost side. I think the cost pressure could be pretty high for the US consumer because that's the first hit that's going to happen, right? And you're doing this across the board, across countries. The eventual, I think, ambition is that manufacturing shifts back to the US, but I think in the short term, that is a major risk. For India, actually, it's if we allow cheaper imports on the finished goods side, right? So I don't know if you're looking for a Harley Davidson, it might be cheaper now, right? If you are one of the, if you're bringing in inputs for your manufacturing plants, then so it could be say electrical machinery, industrial machinery that could could get cheaper if India brings down its reciprocal tariff. Also, I mean, as far as oil is concerned, I mean, there was talk yesterday about US being the one of the top sort of supplier of oil to India, which would then supplant Russia. So from a trade deficit side, there might be just some exchange that's happening. So overall, it may not be a big hit to the current account. And the other thing is that let's not forget when US and China clash on trade, that actually generates much more opportunities for countries like India to sort of capture a bigger part of the global value chain, because increasingly you will have foreign companies that will be realizing that it's because of these trade wars, it's going to be more expensive, more restrictive to import from China, and instead try to look at India as an alternate destination. I mean, note that there is a difference in the way China reacted to tariffs and India has. China imposed retaliatory tariffs, and India's reaction is, let's sit and figure this out. So there are opportunities for India in all of this too.
Right. So, Auradeep, my question then comes to you is, do India's domestic policies or are they capable of handling adverse impact of US tariff hike?
It's difficult to say for now because you don't know what it's going to be, how this is going to look. And the other thing is that it's not like India is the only one getting hit. So it may be that a lot of countries, once this sort of percolates through, India may still be relatively competitive in that aspect. So it's the American consumer that might be the loser in terms of higher prices because of the tariffs. But it could very well be that an Indian auto ancillary manufacturer or say a pharma company might still be more incrementally competitive compared to its global peers. So it's very difficult to say. And again, we don't know how much of this is going to actually sort of follow through, because you don't know how much of this is going to be just a negotiating tactics too. So it's actually difficult to say at this point.
Auradeep, maybe it's too early to assess this, but do you think that, I mean, if yes, what could be the broader, implication with respect to global trade when, these tariff hikes are implemented?
So as I said at the start, this sort of completely uproots a lot of this, the global trade norms. There is a reason why tariffs are higher in developing countries compared to the US, because the whole idea was the developing countries need trade to develop. Right. So what President Trump is trying to say is that time's up for all of that. Right. So if you're going to charge so much, we are going to charge equivalently. Also, in terms of, as I said,
already we are running out of time on this. My last question coming to you on this is, very quickly, is India then exploring options to actually strike a deal with the US? Because that was something that you mentioned in your report as well ahead of. Over the medium term, is this just going to be a plan so that the engagement is better and the deals are much more attractive for each other?
I think US is an extremely important strategic partner for India, and India is for the US as a counterbalance for China. So I think definitely a deal would be something that will be looked into, and ultimately it's about shrinking that trade surplus. So it may not just be a tariff play; it might be more of defense buys, more of oil buy, and then also a little bit of rejig on tariffs.
Right. So I think this is going to be interesting to watch out for as well. Thank you, Auradeep, so much for giving us your understanding and how things could change from here on, not only with regards to India, but the entire global trade cycle, right? A lot of things will see that churn that would be happening, but it's going to be an interesting watch.
Absolutely. And, in fact, a couple of things that, really need to be answered include that, are any sectors that could benefit from China plus one here, or with respect to the US CPI, that's kind of significant jump in Jan. Now, also let's hear out experts' view on impact on Trump tariff tantrums on India, from top market voices to industrialists and more.
I think it's too early to come to any conclusion. In fact, the reciprocal tariffs that Trump signed off on today probably not going to take effect for another 6, maybe 8 weeks. And so it's just a wait and see.
Not a big fan of the tariff agenda, but that's, it's probably not going to have that big an impact if, the negotiations continue the way they look, where you get some concessions, you delay tariffs, they're not as harsh as anticipated.
The reciprocal tariffs have been announced, but they are not in that sense country specific. This is the global approach that Trump administration has given, that reciprocal tariffs will be applied to those countries.
When you look at the Hindalco India business, we hardly export any metal to the US. Most of our exports go to the Asia side. So at this stage, we do not see a big negative impact on Hindalco, but we'll have to wait and watch. Currently for Novelis, it's a neutral to positive type of an outlook.
The outcome of India, US would be very positive for Make in India kind of initiative.
Very, very paradoxically, US's entire play is actually to hurt China the most. And China would be least hurt, and of course, US would be sort of much less hurt, given the hegemonic power that they have. It is true that most other countries will be majorly affected because of this.
In fact, the details of reciprocal tariff is not much clear. Traditionally speaking, reciprocal tariff means that if on a product I am charging X percentage of tariff, the counterparty will also charge X percentage of tariff on the same product. This is a little impragmatic because if you are looking into the trade, normally trade happens into the complementary product. So if I'm exporting to US a product, US need not be necessarily exporting a product to me.
As Honorable Prime Minister has already said that Make America Great Again is a very respected target, but Make India Great is also equally important. So we will be playing on our strengths. We will be required to bring efficiency into our systems, to bring down our cost of production, so that we remain competitive in the American market or any market whatsoever in the world.
All right, so that were the views with respect to the top market voices as well as the industrialists, Hiral. But we're completely out of time on this edition of this special show on Modi and Trump meetup. But stay tuned to NDTV Profit. More news and updates on the other side.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Welcome back. You're watching India Market Close here on NDTV Profit. And we have with us Sandeep Agarwal. He's still with us, fund manager, co-founder at Sovilo Investment Managers. Sandeep, we spoke power. And I want to try and shift focus on consumption now. How are you playing that theme? And how are you looking at it? With what lens? Are you at all constructive, or what's the view?
So, consumer, as you see, it has corrected a lot, and also there has been a good reward in the budget, in the sense that till 12 lakh there is no tax. So obviously all these things trigger and help consumption, but we still don't know how much more damage quick commerce is going to do. And we have seen that consumer has not done well for quite some time. It has underperformed. So time correction has been happened, but we still don't know how much of PE de-rating can happen. The sector seems to be safe in this turbulent market, but finally, in long-term stocks do perform based on their earnings visibility and growth. So I think from that perspective, still there is little more time before we start looking at them in terms of accumulation.
Okay, and Sandeep, the other small question would be, I don't know how closely you track that space, of course, but chemicals, they promised a lot this quarter. At least everybody was hopeful, and the numbers have been very, very weak. Now, the question only is this, that it's not that the cycle had turned. People were just expecting it to turn. Maybe it turns the next quarter. What have you gauged from the con calls and from the reportage that has happened thus far?
So as Neeraj, you rightly mentioned, no one was expecting a turnaround, but bottoming out was called out. But the way, after Trump taking over and the way tariff war has started, the challenge which we are facing is that China will have to dump its production. And that is the worry today everyone has in mind. No one is worried about, otherwise on the demand, but the dumping which can happen and how it will get routed to different countries is something which everyone is worried. So I think, that is the cause of the worry. That is the cause of the reaction which you are seeing.
You reckon that therefore the pain in chemicals will continue, Sandeep?
I will not say that it has ended.
You will say that it's not ended. Okay. Fair call. Okay. We'll have one more question with you, Sandeep, if you can. Just hang on, because I want to talk to you about CDMO companies as well. But it's the time of the show wherein we make you hear what is being heard on the street. If there is an appetite for that today, considering that people must be feeling really jaded with the kind of cuts that have happened at the broader end of the spectrum. Somit, I know we usually talk stocks, but maybe, just maybe, if you have picked up anything from dealing rooms around what's happening to specific pockets in terms of either flows or sentiment or both.
Well, if you look at the overall market sentiment, it's disappointing. Dealers are suggesting that there are no new buy orders. It's the same story that has been going on since Monday. No new buy orders coming in on the HNI desk. Dealers are also indicating that this kind of pressure could continue for the entire month as well. There could be some pullbacks, but that will be largely technical led. But no fresh large orders, buy orders are coming in from any of the larger desks, be it FI, DI or large HNI desk. Nothing new buy order. But yeah, dealers are indicating this pressure could continue for the rest of the month as well. Now, when it comes to consumer stocks like Nestle, Colgate, Godrej Consumer, Tata Consumer, dealers are indicating that some small buy flows are coming in from the DI desk. Not much of a volume action. In fact, even if you see at the volumes for these counters, it's less than 1 times the 1 month average. So not much of volume action for these counters, but small buy flows on the DI desk. Two stocks from banking names which are seeing some FI flows, HDFC Bank and ICICI Bank. Both these counters are seeing small FI small FI buying action on these counters. And lastly, what dealers are indicating is on Mahindra and Mahindra. Now they have today launched, they have opened the booking for their EV today. And dealers, what their channel checks are indicating is that the response has been very strong for the new EV booking unit, and hence this stock should be in focus as per dealers. They are suggesting that the EV registrations for the new EV has been very strong, and this is as per their channel check. The company has not come out with any notifications so far. Neither any analyst or broking house has come out. Dealers are indicating this, that their channel checks suggest strong booking.
Well, interesting one, Somit, and just to kind of call this out, because we've had this segment over the last month or so, and we've had a very good hit rate in this segment. So, Somit,
yeah, I guess we should not talk about it given how markets
spoil the show. Yeah, but we've got a very good hit rate, and credit to Somit for that.
Exactly.
Because really meaningful insights coming through, and a lot of those actually working. So thanks, Somit, for that. We'll go across Sandeep. Just before we went to Somit, Neeraj wanted to touch upon CDMO as a space, as a pocket. Is it looking good to you, and what could be some of the ancillaries within the supply chain which may actually benefit from a push with regard to CDMO if it were to come?
So, if you see globally from India's perspective, software, CDMO, pharma, software and auto are spaces where we always had strength. And I think to that extent, we always are able to find out innovative ways to make a mark there. So I am quite constructive on this space, honestly. And we believe that CDMO has a long way to go. And we are very, very constructive on the space. Only thing is that, we don't know when the actual numbers will start coming in. So it is a invest and wait kind of thesis. So when that is the thesis, then you slowly build up your position. So that is the way we are looking at the space.
Okay. Thanks so much, Sandeep, for joining us, for all of that perspective. Always a pleasure speaking with you. Let's though continue to talk markets. We have Kunal Shah as well joining us, Senior Technical and Derivative Analyst at Mirae Asset, to give us his views with regard to how he's looking at markets. Kunal, I want to first quickly have your take with regard to the index, and what is it that you're suggesting at this point?
Good afternoon, everyone. I think firstly on the technical setup, I think still the bearish trend is intact. I think last time we had a word last Friday with you guys, and Nifty was trading somewhere around the mark of 23,500, 550 zone. And a lot of people were expecting reversals from there, but I was of the stance that we will be sliding down lower 23,200, 300. Once that zone is taken out, we are heading for again to test the low of 22,800. And that is how exactly the market has played out. We believe that still a little bit of more downside is left for the market. We face rejection at the 20 DMA for the Nifty index, which is placed at 23,252. So till the time we don't surpass that level, the view continues to be on the negative side. The next level on the downside for the Nifty is what I see is 22,670 on the downside. So still, I think even whatever bounce you're getting, that should be an opportunity to again look for short positions. 20,670 is what I'm expecting for the Nifty in the short term. For the Bank Nifty index here, again, we have seen Bank Nifty in today's trading session has been holding the lows of Wednesday. That is on the lower end, 48,734. So 48,700, you can roughly say that's a support on the downside. Once that is taken out, then we expect further correction in the Bank Nifty. Bank Nifty could touch the mark of 48,000 on the upside. So for Bank Nifty, I think there is still some downside left even for the Bank Nifty index. Till the time we are not surpassing 50,000, no need to be on the bullish side. Rallies could be an opportunity again to go on the short side and look for targets of 48,000 on the downside.
Bit of a recovery while we're speaking about those levels. Kunal still hinting or let me change the question a bit. What's your sense? What's the probability like? Do you believe that it's still a sell on rise kind of a market? Is that how one should view it?
Yeah, I think definitely. I think see now a lot of people have been on the lower end has the bottom been made in Nifty. So one thing on the technical front that more the time the lows are tested, the more weaker it gets, and that is where we expect that to break. And probably in that break, we might make a panic bottom over there in that case. So for me, that panic bottom which is there in the Nifty index that is still left, you might see further downside coming in, and somewhere around the mark of 20,500, 400. Nobody knows where the bottom is going to be made. But we make that bottom on panic, and then probably we see a recovery. Now, the first sign is that the mid cap and the small cap space have already been butchered. They have already been trading in deep oversold territories on a technical chart perspective. So, firstly, you will see some kind of reversal happening out on the mid cap and the small cap space. In the meantime, Nifty would keep on correcting on the downside, and then eventually everything will move up. So my sense is that in Nifty and Bank Nifty, still the downside is left. Nifty can test the levels of 20,670 on the downside, and Bank Nifty could again test that low of 48,200, 48,000 on the downside. So I'm not expecting that Bank Nifty might break the level of 48,000 on the downside. That could be a somewhere point where Bank Nifty could make support around the mark of 48,000. But Nifty, I feel still there is downside left. 22,670 is what I'm looking on the downside.
We've jumped, and as we speak, we've jumped 150 points on the Nifty from the day's low. So a little bit of all that selling is getting bought into, it seems. And across indices, you're seeing that, but the Bank Nifty is leading that. Let's pull up the Bank Nifty one more time, and let's also look at the constituents of the Bank Nifty. You're seeing ICICI Bank lead, but you're also seeing some bit of buying in some of the other counters. Swami just spoke about how HDFC, ICICI is seeing buying, and maybe that's reflecting, in fact, as we speak. Okay, Kunal, while we are at it, and while we take all of those views, how do you sum it up? What are your picks for this afternoon?
I think I'll go with two recommendations, one on the buy side and one on the sell side. The buy side recommendation is Bharti Airtel. I think the structure remains positive in a weak market. High top, high bottom formations have been happening since the last 3 to 4 trading sessions. Already we have witnessed a breakout, so this has to be continued on the upside. So that's a buy. 1750, 1770 should be the target on the upside for Bharti Airtel, and stop loss should be placed at 1680 on the downside. The second is on the sell side, and that is from the pharma space, and that is Glenmark Pharma. Already the stock has given a breakdown below the swing low. Your fresh short positions have been added in today's trading session. Any bounce would be an opportunity to sell into the stock. Keep a stop loss of 1400 on the upside and look for downside targets of 1280 to 1270 on the downside.
Okay, well, let's take a look at the top 3 stocks on our radar today. Rucha Johnson with the list of those. Rucha, I mean, you'll be spoiled for choice, I presume.
Yeah, very true, Neeraj. But my top 3 stocks are number 1, FACT, which is thumbs down, intraday low of 9.3% on the back of its third quarter earnings. Revenue down about 13.5%. EBITDA down about 27% in absolute terms. Margin at 3.3%. Again, lower than same time last year. All this on a YOY basis. Net profit also down about 73%, but as we can see, stock has slightly recovered from its day's low, but still down about 6.5%. Next is SDB, and again a thumbs down in this kind of market. Intraday low of about 4%. Revenue up 24%. Margin came in at 69%. Slight bit of an uptick from same time last year. Net profit also up about 8%, though you can see that this is actually up on a YOY basis. This is lower than the estimates, and that is why the stock is tumbling down. Although as we can see, recovered slight bit from the day's low because of the recovering market overall as well. Last one on my list is Titagarh Rail, again on the third quarter earnings. A thumbs down over here, hit an intraday low of 6.3%. Revenue down about 5.5%. Margin came in at 11.1% versus 11.6% on a year-on-year basis. So again, a kind of degrowth as we can see over here. And net profit also down about 16% here as well. Stock down about 4.6% right now as we can see. Again, recovery based on the broad overall market recovery, but these 3 stocks are definitely thumbs down on its bad third quarter earnings.
Yep, certainly looks so. And a lot of correction moves out there. You know, actually some of these railway companies, Titagarh Wagons, started off a rally from 400, went up all the way to 1800 or 1900. From there, the price has just collapsed really. 4.6% lower, 811 currently. Bring up the 1-year chart, and I think you will see Titagarh having come off, or maybe slightly more than 1 year, but yeah, the 1-year chart gives you the example, right? Look at that peak and the trough. It's been a really sharp downtake, you know, and it doesn't quite show the actual fall, if you will, simply because it had risen from a particular level. But from the peak of 1800 to all the way 800 now, Titagarh has not had a really good run. Would be true for a lot of other PSUs into defense and railway stocks. Kunal, how bad do these charts look? I mean, do any of them look like they are near some long-term supports or anything? You may not buy them, but just want to understand the support levels for a Titagarh, a Texmaco, you know, any of them.
Yeah, I think overall, as you have seen that the correction has been very sharp in the entire space. So definitely pullbacks cannot be ruled out. But again, on the lower end, if I talk about first for Titagarh, the support for the stock on the lower end was placed at 785, 780 zone. So we have seen multiple bounces from those levels earlier. Today's low is 790 and 785 is the support zone on the downside. So again, at a very critical support zone, if the market has a pullback from here, I can see this could have a pullback as well on the upside towards the 20 DMA. That is placed at 923 on the upside. But I think again for these all stocks, pullbacks would be an opportunity to again look on the exit side.
Okay. The other one, Kunal, is and you know, I think viewers just keep in mind we're getting somebody who looks at investing public money into small caps and mid caps as well in just moments from now. So there'll be an interesting conversation. But Kunal, the other one is, of course, what's happened to some of the chemical names, right? And what are the bottoms that you see? So Deepak Nitrite is the case in point today. I'll add to that maybe a resilient Gujarat Fluorochem, which largely has been resilient relative to others. And I'll throw in maybe a Vinati Organics there. 3, possibly some of the more liquid names.
I think firstly talking about Deepak Nitrite, so I think absolutely on the weekly chart, it has given a breakdown on the weekly 200 and the 100 SMA. So that's on the bearish side. The next support what I see for the stock is around the mark of 1690 to 1700 zone. So still from the current levels, $200 is left on the downside for Deepak Nitrite. Vinati Organics over here, again, the structure has been weak, low top, low bottom formations are there. The next support, what I see for Vinati Organics on the downside is at 1460, 1470 mark. So again, from the current levels, if you see 100 to 130 points downside is still left for Vinati Organics. And fluorochemicals, if I see over here, this has been more resilient for the stock perspective. But I think once it breaks above the mark of 3,900 and we close above it, then we could say that the rally could continue on the higher end. Currently, it is trading in a sideways trend. 3,900 is a strong resistance for the stock. If we don't surpass that and again we trend on the lower end, then we might test this support zone of 3,100 on the downside.
So those are some names and some numbers which you may want to keep on your radar. But Nikhil Rungta joining us, co-CIO at LIC Mutual Fund, largely takes care of the small cap fund at LIC MF. First off, great having you, sir, on a day like this. You're seeing 3.5% shaved off the benchmark small cap index. What is it you believe is the big concern for investors at this point?
See, what we believe is, as such, these are normal volatile phases. The concern is going on in the market that the valuation could be high. Small caps are trading at a very high valuation. Your large cap as a percentage or top 100 as a percentage of total market cap is 60% compared to 75% in the past. But let me give you some data. See, what has happened today is your large cap is just the first 100 companies. Your mid cap is next 150. But your small cap is 250 fund company and beyond. So we have 4,847 companies there. So these are just the issues which are going on in the market, that small cap are expensive. The large cap as a share of total market cap have come down significantly, but that's because a lot of new companies have got listed in this particular space. So as such, these are just volatile phases. The only thing which we ask our investor to is to keep calm, stay disciplined in these times. In fact, great investors are made during these volatile phases or when there is a correction in the market.
Mr. Rungta, I'll just like to extend that question. So you spoke about new listings coming in. There's also a viewpoint coming through that a lot of the new listings have not made very good money for investors, and they were in any case quite expensive in terms of valuations. The exits have happened. Private equity investors have made good money on those exits. Promoters also have done QIPs. And therefore, in general, was it an expensive time in your view? And how have you worked around your portfolio to try and insulate it at this point?
See, definitely the new listings have not made money, but that has been primarily the case which have got listed in the past 6 to 9 months only. The earlier ones have definitely made money. Also in the past 6 to 9 months, it's not that those guys have lost money. It's just that they are down from the peak. They are still above their IPO prices. And there are a lot of companies which are coming into the market at a very reasonable valuation. See, what are small caps? Those are today's number and tomorrow's story. So you need to start looking at them. What would be your number, say 1 year or 2 years down the line, not yesterday's number. That's why these are high growth companies. That's why these are small caps. If it's a large cap, then you need to take care of current number. But if it's a small cap, it's definitely a growth company looking forward to, say, next 2 to 3 years number. And that is where we look forward to, like, how would those numbers be? Coming to how we are changing our portfolio, we are definitely looking at the valuation. What we follow is growth at reasonable price. See, people talk about valuation, people talk about growth. If a company is trading at, say, very, very cheap valuation, but there is no growth, it will not give me a return. If a company is trading at a very high growth, but it's also at a very high valuation, then I'll not make money. So the companies, the script should have the blend of both growth as well as valuation. So what we follow is growth at reasonable price. The GARP model is what we follow.
Nikhil, good afternoon. Neeraj here. now the opportunities of growth at reasonable price would be a plenty, right? Relative to maybe a couple of months ago. But the sentiment is sour right now. So if you are also putting money to work, are you spacing it out, Nikhil, currently? And if so, what is it? I mean, is it that invest 10-15% right now and see, give the market time? You may be buying it higher, which is fine, but at least you kind of spreading it out.
So definitely, we don't see much downside from current levels.
Nikhil, we're talking about the small caps right now. You don't believe?
Yes, yes.
Okay.
So say index is down in the range of say 17 to 20 odd percent, but when we talk about individual scripts, they are down in the range of 40 to 50%. The valuations are very tempting as of now. See, there would be scripts which are still expensive, but let me give you this number. I mean, when we talk about small cap space, we have 4,847 companies in small cap space. And when we talk about the valuation or the expensive number, we talk about these indexes, these small cap indexes, say Nifty small cap 100 or Nifty small cap 250. These are index of 100 and 250 company. Hypothetically, let's assume the entire index is expensive. 250 companies all are expensive. But I have a universe of 4,847 companies. Let me remove those 250 companies from there. I still am left with 4,600 companies. I'll have to cherry pick those 10 or 20 script from this. Not everything is expensive. So there are a lot of opportunities available in the market. And in the times like this, it's basically we get a lot of ideas in this type of market, plenty of ideas in fact, and we have to cherry pick which one to look forward to.
Nikhil, obviously you are a mutual fund, so I don't want to talk stocks with you, but I would love to understand what themes do these reasonable valuation or good valuation ideas exist in? I mean, what sectors, what themes?
So see, currently we are in that phase of the market where your sectors or theme doesn't work. What works is micro things, in the sense individual script specific. We are in that phase of the market where your stock specific returns, your stock selection skill will matter. Just to give you an example, say we are bullish on IT, but in that we are more bullish on the AI and automation type of thing rather than the traditional IT. And in that subsector also, we have around 5 to 6 companies. Not everything will run, only 2 to 3 in that will run. We are bullish on pharma. There are 7 to 8 companies, but bullish on pharma, but in that we are more bullish on the CDMO part of the pharma. So in that also 7 to 8 companies are there. Not everything will run. So we are trying to go as micro as possible. So we are in that company specific market wherein your bottom up approach will be working. The top down approach, actually, when we talk about the top down approach, you take into account your macro numbers. And when we talk about the macro numbers, there is a lot of uncertainty in the macro numbers, be it of India, be it of global. So better to go bottom up as of now in this type of market wherein you have the full, conviction and confidence on the scripts which you are buying.
I understand, Nikhil, but because I can't talk specific stocks with you, like I would love to know within CDMO, do you like a Newland or Laurus or Divi's or something else? But because I can't talk that, I'm at least trying to figure out the universe of companies that you may like, right? And then our viewers or whoever wants to can do some basic research out there. So what is the top overall? Let me put it that way. If you get capital right now and you are saying that there is not much downside, which means that you might be deploying large pools of capital right now as opposed to small percentages. Where is the capital going the max? Is it in CDMO? Is it in AI focused IT companies? Or is it some other sector?
See, given today's market, today we are seeing a lot of these pharma and CDMO names going down drastically. So today probably I'll put money there. But there are a lot of companies in the IT. And if I talk about the infrastructure and CapEx part, in the past 6 to 9 months, they have been beaten down drastically. Of course, if I talk about MNC players there, their multiple have corrected from say 80, 90 odd levels to 50, 60. Still they are expensive. But if you talk about the domestic names there, then the multiples have come down to as low as 10, 15 as well. So there are a lot of opportunities there. Earnings are coming in. What we are trying to focus is let earning be there. If earnings are there, I don't mind investing it today, be it in CDMO or be it in AI or automation.
Okay. And so, what about redemption pressure? Are you seeing any of that at this point?
See, as of now, we are not seeing any redemption pressure.
Okay.
One thing which I wanted to say was, see, where we have the MFI data which came out, the cancellation of the SIP, primarily what we believe is these are happening in those direct SIPs which have come into the market through various platforms. The ones which have come via the distributors, via the partners, are not seeing as much cancellation as the direct SIPs, because here your distribution partners are helping them out that the disciplined approach in this type of market is very useful. For the direct ones, there is no support, and that is where we are seeing a lot of cancellation. But in our scheme as such, or in our AMC, we are not seeing redemptions as of now.
Okay.
In fact, just to give you a brief, since last 1 month, as we saw in the MFI number also, the inflow in the small cap schemes have been amongst the highest. Monthly inflow in small cap schemes have been amongst the highest. Similar type of thing we have also seen.
Okay, understood. So last quick question. How quickly are you utilizing cash? What was your cash balance at the start of this? Where are we currently?
So at the start, or say if I have to talk about, say 3 months back, we were at around 3% odd.
Okay.
Today, if I have to talk with you, I am still at 3% odd.
Okay, noted. Noted. Okay. Interesting time, sir. Thank you for coming and speaking with us. That's, of course, Nikhil Rungta of LIC Mutual Fund talking to us about small caps, because that's where all the focus is. But let's start talking specific stocks again. Bull versus bear on Concord Biotech. Stock down 20%. Puneet here to break down that bull versus bear for us.
Well, thanks for that. Definitely, a quarter not gone right for something like in Concord Biotech, but more so based on valuations, we're seeing that kind of correction come in. But let's look at the first bull and bear case. Of course, EBITDA margins were impacted, down 390 basis points to come in at 40.4%, and that was one of the bear cases. Now, while the company has mentioned that revenue has also just come up with a growth of about 1%, most of the lumpiness is because of procurement issues by the customers. So they've deferred purchase over to the next quarter, but the company has mentioned that this is not lost revenue in terms of business. It is just delayed to the next quarter, and that's something that the company has mentioned over the past few quarters as well, that revenue isn't lost for them, it's just deferred to the next quarter, and that's one of the key aspects. So while we've seen lower revenue growth and also higher cost in this particular quarter, it might not be that the business conditions also have changed in terms of revenue. When you look at the second bull and bear case, it is of course the formulation business that has been driving the growth, up 42% in the first 9 months, and that's roughly about 25% of the total revenues for Concord Biotech. That's been driving the growth. In this particular quarter, we saw a slowdown there, just 1% growth. But the API business, which forms the majority of the 3/4 of the revenue has, the growth has slowed down to just about 3% in this particular quarter, and hence no growth in terms of revenue versus estimates as well. When you look at the third aspect is, of course, the company's valuation as well as the CDMO picture. So valuation is at 36 times price to earnings for FY26 is at a premium versus its other peers. But the formulation and the CDMO business are the new ones and new verticals that the company is expecting to grow over the next 3 to 5 years, and specifically form that kind of guidance. And that's where I come in, because management has guided for a 28% CAGR of growth in terms of revenue over the next 3 to 5 years consistently, and that will come from the formulation business as well as the CDMO business. But the guidance is of course based largely on the CDMO vertical. While the company has not mentioned any kind of split, it is expected to have roughly about 1/4 of the business revenues for the CDMO business, and that forms roughly 0% of the current revenues. It's still into developmental phase where they are looking to partner with other clients. So while the company has steadily performed very well over the past year or so, this quarter has been a miss across the revenue as well as higher cost of employee cost, up almost 12% while revenue was deferred. So certainly things not right in this particular quarter, but management guidance as well as continuity of new verticals such as formulation as well as CDMO will be something to watch out for on the positive side.
Okay, so it's a comprehensive bull versus bear from Puneet. Thanks so much, Puneet, for getting us that. We'll slip into a short break. We'll have Neeraj Diwan on the other side to give us his views, along with, of course, top BTST recommendations coming your way. Stay tuned.
entire special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Back with India Market Close right here on NDTV Profit. If you saw the index, Nifty Small Cap Index down 3%, you wouldn't dare call it a bit of a recovery, but we're seeing that. From 4% down to 3%. The Sensex, in fact, is now just 0.25% lower. And the Nifty IT is on the verge of breaking into the green. So there is some bit of an uptick that has happened in the last few minutes of trade, for whatever it may be worth, really. But yes, there is. Nifty IT, look at that. Nifty IT will come up on your screen, about to break into the green, which is actually, well, not bad. But of course, there's still pain out there. We joined by Neeraj Diwan, independent market expert, and Kunal Shah, of course, is still with us. But Kunal, just a question before I go to Neeraj, a question to you. I've heard you say earlier that this is a market which is sell on rally. Is IT looking slightly different there, because this index is absolutely flat currently?
Yeah, I think if you look at IT, Neeraj, I think overall the structure has been low top, low bottom that has been forming. Now IT has a very important support at the 200 at the 200 DMA. I'm sorry, which is placed at 40,400. So IT index currently is trading somewhere around the mark of 41,300. And in the last 6 to 7 trading sessions, we have seen continuous negative closing for the IT. So I think tomorrow, Monday could be a crucial day for the IT space. Either we test that 200 DMA on the downside, which will probably make a support out there at the 200 DMA, which will also help Nifty to make a panic bottom on the lower end, and then we can see a recovery. Case 2 is that if market has made a bottom in today's trading session, then we might see IT again leading the rally on the upside, and we can go towards the mark of 43,000, 42,500, 43,000 on the upside. So I think for IT, it is trading at a very critical support zone. If the 200 DMA is free, then we will say the trend has been reversed. But till the time it is sustaining about this 200 DMA, my view remains bullish on the IT.
Okay, Neeraj Dewan with us as well. Neeraj Dewan, is this scaring you, or are you sensing an opportunity here?
Yeah, good afternoon. Yeah, definitely for an investor, also these kind of times are scary because you don't like your portfolio getting hit by 15-20% just in a matter of few days. So definitely the screen is looking scary, but these are long-term opportunities also, because we've all been talking about high valuations since last August, September, that valuations are very high. These can't sustain, so market need to correct. So now we're getting that opportunity, that correction that we were talking about. And you've seen that so many times earlier also. Whenever the market is doing these kind of corrections, mid and small cap definitely get hit more, and there is a lot of pain there. So you have to go through this pain, even in some of the good companies which are delivering, which are performing well, which are delivering quarter on quarter, but still the pain will be there even when the bottom formation happens in those kind of companies. So I think I'm sure that when you look back after a year, you will see that this was a good opportunity to accumulate some of those good names. So there is opportunity, and one should be looking at very specific opportunities in this mayhem, in this correction that we recently see.
Okay. Neeraj, how long do you expect that this will go on for? There's been, of course, a bit of pain that we've seen already. We are in about the 20% from the high. We're down in about 20% from the high. More pain, is that what you are building in for?
See, one thing is we've seen again and again, you can't really catch the bottom. You can't really figure out, okay, now this is the bottom or this is the maximum the market can fall. What you can look at is only opportunities and valuation. So if you feel there a particular stock that you've been tracking, you've been looking at, they have corrected enough and there is a case for buying those stocks, you should start accumulating those stocks. Market may have bottomed today, no one knows, or market may bottom after another a few hundred points, the Nifty. That is something which is very difficult to predict. But as far as a major part of the correction is concerned, it looks like whether the small and mid cap space is concerned or whether it's the large cap space is concerned, I think the major part would have got over. So there's a possibility if some news flow comes which gives another hit for a day or another leg down, that no one can really predict. But I think that with a good you would have got good prices in certain stocks where one should be looking at opportunity.
Okay, so opportunities galore, at least so it seems. But again, shifting focus more towards tariffs. Exports to the US trading in the red, but not sure whether it's just in trend with the general market. Likely it is. But which are these stocks that you want to keep your eye out on, which you want to keep on your radar, and whether they're actually relevant? We'll have a conversation on that. But Mika's here first with the list which is relevant.
For throwing a lot of stock names, but all the data is the exposure of the companies to US as of FY24 revenues. Up first, you have the pharma sector. A lot of these companies have significant exposure to the US. Up first, you have a Dr. Reddy's at 46% from US, Lupin at 37%, Sun Pharma at 32%. You also have a Cipla at 28% exposure, and Torrent Pharma's 10% revenues in FY24 came from the US as well. In the auto ancillary space, you have something like a Sona BLW, 40% of its FY24 revenues from the North America region. The same thing for Samvardhana Motherson, 18% of its revenue from the North America region, whereas Sansera Engineering, you have 10% revenues coming from the United States in FY24. In the forging space, you have something like a Bharat Forge, 25% exposure in terms of their top line. RK Forging, 58% exposure, but this is North America as a region, not only United States. In the tires segment, you have a Balkrishna Industries, 16% of their FY24 revenues did come from the United United States. In capital goods, you have something like a Shilza Tech, 21% from the North America region. And in solar manufacturing, you have a Waaree Energies, 50% of the FY24 top line did come from the US exports, but they do have capacities on stream. And I missed a slide, that was Tega Industries, they have 15% US exposure in the engineering space. And then we have some textile companies which do export to the US, whether it's just materials or ready-made garments. You have something like an Arvind, Wellspun Living and Trident, as well as an Alok Industries, Raymond and Gokaldas exports that makes ready-made garments and exports them to the US. And lastly, you have 3 companies, PI Industries, UP and Jubilant Ingrevia, which make these 5 major molecules. And these are the top 5 molecules that the US imports from India. So we also have these counters in focus.
Okay, so all of those, maybe something you may want to keep your eye out on. Thanks so much, Mihika, for bringing us that very comprehensive list. Absolutely no need to be apologetic because we need that entire comprehensive list. But, while we're at it, Neeraj Diwan, would you look at this in negative light at all? The fact that there is a possibility of US tariff and there's plenty of chatter that India will be one of the worst placed when you're looking at the list of countries and the impact. India may just be the worst placed. Your sense, and what would you be cautionary on therefore? Would you at all play your investments on the basis of this?
See, there's already too much talk about this. So before anything is really imposed, there's already so much negativity, so much scare, which has already come. So I don't really want to talk specifically as to how much tariff can come, what companies can get impacted. I think let it come now. Let's see how it comes and then we'll take a call. But if you're buying something fresh, or if you're, then of course you'll keep that in mind that, how much impact can be there because of tariffs on your particular company that you are buying right now at these levels. And even if you're holding something, there also, you like to prune and you would have waited now to do it. If you're tracking a stock, you'd have already done it 1 month back or a few days back only. So I think if that would have already happened and some of the names which may get impacted or which are exposed, and and there'll be certain sectors like pharma, which I feel the pharma kind of a sector may be spared of the tariff wars. That is the kind of indication also we're getting. So one can be some sector specific and stock specific. You can keep this in mind, but I think that would have already happened in most of the portfolios which are keeping a track on.
Okay. Kunal, just wanted your quick take, and I'll suddenly switch over to micro. Talk about a little bit about an REC or PFC, the fall that we've seen today, a bit of a recovery also likely that we're witnessing. What's the sense like on these 2 counters? Because from the highs, they've fallen quite a bit. So just your quick view.
I think firstly I'll talk about PFC. I think yes, the correction has been brutal in REC PFC as well. Now the lower end support for PFC, what I see on the downside is placed at the mark of 350, 360 zone. The weekly 100 DMA average is placed at 360. So we are at a very critical support zone for PFC and REC. Any sort of reversals from these levels could see a good rally on the upside. I don't see any reversal right now, so no need to be bottom fishing at the current levels. And if I see any signs of reversals around the mark of 360, 370 for PFC, that would be a good opportunity to go on the long side. Similar is the case for REC as well. REC also has been forming lower top, low bottom formations on the downside. If one wants to be going on the long side, I think one needs to wait for a breakout above 430, 432. Now that is where the 20 DMA is placed. Once that is taken out, then we can see that the bottom has been formed, and we can see further upside towards 538, 550 levels on the upside.
Okay, all right. Now, of course, Valentine's Day, and we all here in the studio as well as in the newsroom wish you all a very happy Valentine's Day. Hope you all have a great evening. But if you're running out of ideas, especially gift ideas, and you've just got 10 minutes to cover yourself for that, no chocolates or flowers, of course, but just pure investments. Rucha's compiled this list of stocks which can be a potential gift for your Valentine. Over to you, Rucha.
So this Valentine's Day, let's think of a stock that which you can give to your Valentine. So we've brought you 11 stocks with an upside potential from more than 50% to up to 110%, and which are tracked by at least 10 analysts according to Bloomberg estimates. Let me start with the one having the highest upside potential. It is Cyan DLM with a 12-month target price of about 900 rupees and an upside potential of 110%. Next one is Prince Pipes. 477 is the target price, upside of 66%. This is followed by the realty stock, Suntech Realty and CESC with the target price of approximately 727 and 205 respectively, having upside of about 63% to 65%. But if we can move on, we have upside stocks with an upside of from 53% to 57%. You can see we again a realty name Godrej Properties, we have a defense name Patents and REC, AB Capital as well, all having upside potential of up to 53 to 57%. But if we can also move on, we have Power Finance Corporation, Z Entertainment and Repco Home Finance, which have an upside of approximately 52% to 53%. So these are the 11 stocks, as I mentioned, which have an upside potential of from 52% to about 100%, with Cyan DLM having the highest potential upside, and this is according to the Bloomberg analysis.
Okay, well, Valentine's Day gifts, at least in terms of stocks. Thanks, Rucha. Well, I don't know if this will work out or no, but maybe Kunal Shah has a Valentine's Day gift on the downside as we get ready to shut shop. Kunal, what would the trade be? Would it be on the short side if one wants to take a trade for today to be squared on Monday?
Yeah, I think on the index perspective, definitely it is nice to have a happy weekend rather than taking any positions over there. So I'll not take any trade on the index perspective, but I'll give a stock recommendation as a BTST trade that looks attractive to me, and that is SBI Life. I think already 2 days back we had seen long positions getting built up in a weak market, and even today the stock has been sustaining at higher levels, that is above the 20 DMA, and it has even not reached yesterday's low as well in this volatile market. So I think here clearly the strength is visible. So this could be for a long trade, keeping a stop loss of 1447 on the downside and looking for targets of 1480 to 1492 on the upside.
Okay. Well, interesting. Neeraj Diwan, we obviously have to stagger out things, I would presume, in most cases right now, even if you want to buy, because the downsides are iffy to very accurately forecast. But I wonder if the view on chemicals has changed in that, because it was a sector that was showing a lot of promise, but the tariff wars, they've not even started and already Q3 numbers have looked wobbly. Would you stay away from the space for the time being?
Yeah, you're right that if anything has to be bought also, you have to stagger your purchases because you have to accumulate slowly. But as far as chemical space is concerned, one will have to be very careful what are the kind of stocks you're buying there. So one can be very stock specific there, though as generally if you see the sector can be avoided. But if you still want to look at a couple of stocks, maybe the ones which are fluorine, stocks there, I think still there is good potential as far as medium to long term is concerned. Short term, definitely, anything can happen in the shorter term, but medium to long term they seem to have good potential. But yeah, I agree with you that you better avoid the sector for the time being and see what kind of tariffs imposed, or if they are and at what level they can impact these kind of stocks.
Gujarat Fluorochem has guided to strong numbers, that the stock has stayed okay. Would that be the bucket would you look at, or something which has fallen so much in the recent past, like Deepak Nitrite, for example, today? One bad quarter, we don't know what the time ahead would be like. Would you avoid that completely?
I think I'll avoid that for the time being, especially when there are these threats of tariffs, plus even the numbers are also not good. I think those stocks can be avoided. But like you mentioned, Gujarat Fluorine or Navin Fluorine, these kind of stocks, Navin Fluorine numbers were good this time. So these kind of stocks can still be accumulated when they're falling now.
Okay. One stock Neeraj, since the morning, which has been in focus is Mannapuram. Just a really poor set of numbers. Stock down nearly 11%. Lots of pressure at a time when the other gold counterpart, Muthoot, has done ever so well in terms of both growth, asset quality, as well as margins across the board, demonstrating how it is a leader in a typical down cycle. And Mannapuram just reflecting that, the really poor numbers at a time when ideally they should be growing at a very, very fast clip given everything that's happening with regard to regulatory and gold loans. And therefore, begs the question that valuation mismatch is much warranted, right?
Yeah, and maybe that's why, you track the space closely, that's why the kind of divergence between the two, right? The question only is, will this continue much?
Yeah, absolutely. Neeraj, your preference with regard to some of these gold financiers, because one, gold has rallied, and two, there's significant divergence in valuations, and the growth that Muthoot is clocking is just fabulous in comparison to a Mannapuram. So, is there a viewpoint? Is there value in Mannapuram, or would you avoid at this point gold financing altogether?
Yeah, I would not avoid gold financing. I think Muthoot definitely is well managed with the kind of gold prices that are there right now. And I think Muthoot Finance can be one stock which can be accumulated. Manappuram, besides the gold business, they also have the microfinance business, which I think will still suffer even in this quarter. So I think Manappuram, one should wait and see, at a price, maybe, if it is really falling another 10-15% of these levels, one can still be brave and start accumulating at those levels, but not right now. I think let's wait as far as Manappuram is concerned.
Okay, wait for Manappuram. Okay, so now down 8, well off the lows of the day, but for a while during the day it was down at least 10 to 11%. So and 8% doesn't look pretty either. So that's one. I want to also quickly take a check with Kunal. Kunal, with regard to technicals, both on a Muthoot and a Manappuram, just your quick take.
Yeah, I think definitely if you look at Manappuram, it has been in a better trend. We had seen some rally on the higher end, but that has fizzled out quickly. I think, firstly, a very volatile counter, so still I can see any pullback could be an opportunity to look on the exit side. For me, the downside support is now placed at around the mark of 155, 160 zone on the downside, so it could come towards those levels. Contrary, Muthoot, I think here the setup has been strong. Art of high bottom formation still intact over here. The trend looks quite strong for the stock in the near term as well. So this could extend the rally towards the mark of 2380, 2470 on the upside.
Okay, so right, so those are some levels for you to look out for. But quickly on to what to watch. You'll have some macro indicators again coming through: US import-export prices, US industrial production, balance of trade for India, and import-export data for India as well. You'll have Japan GDP growth on Monday morning pre-market, and Asia may well react on the back of that, and you'll also have some cues coming out from the GIFT Nifty on the back of that. Earnings on Monday, ABB India to look out for, rather earnings today, tomorrow, and which will likely react on Monday. And then you have a slew of record dates with regard to interim dividend. Those are some names for you with regard to that as well. But Neeraj.
Well, I guess not too many cues in the near term. Probably wait for the medium term, and until then, with lack of triggers, try and hope that the global picture doesn't really become too awry. So that is probably the long and short of it.
Yeah, absolutely. Just want to quickly mark out a couple of other names and take views as well. What do you make of the move with regard to an ICICI Bank today, Kunal? Because on a tough day, it held fort for a while now, and now it's up nearly 1%, nearly at the day's high. Just give us a quick view with regard to ICICI Bank.
Yeah, ICICI Bank, if you look at the trend, has been very strong. In fact, in today's trading session, the stock has taken a support exactly at the 20 DMA, which is placed at 1244, and we bounced from those levels. So that's a positive sign. Monday could be a very critical day for ICICI Bank. If we see the follow-up coming in, then we will see even ICICI Bank reaching the 100 DMA as well. And again, that would mean that the trend will change for the stock, and we'll see further upside coming in. So below 1244, 1243, which is the 20 DMA, we see the trend getting changed. And any follow-up move in Monday's trading session could see a good rally towards 1300 on the upside.
Okay, thanks so much for that, Kunal, as well as Neeraj. Thanks for all of those views, and hope you have a great weekend. But let's quickly look at where we are on the Nifty. We're just a minute and a half from close. Let's quickly wrap this week up. 0.5% lower on the Nifty. We're down, of course, 115 odd points, but from the lows, and I'd look at the glass half full rather than half empty, 140 points from the lows. So definitely a positive where that is concerned. The recovery has been solid, and that's one key positive. Let's look at the constituents on the Nifty and the heat map. Of course, the breadth of the market, which was extremely weak at one point, still weak, but slight bit of improvement for sure. And I'll pull out some numbers, talk about them. 23 stocks down 1% plus, and you have just about 16 stocks down 2% plus. So that's how it's really stacking up on the heat map. Let's also look at sectors very quickly, and likely it's that pocket of FMCG and IT which is holding fort. IT for sure, we've seen a decentish recovery in IT. In fact, FMCG just about 0.5% thereabouts down. So we've seen a bit of a slip up where FMCG is concerned. What's not doing well? Pharma was down 3% in trade. Tariffs, one of the concerns. PSU banks down 2.5%, realty down 2%, and we'll just quickly pull up the weekly charts for some of these sectors. The 5-day, the current weekly charts if we can, and auto 1.5% lower as well. Let's try and zoom in on how the week has gone by. Nifty Auto 1.5% down. We've closed for the week, but nearly 6% down for the week. The pharma index, the realty index thereafter. And there you go. That's the pharma index again, 5.5% lower. So we've seen some real cuts, and the pharma index is down 3%. Of that is today. 10% on the realty index. So this is where a bulk of the pain also is, where broader markets are concerned. We've seen sizable correction where the Nifty realty is concerned, so those are three sectors for you which have taken a bit of a knock this week. Now, let's look at the advanced decline, move to broader markets. Well, the advanced decline, it's obviously tough, the breadth, but it improved a wee bit towards the end. So that's one positive. 250 odd to around 1960 declines. Let's also look at the Nifty mid cap and small cap, and let's look at them first intraday and then for the week gone by. The Nifty mid cap down 2.4% off the day's lows for sure. So that's again partly positive, but just about 180 points from the low of the day. So the bounce back has been decentish, but 450 points down from the highs. The weekly chart on the Nifty mid cap won't paint a pretty picture at all. It won't look good. We've seen a 7.5% cut on the Nifty mid cap index in the last 5 trading sessions. The Nifty small cap today, of course, we've again seen a bit of a bounce from the lows, 3.3% lower though for the day, and for the week it's down 10%. So the gash quite sharp on the Nifty mid cap as well as the small cap index. Last off, I want to cap the Nifty 50 index as well for the week, and the Nifty 50 for the week looking down just 3% in comparison, pales in comparison to how the mid cap and small cap have performed. So plenty of pressure, significant week this week. Let's see how next week really boots up, and we're hoping that markets start to see a bit of a recovery. But with that, from Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
entire special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
US President Donald Trump refuses to budge on reciprocal tariffs against almost every country in the world. India is no exception. India and the US will increase bilateral trade to $500 billion in the next 5 years. The allies also agreed to partner in AI, semiconductor, critical minerals, and fight against terrorism. The bloodbath in the markets continues. Small caps entered bear territory as they fell 22% from their peaks. Mid caps took a battering as well, but stopped shy of bear zone. The Nifty and the Sensex witnessed sell-off for the 8th straight session. Move over foreign ratings agencies. Market regulator SEBI is all set to appoint an Indian credit rating agency for risk return verification. This could happen within the next month, say sources. That's an NDTV Profit exclusive. Anxious customers queue up as the Reserve Bank bars New India Cooperative Bank from issuing new loans and suspends deposit withdrawals for 6 months. Supervisory concerns and poor liquidity position of the bank are the reasons for this move.
जब अमेरिका और भारत साथ मिलकर काम करते हैं, यानी मागा प्लस मीगा, तब बन जाता है मेगा पार्टनरशिप फॉर प्रॉस्पेरिटी.
Hello and welcome. This is Profit 360 on NDTV Profit, and I'm your host Mallika Mishra. Along the next half an hour, we will bring you the latest on markets as well as national and international news. The top story today: US President Donald Trump refuses to budge
On the subject of reciprocal tariffs, he reiterated that India imposes some of the highest tariffs on the US. Prime Minister Narendra Modi this morning met with Trump at the White House. The trade partners expressed support and resolve to jointly work together on a variety of sectors like artificial intelligence, semiconductors, nuclear power, and energy. The Prime Minister also stated that India would purchase fighter jets and other defense equipment from the Americans. The two state leaders also announced that bilateral trade between the two countries would touch $500 billion by 2030. Experts weighed in on the impact on Trump tariff tantrums on India, from top market voices to industrialists and more. Let's hear out what they had to say on this matter.
I think it's too early to come to any conclusion. In fact, the reciprocal tariffs that Trump signed off on today probably not going to take effect for another 6, maybe 8 weeks, and so it's just a wait and see.
Not a big fan of the tariff agenda, but that's, it's probably not going to have that big an impact if, the negotiations continue the way they look, where you get some concessions, you delay tariffs, they're not as harsh as anticipated.
The reciprocal tariffs have been announced, but they are not in that sense country specific. This is the global approach that Trump administration has given, that reciprocal tariffs will be applied to those countries.
When you look at the Hindalco India business, we hardly export any metal to the US. Most of our exports go to the Asia side. So at this stage, we do not see a big negative impact on Hindalco, but we'll have to wait and watch. Currently for Novelis, it's a neutral to positive type of an outlook.
The outcome of India-US would be very positive for Make in India kind of initiative.
Very, very paradoxically, US's entire play is actually to hurt China the most. And China would be least hurt, and of course, US would be sort of much less hurt, given the hegemonic power that they have. It is true that most other countries will be majorly affected because of this.
In fact, the details of reciprocal tariff is not much clear. Traditionally speaking, reciprocal tariff means that if on a product I am charging X percentage of tariff, the counterparty will also charge X percentage of tariff on the same product. This is a little impragmatic because if you are looking into the trade, normally trade happens into the complementary product. So if I'm exporting to US a product, US need not be necessarily exporting a product to me.
As Honorable Prime Minister has already said that Make America Great Again is a very respected target, but Make India Great is also equally important. So we will be playing on our strengths. We will be required to bring efficiency into our systems, to bring down our cost of production, so that we remain competitive in the American market or any market whatsoever in the world.
Nomura feels that considering the strong relationship between the US and India, imposing tariffs would not be the right answer. Aurodeep Nandi spoke to us earlier today, and he said that India is likely to bend and weather the storm.
This whole reciprocal tariff across countries essentially throws the whole rules-based framework of global trade out of sync, because and India could say, all right, US, I am reducing my tariffs with respect to you on, say, dairy, but may not be as open to doing the same for other countries that might flood in to India on that particular commodity. So one, I think it's important to understand sort of where the dust will settle. Also, let's not kid ourselves. This is a complicated process. There are the customs codes run into like 8 digits or more, and for each one, there is a separate tariff rate. So for the US to do this reciprocal tariff across countries means it's a massive exercise to do. It's one thing to sort of impose it on a sector. But if you're actually planning to map each, say an auto component, and then you map it to what India is charging and then charge similarly, it is a pretty huge exercise. So I think there are some questions in terms of how this will finally look like. I think as far as India is concerned, India and the US share a sort of strong strategic relationship. Yes, India has a much lower trade surplus with the US vis-a-vis other countries, but President Trump has flagged India in the past and currently as a tariff king, and has been quite critical of this. So I think there is a sense where India needs to act.
It is important to note the US accounts for nearly 17% of total goods exports for India. But what will the impact of reciprocal tariffs look like for us? My colleague Soumit is joining us with a breakdown.
Well, yes, if you look at the India-US trade, US accounts for nearly 17.7% of India's goods total export. But when you compare it with the other Asian economies, we are not that high. When you look at China's total trade surplus to US, it stands at around $295 billion, followed by Euro region, which stands at close to $267 billion. Then there is Mexico, Vietnam, Taiwan, which is anywhere in the range of around $74 to $172 million. But when it comes to India, it is just $46 million as compared to that of Korea, Japan, and Canada, which stands at anywhere between $64 to $69 million. Now, if you look at the key commodities that are being exported more from India to US as compared to US to India, these are the key commodities where these are the key commodities that India exports more to US. Electrical machineries, the trade deficit stands at around $11.8 billion, followed by pharma products, similar amount of trade deficit. Then there is pearls and precious stones, nuclear reactors, textile, where the trade deficit is anywhere between $3 to $6.3 billion, followed by products like multiple apparel and textile products, iron and steel products, organic, chemical, and vehicle, which stand anywhere between $2.2 to $2.4 billion. So these are the key commodities where there could be a chance of a higher tariff coming in, given the fact that India is exporting more of these products to US. Now, also let's look on the flip side, which are the products that we import more from the US market. Firstly, it's minerals and fuel. The total trade surplus stands at around $9.6 billion. Most of this would be towards gas, LNG as well. Then there is aerospace, which is around $2.7 billion, optical parts, edible food, fruits, pulp food. Not much of these products are coming in from the US to India. On the other side, if you look at, then there is chemical products, beverages and spirits, iron and steel, plastic, cotton, but the contribution of these products are not that higher. Now, if you look at the total excess tariff that India charges, in fact, that is the highest, around 8.5%, the second highest that we are seeing in the Asian countries. South Korea's total weighted average tariff stands at around 14.4% on goods that are imported from US, while that of India stands at around 8.5%. China has a lower rate of around 7.1%, Thailand 6.2%, Mexico 5.2%. As against this, US is charging a weighted average tariff of just 3%. So a clear differential of 5.5 percentage points is what we are seeing between the tariffs charged by India and tariffs charged by US. Now, let's look at the products in which the differential of tariffs is the highest. Firstly is the animal products, where the tariff differential is nearly 30.2%, which means that India is charging this much percentage points higher than what US is charging on animal products. Vegetable products 20.5%, food products 35.6%, footwear 17.2%, textile 15.6%, and this would be the important sector because a lot of companies from India export various types of textiles and garments to the US market. Followed by there are many other products like transportation, chemicals, also one of the important products stones and glass and minerals, and the tariff differential for these products stands anywhere between 8.6 to 14.4 percentage points.
The auto sector is likely to be the worst hit due to Trump's reciprocal tariffs. My colleague Tushar joins in to tell us the potential impact on the Indian auto sector.
So, original equipment manufacturers, the companies which manufacture vehicles, are seen largely insulated, but there can be some impact on the auto component makers due to the Trump reciprocal tariffs. So what are the companies that may be impacted? First is Royal Enfield, because some of its 650cc exports are targeted towards the US market and then the European market. Auto auxiliaries like Sansera, Suprajit, BKT, Sona Comsta as well as Mother and Sumi have significant exposures to the US market. But the impact is seen limited because what analysts are saying that these companies have already started looking at workarounds from these US tariffs that may include routing these exports via other countries such as Mexico or Morocco, where these companies may have operations. The impact on auto auxiliaries also should be seen from the point of view that these auto components go into several American cars, including Tesla as well as Ford. So if these exports become more expensive, which means the American cars will also get more expensive, and that's not a good idea for a market which is already seeing a sales slump. Any hike in the tariffs will, but India is a preferred partner to the US, so it seems largely that all these companies will be insulated. Also, we have to remember that India's forms just 2%, it's about $6 to $7 billion. India exports just about 2% of the total auto components exposed to the US, which is about $300 billion in a year. So small fraction, limited impact, that's what the story is emerging at this point of time.
Right, Tushar. Now, Prime Minister Narendra Modi became the fourth world leader to visit Donald Trump in the White House since the start of his second term as President of the United States. Among multiple points of discussion, the chief point was the question of Trump's newly announced reciprocal tariffs. Nikunj Garg from NDTV has the key details of the meeting.
Both leaders have done an exceedingly good job because repeatedly President Trump, I heard him in the Oval Office where I was allowed to be present, and I heard him at the White House's press conference, the press conference hall of the White House. Of course, we heard the joint statement too by both the leaders given separately. President Trump repeatedly referred to the good work that he was able to do and achieve in collaboration with Prime Minister Modi during his first term. So in that sense, in fact, the beginning was that we missed you at the White House. And then, of course, going ahead, he said that the Prime Minister is a great leader and he's doing a lot of good work back home. So in terms of rekindling that warmth, in terms of reworking that chemistry, now that once again it's the Trump's White House, they have done an exceedingly good job. Other than the fact that substantive issues like dealing with the thorny issue of tariff and illegal migration and dealing with the expansion, Prime Minister said right in the very beginning of his statement that he wishes to expand, he wishes to broad base this relationship. He said, "Hum is relationship ki vyapakta chahte hain," and which means that he wanted to spread this relationship far and beyond from where it has reached already. That showed in finally concretizing the output in the form of India opening 2 new consulates in Los Angeles and Boston, which makes this India's largest diplomatic presence anywhere in the world and by any country in the United States of America too. So that clearly shows you the depth of this relationship.
Prime Minister Narendra Modi has met with Elon Musk, who is a close ally of Donald Trump, hours before his bilateral talks with US President Donald Trump. Space, mobility, technology and innovation were the key topics discussed during the meeting with the tech billionaire. They also discussed strengthening collaboration between Indian and US entities in innovation, space exploration, artificial intelligence, and sustainable development. Speaking of the markets in India, another week of losses for the market. Benchmarks, Nifty and the Sensex end a volatile session with cuts, but small caps enter the bear territory, wiping 1.17 lakh crore rupees in market cap. My colleague Harsh is joining us with a wrap of the markets today.
Well, the Nifty 50 index down 0.5%. The Nifty Bank also down roughly 0.5% thereabouts. But the pain was really sharp in the mid cap and the small cap end. 2.5% down on the Nifty mid cap. We saw a recovery of sorts, maybe 0.5% thereabouts. The Nifty small cap 3.3% lower. Again, a recovery. It was down nearly 4% at the day's low. So lots of pain starting to get built in at the broader end. You look at both of these indices for the week, 10% down on the Nifty small cap, 6% wiped out from the Nifty mid cap. The Nifty 50 though bad, but not as bad, 3% lower for the week gone by. So pain nonetheless. Let's look at some indices. The Nifty Pharma Index was down nearly 3%, tariffs and some bit of skepticism, but it's down 6% for the week. So pain even within individual indices. The Nifty IT Index was relatively resilient in trade today, down just about 0.1%. The Nifty Auto Index is the other one, which is down roughly 2% in trade today, but again down 5% plus for the week gone by. So pain in those two pockets, and tariffs being possibly one of the components of that pain. Last off, I want to talk about the Realty Index, 2% down today, but 10% down for the week gone by. Again, in line with how the small cap index is performing, this one seeing a bulk of pain, at least among sectoral indices. And therefore, it's just been a very, very difficult week. Here's hoping that the next one may just improve a wee bit.
SEBI has been keen on allowing an Indian credit rating agency to verify past risks and future return claims made by market participants like research analysts, investment advisors, and algo providers and others. While there has been a high demand to have a solid framework on the issue, the regulator may take 3 to 4 more days or weeks to come out with the final circular. Charu is joining us to explain the story.
So the market regulator Securities and Exchange Board of India has come out with an order against Ellis Industries, which is a textile company, and its promoter entity as well as other key individuals within the company. The regulator mentioned in its order that it started its investigation after getting triggered through an article that was published on the website of NDTV Profit on 3rd Feb 2025. Now what happened here is that as a news organization we had flagged out that despite having no or zero negligible revenues for the past quarters, the company had a market valuation of over 5.5 thousand crore rupees. Now SEBI in its investigation found out that there are several loopholes and gaps in the disclosures made by the company. It found out that the information given to investors to make their decisions was false, and the valuations and the frequency with which the trades were carried out and the disclosure entities that were in a coordinated way related to the company were also having some shady transactions in relation to the trades that were being conducted, and that is why SEBI came out with an immediate order. However, a more formal and more detailed investigation will be carried out that has to be closed by May 15th this year.
Thanks for explaining that story to us, Charu. Now, RBI issues notice to New India Cooperative Bank in Mumbai. The strong move by RBI halts all financial operations of the bank. As per the notice, the bank is not allowed to grant or renew loans, make any investment, borrow funds, accept fresh deposits, disburse any payments, and more for 6 months. Now, the decision imposed is effective from the 13th of February. In fact, Reserve Bank has also superseded the board of directors of the cooperative bank for a period of 12 months. Crisis-laden customers gathered outside the bank demanding money and seeking clarity on the situation. India's wholesale price inflation eased to 2.31% in January as compared to 2.37% in December. The wholesale price index-based inflation for the month was also lower than the estimated 2.5%. While wholesale inflation in primary articles declined, led by easing food article inflation, the month witnessed an increase in prices of manufactured products along with continuing deceleration in fuel and power. Within the food basket, vegetables such as potatoes led the decline in prices. Vicky Kaushal's Chhawa movie hits the theatre today. The film is based on the life of Maratha king Chhatrapati Sambhaji Maharaj, directed by Lakshman Uttekar. The film features Rashmika Mandanna and Akshay Khanna. The movie has earned around 4.24 crore rupees from the advance booking collection. Here's NDTV's discussion with the star cast. Listen in.
So तकरीबन 6 से 7 महीने का prep work गया है before we really went on floors, and then there was about 7 to 8 months of shoot time, which was also constantly just rehearsing and working and all of that. So total about year and a half. But in that sense, it was far more demanding, far more challenging to portray this. Required a lot more conviction with the grammar and the pitch that it was played at. And overall, of course, when there's history at play, when there's a character which has sentiments attached to it, there's an added responsibility that you have to do it with utmost sensitivity, utmost authenticity and respect towards that character.
ChatGPT's parent company OpenAI begins the process of setting up data center operations in India to support the country's growing user base and growing demand for artificial intelligence tools. Media reports indicate that the data center will store data from Indian users and may also host data from smaller neighboring countries. If OpenAI's plan to set up a data center in India is successful, India will be one of the few countries where the company will have both an office and a data center. OpenAI's current offices are located in Tokyo, Paris, Brussels, New York, Seattle, Singapore, San Francisco, London, and Dublin. Now, Valentine's Day is here and love is truly in the air. This year, young Indians are splurging more than ever, turning it into a week-long celebration. Spending remains high, with roses, chocolates, and romantic gestures leading the way. Take a look at the latest report from Cesar Sen.
While Valentine's Day on February 14th is globally recognized, in India, the days leading up to it are increasingly becoming popular. Each day is dedicated to a specific theme, starting with Rose Day on February 7th, followed by Chocolate Day, Teddy Day, and more. This trend is prompting businesses to make the most out of this lucrative event, with sales expected to touch record high this year.
This is the first Valentine and I've been here for a long time at F&P. I see almost in terms of volumes, number of orders which we are doing, I see a 300% growth. And this is something which I had never seen. And primarily this is because of the quick commerce platforms wherein we are able to supply the bouquets, the hampers, and this is giving us a very phenomenal growth. Rose Day is a very substantial day for us, wherein we have multiple offerings on flowers, whether it is starting from a single stem to a arrangement which is maybe around 25,000 rupees. So on Rose Day, we saw a growth of, in terms of volume of orders, we saw around 100% growth. In terms of revenue, we would have seen somewhere around 50% growth.
E-commerce and quick delivery platforms are driving demand and launching aggressive marketing campaigns to promote all kinds of romantic gift items. Many young adults are also spending on experiences like a staycation or a spa day. Now, although prices are higher than last year, so is the demand. Many hotels and resorts are fully booked for the Valentine's weekend.
February has always been a strong month for all hospitality sector, and we normally see 80-85% occupancy. So this year also we are expecting a similar occupancy, but what is benefiting us is the robust growth in the ADR. So if you look at our ADRs over last year, we are seeing a growth of around 17 to 18%. So which will benefit us in overall revenue, and we are expecting a growth of around 20%.
Estimates suggest that Indians spend roughly 25,000 crore rupees on Valentine's Day. Now, while the formal sector thrives, a significant part of this Valentine's business remains unmonitored. Street vendors and local florists are bustling with activity as young adults don't mind spending to express their feelings. Overall, the impact on consumption is noteworthy, and businesses are hopeful of a recovery as consumer sentiments improve. In Delhi, this is Sesha Sen for NDTV Profit.
Well, on that note, wishing you all a very happy Valentine's Day, but do stay tuned to NDTV Profit to get all your latest updates and news.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
If you had told me when we started that we would be a predominantly cafe chain, that was not the original vision that we had for the company. Coffee has a bit of a cool factor that tea doesn't have.
Cappuccino, Americano, or a cortado? What is your favorite?
I drink Americanos all day.
How many cups of coffee a day do you drink?
Anywhere from 4 to 6.
What's the worst cup of coffee you've ever had?
Nescafe instant coffee. That's probably one of the worst cups of coffee I've had.
If you had no other coffee in the world but instant coffee, would you have it or would you go with it?
I'd get green tea instead.
nation that loves its chai, one wonders why coffee, and that too gourmet coffee, has become such a craze. And one of the brands at the forefront of that is what I'm talking about today in this episode of The Disruptors. We're speaking with Matt Chitranjan of Blue Tokai at this lovely space in Mumbai at this cafe to understand the story behind Blue Tokai and why India has started loving its coffee so much. Matt, thank you so much for speaking with us.
Thank you very much for having me. It's a pleasure to be here.
All right, let's start with the story of Blue Tokai. And you know, if people are wondering why we have so much coffee here, is because we're going to get Matt to do a little explainer for us on which coffee is what. But before we do that, let's start with the story of Blue Tokai and why everything is blue. What's the idea here?
So Blue Tokai was started in 2012 by my wife and I. We were both at points in our careers where we were looking to do something on our own, and we were really struggling to find a good cup of coffee. So we were in Delhi, and at that time there was the Cafe Coffee Days, some international brands like Costa, Coffee Bean and Tea Leaf, but all of them were selling kind of a commodity coffee product. So I grew up in the US and I was exposed to specialty coffee culture there. And so I was looking for a good cup of coffee that you would get in the third wave. So we started doing some research. We found that there were estates who were growing very high quality coffee, but they weren't focused on the domestic market. They were exporting their coffee to places like Japan, Europe, but none of them were interested in selling the coffee domestically. They felt that Indian consumers weren't ready to pay for the quality of coffee that they were offering. We felt something different, so we went down south. We convinced them to sell us their export quality coffee, and then we launched the brand in 2013. Now, Blue Tokai comes from the logo, which is a peacock. So peacock is the national bird of India. We really wanted to create an identity that was reflective of where that coffee comes from. So if you go to the coffee estates, you'll often see peacocks flying around the estates. And honestly, the blue is because it sounds better than red Tokai. We needed a color to go along with the name.
Okay. So yeah, okay, fairly simple. So 2013, you start the brand. You start in Delhi, which is your hometown. And now cut to 2025, you're over 130 outlets countrywide. It's also a very different time. I mean, I know you've opened your first international outlet as well. It's no longer the days of, like you said, one CCD, one barista, one coffee bean. Starbucks is here in every corner. You have international brands. And then you have this whole movement of homegrown Indian coffee makers who have the same idea that you do. What is it looking like today?
I would say today is much more encouraging to be running a coffee brand than it would have been in 2013 when we started. Coffee culture in India has really taken off in the last few years. You see it just by the number of cafes that are being opened up. Now you can go to any town across the country and there'll be at least one or two places that are serving good quality coffee, which never was the case when we started. So while it may seem that there's a lot of brands coming up and a lot of competition, I think it's also important to understand that there's only around 5,000 branded coffee shops in the entire country. And if you think of the size and scale of India, 5,000 is really a drop in the bucket. So we're happy that there's more coffee shops opening because all of these different brands have different styles of communicating with customers, different USPs. Ultimately, that's helping to grow the overall market for us.
What's your USP? I mean, how do you separate yourself from a lot of gourmet brands? And every city has its favorites, actually.
Yeah.
Every locality now has its favorites for people who are willing to pay more for a premium cup of coffee. So what is your USP?
So product has always been core to us. That's something that we've never wavered from. We started this company because we wanted to have good quality coffee, and that's really been the bedrock of everything that we do. So right now we have the widest sourcing network in the specialty industry in the country. There's more than 50 estates that we work with to source the green coffee from. Growers that are doing amazing work at the farm level, because ultimately our coffee will only be good as what happens down there. We've also started partnering with small-scale growers, which are the majority of growers in the country. So we help provide them with technical assistance to improve the quality of coffee. In some cases, we process that coffee fruit ourselves. Then we operate 3 roasteries across the country. So one is getting good quality raw material, but then how you roast that and extract that flavor is incredibly important. That's something that we've always been doing ourselves. It's been something that we've invested a lot of time, money, and effort to be able to really roast that coffee expertly and consistently. Then it's being available. So our idea for the brand is that anytime you want a good cup of coffee, no matter however or wherever you like to drink it, Blue Tokai should be the brand that you go to. So we operate 135 cafes across the country, but we also have a very strong presence on e-commerce, on quick commerce, and then also in offices as well.
Okay, so all of which you described about sourcing the right coffee, roasting it the right way, and focus on quality. Again, and at the cost of sounding repetitive, there are more and more brands who also say the same thing and are doing the same thing, and say that, look, we get our own coffee, we roast it ourselves, we do it in a quality fashion. Then what makes you stand out? And more coming in.
Yeah, so I think there's some nuance. One is coffee is subjective. So it could be that you like a particular style of coffee that brand A has. Someone else like a particular style of coffee that brand B has. But access and convenience is very important. Very few people are willing to go to the other end of the town for a particular cup of coffee, no matter how much they might prefer it over someone else. Yeah. So can we be the brand that's most accessible? Can we be in the places where you frequent regularly? So that it's very easy for you to get a good cup of coffee. You don't have to think twice. Oh, I'll go to Blue Tokai. I know it's consistent. I know it's high quality. I don't have to travel anywhere else to get that. So I think that's a big advantage for us.
And how do you maintain consistency? I think that gets to be another big question mark, because a lot of the process of making coffee is also on the skill of the barista.
Sure.
Yeah,
sure,
and then you need to make sure that that's the same everywhere.
Yeah.
Especially if you're going to be in the quick commerce space, which you are now.
So I think it all starts at the roastery, right? So one is we have very strong processes to ensure the coffee that's going to the cafes is roasted to a very high quality level and very consistent. So one is we've invested a lot in the technology that we have and the roasteries. We recently put in place new Italian roasting machines, which are designed to extract better flavor from the coffee. There's a software program that's layered onto that so we can ensure that coffee is roasted consistently every time. Then at the barista level, at the cafe level, we spend a lot of time on training. So there's an intensive training program that all the baristas undergo through. Then they go into on-the-job training, plus we layer that on with a learning management system so they can do online training as well. And then we equip them with tools and technology to ensure that they are brewing the coffee consistently. So if we're roasting the coffee consistently and it's being brewed consistently, that's 80% of the job done.
Okay. Then making it is not as tough, you're saying.
It can be taught to someone. It's not, we don't do automatic machines, so it's not a push button solution, but we equip the baristas with training and tools to help make their job easier.
Yeah, absolutely. If it was a push button solution, I don't think you could charge that premium for it.
Yeah, and that's not the experience that we want to deliver to customers also.
All right, let's do a quick coffee lesson for the coffee snobs and for those who want to show off that they know all of their coffees, because remember, this is still a growing culture. So we have 5 cups here. Matt, why don't you take us through this and tell us which one is which? How do you identify which coffee is which, and which one you think is the best?
Sure. So they've been sitting here for a little while, so you see the color has changed a bit, but this would be a cappuccino, which is the most popular coffee that we offer. Cappuccino has espresso, steamed milk, and foam in equal proportion. So if you see, this should have quite a lot of foam still on the top. I think cappuccino is the most popular because it's the default one that everybody knows what cappuccino is, so that they order that by default. Next would be the flat white, which is very similar to a cappuccino but has less foam. So only the top layer here has foam and the rest is steamed milk and espresso.
So it's a slightly stronger cup.
This will actually be stronger because this has more milk than a cappuccino, because when you foam the milk, you use less milk. The strongest cup will be the cortado, which is espresso and a small amount of frothed milk. So this would be the strongest way.
Okay.
Now, coming to black coffee, which is what I drink, this is an Americano, which is just espresso topped up with hot water. So this will have a punch from the espresso shot, whereas this is a pour over, which is a manually brewed coffee. So that you ground coffee and then you slowly pour hot water over the top. This gives a more balanced, slightly lighter coffee compared to an Americano.
Okay, so what is the best seller that you see?
Cappuccino is the number one.
Cappuccino always. In terms of where Indian consumers are in their journey of understanding coffee and moving forward, what are the changes you've seen over the last several years? You've been doing this since 2013. Is it a very, very different market today?
I would say interest in coffee is significantly higher now than it was previously. there was always a niche consumer who understood coffee previously. That segment has grown, but more and more people are interested in coffees. More and more people are interested in going to cafes. Coffee has a bit of a cool factor that tea doesn't have. And so as the country has grown and more people have had more disposable income, they're choosing to spend that on coffee than if I looked at compared to 10 years ago.
And are you seeing that now move beyond your tier 1 cities? Since the pace at which you've moved to 135 locations, I'm just trying to understand, is most of the contribution in the top 6 cities?
Yeah, but that's more of a business decision for us, not that there isn't demand in other cities across the country. So Starbucks is around 450, but they're at 79 cities throughout the country. So that's they're everywhere. So that just tells you the depth of the market and the demand for coffee in all cities across India.
Do you aim to be the next Starbucks or the Indian Starbucks?
I don't want to comment directly on another brand, but our goal is not to be Starbucks. Starbucks is a second wave company. We're a specialty coffee company. So for us, ensuring the quality of the coffee that we offer is very important. Do I think there's potential for us to get to 400, 500 outlets in the country? Absolutely.
No, so explain the difference to me between what did you say? You're a specialty coffee and they're a second wave coffee shop.
Yeah.
So what's the difference?
So the second wave of coffee happened in the, I think, 80s or 90s when these coffee chains started blossoming up, and that became kind of the dominant type of coffee. Third wave of coffee is where you really focus on the origin of where that coffee comes from. So that means visiting farms, sourcing coffee from farms that are really paying attention to good quality coffee. There's actually a technical scoring. You have to score above 80 points on a 100-point scale for it to be considered specialty. But more broadly, it just means that focusing on quality in every step of the process. So sourcing good quality coffee, roasting that coffee very carefully, and then paying a lot of attention on the brewing end. So it'd be very rare that you'd see a third wave coffee doing automatic machines, because the technology in the automatic machines is not yet to the point where you can extract the best flavor out of that coffee.
So I think we need to get a masterclass from you on how to make the best cup of coffee.
Yeah.
Because you also provide the beans. Pluto Kai also sells the beans. So we'll definitely do that, where we get the focus on, if you're buying it at home, how do you make a good cup of coffee? It never tastes the same.
Yeah.
So why does it not taste the same?
So one is that the equipment to get, the equipment that we have in the cafes, that costs, the espresso machine itself costs 8-9 lakhs. The grinder costs another 2 lakhs. So very few people are willing to invest that much of money in a home setup. But it can be made very consistently if you just have a scale and pay attention to the recipe. So I think the number one thing that people can invest in to improve the quality of coffee that they're making at home is buy a grinder. Grinding the coffee fresh makes a big difference. And then getting a scale to make sure that you're doing the same recipe every time.
Yeah. In terms of, this journey for you, Matt, and we talked a bit about, you started, you didn't like the cup of coffee that you had around you, and then you started this off. But when did the real lift-off take place? In 2013. At that point, how easy or difficult was it to raise funds? You've now recently raised another round of funding. What was the scenario then?
So in 2013, we started very simply. It was Namrat and I operating out of a spare bedroom in her parents' house. So we scrapped together a little bit of money. We got a small tabletop roaster, a small grinder, and we launched the brand with a few lakhs of investment, very simply, selling online, and that's sort of the origins of it. So from there, we started selling B2B. So we tied up with a few offices, a few other cafes, got some initial traction, hired some employees. We ended up moving into another room in Namrata's parents' house, and then it kind of reached an inflection point of where we had to decide, did we want to keep it kind of a mom and pop lifestyle business, or did we want to raise outside capital and scale? We felt that the opportunity to sell good quality coffee, to sell specialty coffee in India was too large. That if we didn't if we didn't scale, whatever first mover advantage we had developed up to that point would be lost by someone else and could really threaten our business. So that's when we decided to reach out to people, and we raised our first round of funding in 2014.
So 2013 you start, out of a spare bedroom with a few lakhs of investment. 2014 is your first round of funding. What would be the top line of the company today?
Right now, we're at a 400 crore run rate.
Yeah, and what do you aim for it to be?
So we're targeting to reach 1,000 crore run rate in about 2.5 years.
Wow. So that's a huge jump. And do you think that if you started off today, I'm trying to understand if it was a mix of just also the vision and also the timing, right place, right time. If you started off today,
I mean, so
what would that picture look like?
Now it would be a bit harder to establish the scale that we're at because there's brands like us and several other brands who have reached a certain scale. So you would have to come up with a different proposition for customers in order to sort of differentiate yourself from the players that are in the market here. I think in 2012 when we started and 2013 when we launched, it was early. The first couple of years were a bit of a slog, though, it was very slow and steady. And really now is when we've seen kind of the coffee market take off. So I think there's definitely opportunities. I think there's tons of opportunities for people to open standalone coffee shops. I think that's an incredible business for people to be in. I think, every neighborhood could have a standalone coffee shop. But to get to a scaled business now, I think it's a bit more challenging than it would be when we were doing it.
And in this journey, because a lot of people watching this may be people who want to start their own businesses, could be in F&B, could be in any space.
Yeah.
And you always look at someone who's tasted that success, in this case you, and Namrata, of course. And then you wonder, was it a one-way street? Did it just go to plan year after year after year?
I don't think. I would love to meet the person where that's happened for, who started a business and everything has gone according to the spreadsheet projections.
Yeah.
No, there's been so many ups and downs. And
what was the worst?
COVID was definitely the worst. COVID was the worst because, we were operating, I think, 20 to 30 outlets at that time, had a decent amount of staff, and that business went to zero. So we had to make and at that point in time also we were in a fundraising process, so it's not like we had a lot of reserves that we could rely upon. And it was actually a point, and whatever fundraising round, obviously that got pulled because of all investors were uncertain about what the world was going to be like. So we had to make, cuts to staff. Everybody had to take a pay cut, had to really do a lot of things in order just to ensure that the business survived. So that was definitely the hardest time that we faced.
And then what was the comeback like? Was the post-COVID revenge consumption on everything really the wind beneath your sails in that sense?
Yeah, so we were fortunate in that we had been omni-channel for quite a long time. So at least during COVID, when the lockdowns were happening, the online business took off and was really able to support us to some extent. I think one positive that came out of COVID is that people got used to the convenience of ordering on the apps. So even when things started opening up and revenge dining started happening, we still saw that delivery continued to grow as a share of the business. And now we're sitting at close to 40% of the revenues from the cafes coming from delivery. And I think COVID was a big boost to leading to that behavior change. India doesn't have a strong coffee takeaway culture. I think the infrastructure of our cities are not really conducive to grabbing a cup of coffee and walking to work.
Yeah.
So that behavior has really shifted to delivery. So
we want everything delivered, let's be honest.
Yeah, I mean there's a convenience aspect associated with it, but I do think that if sidewalks were nicer and cities were nicer places to walk around, people would be happy to grab a cup of coffee and walk around a neighborhood. It's just right now the cities are not built that way.
Do you think that you have a proposition that could ever go mass on scale for a brand like yours? Or would you want to keep it premium, and that's the plan? And does that make more sense?
Yeah, I don't ever want to compromise the quality of the offering that we have. So if being mass in scale means having to degrade, I don't want to reduce to make it cheaper, use cheaper coffee, use cheaper food ingredients, introduce cheaper bakery, that's not the vision that any of the founders of our company have. So, and it's also that's something that our investors are pushing for.
So how are you going to do that if you have to deliver coffee in 15 minutes? Because I know you've tied up with Snack,
Yeah.
which is what Swiggy is trying to do in this whole 15-minute rush.
Yeah.
How would you keep this quality that we've been talking about?
So I think on delivery for coffee, the taste maintains even after 30 minutes, 35 minutes. What happens in a cappuccino is it won't come with the foam on top. And I think customers understand that there's some trade-off for the convenience aspect, so that no one really expects a cappuccino to be delivered with a good amount of froth, because that's just not possible. So I think that trade-off customers are willing to accept, and that's a quality for convenience trade-off as well.
Okay, so you don't think that there's going to be any compromise on quality with quick commerce?
No.
What do you make of the quick commerce craze right now, and not just on coffee? I think the big push across the space, because those worlds intersect for you as well, is faster. Let's get everything done faster.
Yeah.
In a way, it's the complete opposite of your process, right?
No, so I mean, if you can do it faster and still deliver a high quality product, everybody would love that, right? So even if I look at my own consumer behavior, there are days when I order 4 or 5 times from these apps, just because it's very convenient to have, I forgot some, I feel like having a juice right now, so I'll get a juice delivered. So I think it's important to understand what customers want and to have products that suit those customer desires. And I do think that that's going to be an important lever for all brands going forward, because it's hard to imagine a use case for someone going to our website, entering their details, waiting 2 days for that coffee to come, when in 15 minutes they can get that same coffee packet delivered to them from quick commerce. So we see quick commerce as where more of the higher selling SKUs will be placed, because it's important that we have rapid turnaround, because there is a shelf life associated with coffee. And on the website, we can have the longer tail of our complete offering. So if there's a particular, like a unique lot of coffee that we have, that will only be available on our website. If there's, some of the slower moving SKUs that still have a cult following, those will all be available on the website. But the top sellers will be available on quick commerce.
Okay, so you think that there's space for quality and speed to both coexist?
Definitely.
In terms of advice, really, Matt, to anyone looking to scale up a business, to starting out, and we know that most new businesses end up faltering and failing. What would you say has been your biggest learning in your journey so far?
Yeah, I think you have to have a lot of perseverance. There's, like we were talking earlier, there's very few businesses I know that have gone completely according to plan. We've had to make many sort of, not necessarily pivots, but focus on different verticals at different times in our journey, because those were the levers that were performing well at that time. If you had told me when we started that we would be a predominantly cafe chain, that was not the original vision that we had for the company.
Oh, what
it was just to sell coffee online and wholesale. Cafes have a lot of challenges associated with them, finding good real estate, managing people, managing compliance. There's a lot of issues. On the flip side, there's so many great things that come out of having a cafe. You get to interact with customers on a daily basis. You get real-time feedback. And I think people enjoy a good cafe experience. So now we've been able to, over the last few years, we've really leaned into being more cafe forward, whereas in the past we were more product forward.
And what do you see as the journey? Does your company continue in this way? How necessary is it to keep innovating, pivoting, changing? Or do you need to be consistent with what you're offering?
No, so I think the next couple of years will be more about expanding the cafe, because that's where we see more consumer demand coming. More people are asking and wanting to visit cafes. But maybe 4 or 5 years down the line, then the product business can, the original vision of being more product-led can come into fruition, because at that point in time, coffee culture will have evolved. So you have to be very attuned to kind of what customers are looking for within the industry you're operating. Right now, it's more cafes. I think 4 or 5 years down the line, it'll be like other markets where people are brewing more coffee at home.
Oh, so you see the at-home coffee brewing also coming in on board.
Yeah.
That was the journey of Blue Tokai, and of course so much more to go. It's also reflective of the entire movement of coffee and a class of Indian consumers who are willing to pay more for quality. Definitely an exciting space to be in. Thank you.
entire special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched.
Hello and welcome. Good evening. You're watching Ask Profit on NDTV Profit and I'm your host Malika Mishra. In the next half an hour or 1 hour of this show, we will bring you the latest and we will actually get our guests to answer all your queries. So please do not forget to call us on the numbers flashing on your screen. You can also write to us on WhatsApp, both the numbers of which are flashing on your screen. Today, we're being joined by Vikas Jain on the technical queries. So do call in and let's head straight to our first query. Shah Jahan has written to us from Oman. He holds 79 shares of Swan Energy at 640 apiece. Vikas, what's your view on this particular company? And before that, if you had to give me three picks for Valentine's Day, three stock picks for Valentine's Day, which one would they be?
Yeah, thanks for inviting me on the show. So if you look at the markets have closed at almost 8 months low. We are at near to 22,800 levels where the Nifty has bottomed out earlier in the part of this January month and saw some amount of recovery to 23,800. Now once again we have declined sharply, but we believe there are some amount of safety pockets which are showing some amount of resilience and strength. So if you look at Asian Paints, the numbers came out, the stock had some amount of positive momentum, and then again stock drifted downwards. We believe the stock is at multi-month average. The valuations also support in the current juncture. So Asian Paints looks attractive from current levels. There are multiple news flow going around for one of the larger paint companies to be getting sold off. So that could be a trigger for the whole sector. So that stock could get re-rated from current levels. So we are very positive on Asian Paints from current levels. We believe a 12 to 15% upside could be expected over the next 12 to 15 months. The second stock we like is Aarti Industries from the chemical space. So if you look at the chemical space, structure has outperformed over the last 1.5 months, where the likes of SRF, Navin Fluorine from other mid-cap chemical companies have done pretty well. And the stock has been sweetly poised. Aarti Industries also had its own run from 395, 300 odd levels to 475, 488. It tested the 100-day average and then again declined. But we believe this corrective opportunity gives a good opportunity to enter into this name. The current quarter results were also been pretty good, and we believe the stock could move further higher back to near to those 475, 480, the first band of resistance. And if that has been crossed, then we could see strong amount of up move. So Aarti Industries looks attractive. If traders want to keep a stop, they can keep a stop up around 390 odd levels and move right the up move.
Okay, got it.
The third, yeah.
And your view on Swan Energy?
So in terms of Swan Energy, the company has witnessed a strong amount of sell-off. It has even broken the multi-year lows. So we believe there could be more pressure into the stock because the stock is again back below the 100-week average. So some more amount of corrective action cannot be ruled out. Maybe the stock could decline near to 385, 370, which is a good 10 to 12% downtrend from current levels. So it's better to exit now or exit on rallies.
Understood. And now we have a caller called Ramesh joining us on the phone line from Chennai. Hi Ramesh, good evening.
Hi everyone, good evening.
Good evening. Please ask your question, Ramesh.
Yeah, my question is about Senco Gold. And even though their revenue for the Q3 is increased from Q2 and their profit also increased by from 15 crores to 33 crores, but still the stock went 20% down today. Actually, I was thinking to invest 50,000-60,000 rupees a couple of days back. So since the result is coming, I was just waiting. Fortunately, I was waiting for some time. So it went 20% today down. Right. So is it right time to invest right now? So or do I need to wait for some more fall?
Got your question. Vikas, what's your view on Senco Gold? Ramesh wants to know if this is the right time to enter, and given the context that the stock has seen a beating of close to 20% in the markets today. In fact, has hit its 9-month low after weak Q3 earnings. Margins were bad. In fact, the entire report card looked weak for this company. How does Senco Gold look technically to you?
First, I'd like to congratulate Ramesh for not investing into the stock and tracking the corporate development. So the stock has witnessed a good vertical fall, but if you look at, there was a major corporate action in terms of the stock split data. So a lot of liquidity has been also infused into the stock over the last 1 week, and we have saw a good amount of sell-off. We believe some more pain cannot be ruled out at the current levels. The stock can slide further near to 300 to 285 to 300 levels. So anything between 285 to 300 would be an ideal opportunity to invest into the stock, because that would be the first breakout zone from where it really started. So 285 to 300 levels would be an ideal zone to invest into the name.
Okay, understood. And now we have Anindya. He's calling us from Chennai again. Hi Anindya, good evening.
Hi, I'm having a specific query towards SBI card.
Okay.
I'm holding approximately 100 quantity at an average price of 757.
Okay.
I'm holding this stock since the inception, that is IPO price, and that is 2020.
Okay.
So I wish to hold it for further 5 years from here on. Just want to understand the technical side of it and what is our experts' view on this.
Got it. Vikas, Anindya holds 100 shares of SBI card at an average price of 757. He has made a profit of close to 10,000 rupees since he invested in this company. The stock is currently trading around 857, so 100 rupees, exact 100 rupees more than his buying price. And it recently also hit its 52-week high. Do you think it has more potential to go up here onwards?
Yeah, it would continue to remain invested because if you look at the SBI cards itself, the stock was a major underperformer for almost 2.5 years. And after a strong underperformance of more than 24 to 26 months, it has witnessed strong amount of recovery and the stock is outperforming compared to the broader markets. So we believe it has crossed multiple band of higher top formation structure. So the first band of resistance area would be 960, 965. If that is being crossed, then the stock can further move near to 1030. So he can continue to remain invested. Maybe if he wants, he can put some minor profits at 960.
Got it, got it. And now we have another WhatsApp query. Srinivas has written to us from Hyderabad. He holds 230 shares of Piramal Pharma at 227 rupees a piece. And he's asking if he should hold or sell the counter. Now, Piramal Pharma is currently trading around 186. So quite below his buying price. And he's sitting on a loss of close to 10,000 rupees again. And the stock was down close to 7% in trade. A lot of pharma counters have also been reacting to what's going on with Trump and his tariffs. And today he announced that he's going to implement the tit for tat policy. He's going to charge India the same tariffs that we charge them. Do you think, given this global scenario and uncertainty around tariffs and how it could impact certain stocks in the Indian stock market, pharma counters like Piramal Pharma can take a hit and see the effect, continue in the long run?
So no doubt the pharma sector has witnessed sharp amount of corrective action during the week. The sector was down by 5% and Piramal Pharma being a high beta stock has witnessed further corrective action. But some amount of silver lining is there. The stock is almost near to its 200-day average. So the stock has witnessed some corrective action below the 200-day average, but we believe a likely bounce near to 205 to 210 levels should be expected. So we can exit near to those 205, 2010 levels because the stock has witnessed a vertical correction from 280 to 180. So some bounce rate cannot be ruled out from current move. So 205 to 210 should be the exit range.
Okay, okay. And now we have another caller. Ravi is calling us from Hyderabad. Hi, Ravi, can you hear me?
Yeah, hi, very good evening.
Very good evening. Please ask your question.
Yeah, my question is regarding Tata Power.
Okay.
I'm holding 50 shares.
Okay.
So I bought each at 248. So since the stock is going down,
Right.
shall I accumulate more or shall I wait for a couple of days so that the stock gets more correction?
Okay. Interesting.
And also,
Yes.
my time horizon is 6 to 8 months.
6 to 8 months. And since when do you hold on to these shares, Ravi?
I bought a couple of days ago.
Okay, couple of days. Understood. And did somebody recommend this stock to you?
Yeah.
Who was it? Your broker?
One of the analysts.
Analysts. Okay, okay. Because Ravi holds 50 shares of Tata Power at 248 and the stock is currently trading around 336 levels. It did see a drop down of close to 3% today. However, it is fundamentally a very good company to invest in. What's your view in the long term? Will Ravi be able to make profits out of this investment?
Yeah, he should continue to remain invested because multiple businesses are being flowing through in terms of Tata Power. The stock also, again, it's near to its 100-week average support area, which has been witnessing for the last 4 to 5 weeks. So the risk-reward ratio remains favorable at current levels. It would remain invested, and we will expect the stock to hit higher near to 410 to 420 over the next 6 to 9 months.
And now we have Krishna calling us from Odisha. Hi, Krishna. Good evening.
Good evening, madam.
Please ask your question, Krishna.
I have Delta Corp 150 shares.
Okay.
At the rate of 137, madam.
Okay. And since when do you hold these shares of Delta Corp?
In the mid-September 2024, madam.
Mid-September 2024. Okay, okay. And go ahead. What do you want to know about the company?
What, madam?
What else do you want to know about Delta Corp?
It is running under loss.
Okay.
My horizon is short to medium term, madam.
Okay, okay.
Mm.
Got it, got it. Vikas, Krishna holds 150 shares of Delta Corp at 137, and if I'm not wrong, this company is engaged in gaming and hospitality business, and he invested in the stock around September of 2024. Has not seen a lot of positive performance on the stock market. In fact, he is sitting in a tad bit of loss, close to 6,000 rupees. What would you recommend Krishna to do with his holding?
We believe we should exit the stock because the stock has been in multiple news flow with respect to GST related issues, and the stock has been a major underperformer if you look at over drawdown between 3 months to 1 year chart perspective also. So the stock has not done anything well. If it breaks, we believe the stock could move further down. So it's better to exit and invest into something else which would make her some return recoveries loss.
Got it. And now we have another caller. Do we have another caller? Okay, so we have a WhatsApp query. Yash has written to us from Hyderabad, and he holds 100 shares of Sirma at 510 rupees. Now, Sirma is currently trading around 440, so below his buying price, and did see cuts of 5% today as well. Vikas, do you have any covering on Sirma, and what is your view looking like on this company?
Interesting space to look at. No doubt the EMS related stocks have witnessed a good amount of beating, but if you look at the stock structure, it has witnessed good amount of bounce after forming some amount of bottom up formation. So 410, 420 is a strong support from where the stock witnessed a vertical move to 560, 580. So again, it is witnessing some amount near to the support area. So it would continue to remain invested into the stock and maybe add near to 410, 420, which is a good support area.
Okay, got it. And now we have Hegde calling us from Bangalore. Hi, Hegde.
हाँ मैडम, मेरा पास 3,000 शेयर है ओकर फर्म का 400 रुपए में हम लिया था।
हाँ, और कब लिया था?
2 साल के पहले लिया था।
2 साल के पहले, ओके। और
उसके बाद अभी 1680 तक गया था पिछले बार। अभी 3 दिन से सेलिंग पे 3 दिन हो गया। कल के वो अपर स्केल हुआ था, आज सेलिंग पेज हुआ, उसके बाद वो ओपन हुआ।
हाँ।
उसका नेक्स्ट फ्यूचर क्या है?
ठीक है।
मैं अभी एक साल रख सकता हूँ।
आप क्या?
अभी 1 साल रख सकता हूँ, परवाह नहीं है।
अच्छा, ठीक है। फर्स्टली कॉन्ग्रेचुलेशन हेगड़े जी, आपने बहुत अच्छा मुनाफा किया अपने लिए वॉकहार्ट में इन्वेस्ट करके। यू आर सिटिंग ऑन अ गुड अमाउंट ऑफ profit over there, close to 30 lakhs, so amazing. Vikas, I'd head straight to you on this one. Hegde wants to know what's happening with his shares. He holds 3,000 shares of Wockhardt at 400 rupees a piece. The stock is currently trading around 1,300, and it has seen high volatility in the past couple of weeks. Especially, we were just discussing pharma space has been vulnerable to what's happening globally. Do you think Hegde should start nibbling on his profits, or should he continue to hold and remain patient?
So if you look at the structure looks pretty promising, but some amount of profit booking has been witnessed near to those 1430, 1480 odd levels. So we have witnessed multiple lower tops on the monthly charts. So some corrective action cannot be ruled out. And as the pharma sector is under pressure, the stock has huge amount of high beta play. So we would advise him to put 50% profit. So he's holding some 3,000 odd shares. So he could put profits to the tune of around 50% by selling 1,500 shares and keep the 1,500 shares as a long term.
Got it. And now we have Kalyan calling us from Chennai. Hi Kalyan, good evening.
Hi, very good evening.
Good evening. Please ask away your question.
Yeah, I'm holding some 22 shares of Adani Enterprises, which I bought in December 2024.
Okay.
So actually, initially I just bought it for on a short term only for 3 months like that.
Okay.
But however, now it almost came down to 21.52 I think so for today as 3:30 status.
Correct.
I just wonder whether I can accumulate here in this position, or else I need to wait for till few times and then I can accumulate some more shares in this one.
Understood. And now, does your your time horizon has changed? Do you want to hold on to this company for a long term?
Almost for another 3 to 4 months like that.
3 to 4
6 months like that.
Understood.
Yeah,
okay.
yeah.
Vikas, Kalyan holds 22 shares of Adani Enterprises as 2,470. That's its average price. The stock is currently trading around 2150 levels and has seen a bit of beating lately. Do you think it's the right time to enter and accumulate more shares of the same company, given that the stock is a little discounted?
So look at this stock is one of the high beta play into the Nifty basket, but it commands good amount of volatility with respect to both ups and downs. Now the stock has witnessed good amount of 7-8% correction from the recent weekly high. So I believe the limited risk reward ratio, and plus it is near to the multi-month support of 2050-2080. So you can accumulate the shares at current levels and wait for some amount of bounce. On the higher side,